They're gonna bring it down. I gotta feel good. You wanna see my moves? Let's party all night. We gonna build it up and then we tear it down. They gonna know our name all over this town. We gonna stir it up and do things our way. So if you wanna move, get out of our way. I'm feeling fly tonight, like a rocket ship. I wanna drive fast in this red hot whip. We gonna stand our ground and show off all our moves. Get out the glitter ball and play some dope blues. I wanna play the game, I wanna roll the dice. I got an easy hand that's gonna make the night. You wanna dance off? Let's get our shoes on. I'm done with all your fussing, this body totally bussin'. Still coming down from the weekend. Saturday night like we should. I know I should work a bit harder, but baby, your love is too good. You knew what you did when you planned it, you scammed it, making right off like a bandit. I know that you worked a bit harder, 'cause baby, your love
Let's celebrate, dance to the beat. Forget the wars and stop the feet now. The fun and games and memories I love to share with my family. And everything is better when we get together. Everything is better when we are side by side. Hey, 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 side by side, side by side.
up, Tasty Nation? Welcome to the show. Sorry about the technical difficulties. Working through it, but it doesn't really matter, I don't think, because the E-minis are completely flat. NASDAQ are up 70. Dow the Russell down a little bit. But join us on the YouTube channel if you haven't already. We're streaming live there. You can throw in your trade ideas, questions along the right-hand side chat, and we'll get to them throughout the morning. But my name is Mike Butler. I'm here with Chris Vecchio. And Chris, I had a solid weekend, and I hope you did the same.
It was a weekend for sure. I did not get nearly as much time in the sun out east as I had hoped, but wife and kids had a great time, which is what's most important. But now we're back, Mike. And for those that are wondering, why am I here? Where's Jermal? I'm a much less handsome version than your counterpart these Monday mornings. It's because he's on TastyCrumbs Monday afternoons, 4 Eastern, 3 Central, right after last call. Him and Jim Karsan, they debate market structure, whether or not some opinions actually make the markets or they're just things that we talk about. Where's the trade? Mike, TastyCrumbs, it's a great program. Those guys are both whip smart, and I encourage everyone to stick around after last call to go check that out.
Yep, 3 o'clock every Monday, and it's always a blast. They have a nice little dynamic between them, so it's always interesting and entertaining as they battle through just get the discussion topics. But yeah, check it out, 3 o'clock every Monday.
Mike, this market here today, I mean, can we just talk about the pre-market movers? Usually we do a little bit of morning news. It's coming out of the weekend. There may be some things to pay attention to in oil, but I want to go right to Anthropic here because that seems to be the source, the genesis of all of the market movement here pre-market this morning. So Anthropic is obviously preparing for an IPO right now. They released their outlook, their revenue expectations for the next few years, and they're projecting a $190 to $200 billion revenue run rate for 2028. So what are we seeing flow downhill right now? Infrastructure, AI infrastructure is benefiting all around. If it's memory, hardware, servers, there's a nice little bounce here across the space this morning, but a lot of it's in the semiconductor sill. SanDisk, which was a $1,000 stock at the end of July, is now poised to open up near 1,700. Micron looking at a bounce near 2 or 3% at the open. Same thing for SK Hynix. So the memory trade lives on right now, and that's really one of the main reasons why all this volatility has come out of the market, Mike. With the stocks rebounding here, all of a sudden, all of this concern has dissipated now. But Mike, concern being dissipated here, it's what do we have this week? We have expiration this week. We have monthly OPEX on Friday. And you look at measures of volatility, if it's the move, if it's gold, if it's everything is crashed. I can't remember a time recently where all volatility across all sectors of the market was this depressed.
Yeah, it's pretty wild. You've got 2.5 points of contango now, which is the steepest we've seen it since pre-war, pre-tariff. Like really, this is extremely steep. And that's not even between the Q and the U, also between the U and the V, 2 points of contango there. And then it flattens out and increases as you get to the end of the midterms here, or in the midterms, 2025, 2040, and then into 2027. So yeah, this is certainly a lull after we've received almost all the earnings announcements for this cycle. We still have NVIDIA coming up next week, but this week I think we'll get some interesting data with some retail names reporting, and that's between Lowe's, Home Depot, Target, TJ Maxx, Ross Stores, you name it. They are reporting this week. So maybe we get some volatility from that. But as of right now, the market is basically telling us that if we really wanted to, we could just take a hike and come back next week. Because a 28-point implied move here for today is the lowest I've seen pre-market. And this will probably go into the teens immediately on the open. But only a 70-point implied move for the rest of the week. Kind of dull here. And single-digit implied volatility. When's the last time we saw this across all of these expirations here in SPX?
Mike, I really can't remember a time where we...
Chris, go solo.
Okay. Mike, you're going to drop off for a quick second. I'm going to take this here. Mike, I can't remember the last time that we saw volatility this low. Just consecutively across the board right now. You talk about single digits here, and last week I took a few stabs at trying to sell some iron condors throughout the day. Sometimes it worked, sometimes it didn't. 2 of those occasions I missed, I think, literally 1 or 2 points outside of the short strike. but at 20 points and looking at an open in about 20 minutes time where we could be seeing, that go into the teens, I can't just personally justify selling an iron condor going directly neutral when volatility is this depressed and this low here. We're effectively betting that nothing will happen today at all whatsoever. Now, granted, there aren't that many earnings releases today. Maybe those catalysts come midweek. We're going to have Target, Lowe's, Home Depot, TJ Maxx, Walmart, right? A very consumer-facing week after the retail sales report and Michigan sentiment report on Friday. FOMC minutes are also on Wednesday. So there are going to be things that drive this market, but to 20 points at the open, 15 points by the time we get to those first few opening trades, I can't stomach selling a range that's this tight right now. That doesn't make much sense to me. While we're still sorting through your audio issue here, I would point us, actually, Mike, I hear that you're back now. I mean, are you scared off by that low volatility to sell a range that tight at an open where?
Well, I might scare you off with my microphone volume. How's this sound?
Beautiful. It's better. Listen, better than before.
No, I think when it comes to these low vol environments, it's just really tough to create a neutral range when the neutral range is so low. Especially when you look at the recent days in SPX, like these intraday ranges are ominously low and narrow. And I think we did set a record last week for volumes and the ranges that we saw. So I think it's going to be tough for the iron condor sellers out there, but I think you can take a directional shot much more cheaply if you are leaning long or short here. So that's kind of where I'm at, is waiting for neutral trades or finding neutral trades in equities or higher implied volatility ETFs, or the perpetual trade that I have on, like that nothing changes there in the MES and MNQ contracts, because that's just a trade I have on all year. And will continue to have on into perpetuity.
Yeah, I mean, I'm getting a little nervous up here, admittedly, in some of my long equity positions, where with this volatility so low, why not just buy a VIX call? I'm not going to sell a put in the VIX, but why not just buy a VIX call with a little bit of time into it? I mean, do we really think we're going to stay below 17 or 18 through election day, through the end of the year, after election day? I mean, I can't fathom that right now. So, Mike, just for the sake of this conversation, if we hopping over to the VIX, which is set to, it says 1503 right now, if we were to go out to November 18th, 17-19 call spread in the VIX is going to cost you 83 cents, risking 2 to make 3 effectively. I mean, we could go further out to get better convexivity, right? Buy the 18, sell the 20. What are the odds that we see an 18 VIX over the next few months, given this calendar of event risk? And there's another earnings season embedded in there, Mike, right?
That's true.
So you get midterms of another earnings season plus a September Fed meeting. I mean, and another Fed meeting. There's a lot to work with there. So, I mean, this scares me. I know vol can head lower here, but I think one of the points that we're going to want to address over the course of the day today, which I haven't heard yet on financial news because I was preparing for the morning show. I wasn't listening to CNBC or Bloomberg, but I can almost guarantee when they have any options people on the major financial news networks this week, they're going to be describing option selling, the premium selling, as picking up pennies in front of a steamroller right now. And so we're going to have to work through that dynamic, which I think we may have answers to.
Yeah, I think even if you just look at the price chart of the VIX, and I think this is another interesting way to look at it. If you look at the 20 strike out in November, you can right click on it, view the option in the chart, and this shows you where this option has traded over the last however many days or months you want to take a look. But still, even in May and June, this option had its spikes from $4 and change up to $5 a handful of times. So I think these are the types of situations where if you're trying to play for a bounce, at least a flattening of the curve in the VIX futures, that would likely result in the VIX rallying. And this is a longer term contract. If you get this at bottom of the barrel prices at $3 and it goes to $4 or $4.50, like that's a great trade. And the VIX has had a propensity to spike and then drop with the dip buyers that come in. So I don't hate that either. It's just a cheap hedge for 92 days. If you think the VIX is going to pop, even just a naked call, I think makes sense if you're trying to use it as a hedge exclusively.
Yeah. That's not to say that you don't engage the market. As far as I'm concerned, I'm still riding the rails on the long side here, because if it's low volatility, positive technical drift during the summer months, it's difficult for me to stand in the way of a market that tends to scratch and claw its way higher, which it's doing right now. And it feels like there's a gigantic wall of worry there. Will the Fed hike? Will they not hike? The Iran war this, the Iran war that, midterms, blah, blah, blah. But we'll get it to the Mike. We're going to get to those strategies on the other side of this break here, because we do have some, the research team's put together some data about what to do when the VIX is below 15 persistently. And you kind of just got to hold on, but you do have to be careful about how you structure your risk.
Yeah. And just as a little teaser, the slides are just pictures of landscapes, because you should go touch grass in these environments. But yeah, I mean, it's crazy. You look at the CME futures, natural gas down over 1%. Everything else is within 1%, both to the downside and upside, except for New York Harbor ULSD futures up 1%. But like, this is a crazy day when everything is within 1% and the E-minis are completely flat and the VIX is going to get crushed here. VIX is actually up a little bit here, but VIX futures are telling us we should take a hike. But we are going to take a quick hike, but we'll be back on the other side of this break. Join us on the YouTube chat if you haven't already. We'll check out your trade ideas and questions throughout the morning. And yeah, let us know what you're trading with these earnings reports, whether it's Lowe's, Home Depot, Target, Ross, TJ Maxx. We've got a bunch of them this week, but we'll catch you in 90 seconds. You're watching Tasty Live.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, prediction markets all on one platform. Plus, get advanced tools built for active traders.
Here, just taking a look at some of this economic data. We do have some coming out this week, although it's nothing mind-blowing, but I think it's always interesting to check this tab out. You can trade this directly. It's all through Kalshi pipes in here through your Tasty Trade platform, but I think it's always nice to look at these probabilities and base strategies off that. We've also talked about using the financials to kind of hedge certain positions, especially if you're using zero-day stuff. Like if you have a long call spread that's completely in the money at full profit, you could short the S&P daily close or hourly close, something like that. But I like to look at this economic data and just get the probabilities right here in the platform. Does anything stand out to you here, Chris?
Anything stand out to me? Yeah, I mean, maybe the Bank of England rate decision, quite frankly, which is an odd thing to bet on, but they seem like they're in a comfortable place for the foreseeable future. Compared to the rest of the world, they actually can probably maintain rates or push them up, not for inflation reasons, which is interesting because it's the UK after all. So yeah, I mean, but what are you getting here on this 89 cents? Would I ever risk 9 cents to make 1 penny or $90 to make $10? No. So yeah, some of these things that I feel like I'm pretty confident about, the market already has moved them into to being locks, which, that's the virtue of all of us looking at the same sources, or most of us looking at the same sources of information when we place these kind of bets. Is there anything that's an outlier here? I would think that the Fed rate decision is going to be the one that's the jumpiest because the market's been moving back and forth. I know it's set to 1 day here, Mike. Can you change the time frame to like 1 week or all or something a little bit longer term? Mm-hmm. Yeah, you see that there? There was a pinch back in early August where it looked like we were converging. Yeah. And now it's widened out to where the Fed is definitely going to maintain rates. I've heard some folks have discussions online, and I've seen it on Twitter, I've seen it on Reddit. Like, is it possible to arb this out, right? Could I get short the SR3 contract and long a hold in the prediction market? You could. It's not going to be perfect, but also because of the settlement risk, because of the product difference, one may not pay as much as the other. And so I looked at a little bit of modeling around this. I'm going to send this over to the research team, this component of data that I want them to review. But even if you tried to like bet against each other, like you're either long the SR3s and short the prediction markets or vice versa, you're not able to perfectly capture the difference because of fees, slippage, yada, yada, yada. So I would just bet on one or the other. This one on the prediction page, it's a more reasonable contract to operate around, and I think easier to grasp than the SR3 U6, which is basically like it's kind of like a bond or a note, and most people really don't like trading bonds or notes. But this is going to be the most interesting one because it's flip-flopped a lot over the recent months, and there seems to be a great consensus. So if you think the Fed's going to hike, this actually may be offering a better opportunity than what you're seeing in the SR3 contracts.
Yeah, and I know you've shared these stats before, but once the probabilistic decision is made by the markets, the Fed almost never goes against that, which makes sense because their job is not to spook the markets and scare the markets into more volatility. They're trying to keep things at bay for sure. Yeah, Mike,
literally, I think it's now almost 30 years in the data. If you go back for the last 30 years of available market data, the morning of the Fed meeting, right, when U.S. markets open, if you were to check out your Fed funds tool, every single meeting where the market's priced in at least a 55% chance of something happening, a hike, a cut, a hold, the Fed has delivered in that direction 100% of the time. There have been 2 occasions where the market was pricing in like a 52 or 53% chance of an event occurring, and the Fed did not do it, right? So that's why I set my bar to 55%, because once you get to 55%, everything clears it. So we'll keep an eye on it right now, Mike. The Fed does not like to disappoint or scare the kids, especially in the post-global financial crisis era, like the handhold. Warsh may be different, so let's be open-minded here. He doesn't like forward guidance. Either way, though, I think the bond market here is, we have this really interesting pinning going on right now, where because of these Fed funds that have been able to come in a little bit, twos have backed off. But because of all the pressure that's going on in the oil market, you still have the long end of the curve, inching up. And today, bonds notes are recovering some, but those are still pretty ugly looking charts.
Yeah, kind of wild to see. And really, I was looking through the prediction tab tool and just looking through all of the different decisions, and they're all kind of priced at maintaining rate now, which is very different than what we were looking at just 3 months ago, 2 months ago. We had much more dynamic probabilities for those interest rates. So yeah, I think trading bonds, trading notes, whatever floats your boat here. But TLT down at annual lows, multi-year lows.
Annual lows, Mike, it's breaking its 2007 low right now. Throw that on a weekly chart. Like I have never seen TLT this low in my life ever since I engaged with markets. Like you're gonna keep going further back. I mean, it's literally the low that we have in 2000. So like this is just not something that we've seen. You then started getting into the lows they have, I think, like 2003, 2004.
Yeah. Yeah.
So I mean, I know Ilya has a view here that maybe this is significant long-term support. I don't agree. I don't think anyone is placed. I mean, personally, Mike, do you think that anyone's looking at a chart and saying, oh my God, TLT is at its lowest level in nearly 30 years? There's so much supply down here. No. What? There's no supply down here. What creates support or resistance is when there's a lot of positions being held up at that level, right? When dealers are trying to pin a strike, when there's a gamma, whatever. There's no one's holding a position from 2007 in TLT. in size here that's holding this market up. Those have all been cleared out years ago. So no, I'm still leaning short ZB. I'm long a put spread in ZB, Mike, right now. This chart looks terrible. You have the Fed keeping rates lower for longer while we have oil and inflation moving through the system. Historically, when the Fed is meaningfully or even just marginally less hawkish or more dovish than what the market perceives, like in fall of 2024, Fed gave up 50 basis points of cuts instead of 25, long end yields blow out. We're now not getting hikes when we want them. So policy is relatively looser, long end yields blowing out. So Mike, right now I'm still riding this. It only has a few days to go here. So I may need to roll this. I may need to kick it out a little bit right now. But sitting at the 11 days to expiration, the 108, 107 long put spread. I put this on last week. We're getting these bounces back into its 1 month moving average in ZB. Ever since the first week of July, it's like 2 steps down, 1 step back. So I used the bounce back last week as an opportunity after CPI to buy the put spread. And by the way, Mike, this is part of this lexicon of framework. You know, we talk about the Fed's not hiking, so long end yields go up. CPI came in on the screws and a bit softer. And so I was like, oh, Fed's not going to have to hike. I'm going to sell some bonds here. And now we're trading about 1.5 points lower than we were at the highs around CPI. So this is the dynamic to watch if you're trading bonds. The more the Fed pushes off hikes, the worse the long end is for the wear.
Yeah, I think this is a solid trade here, and it's, even though it's 11 days to go, plenty of time for this thing to work out. And I think
we've just been rolling it down. 112, 111, 111, 110, 110, 109. Now here, 108, 107. Keep milking it. It's a downtrend.
Yeah. And similar with TLT, like if you wanted to play for a continuation to the downside, or even if you're playing for a short-term bounce, like this is the environment to do it in. 10% implied volatility, extremely low in TLT. And that just means if you wanted to get into like a put zebra to the downside, this probably could be done for, 1 strike wide. You get rid of all extrinsic value. Buy 2 of the 83s, sell 1 of the 82s. You control 100 short shares for $200 for 32 days. Like these are insanely low prices here in TLT. You could do the same exact thing to the upside. Probably selling the 82, buying the 81. Similar story. Very little extrinsic value, $200 for delta. So this is really cheap delta. I love using zebras in TLT just because anytime you see near single digit or single digit implied volatility, it's just so low. Like it takes very little for you to have realized volatility that's greater than implied volatility when you have single digit implied vol.
Yeah, I mean, I'm excited for this open here, Mike. I had some things that were underwater recently that may be doing a little bit better here on the other side of this, in particular Western Digital. What a ride this has been. 4 days to expiration, the 500, 510 short put spread here. We closed on Friday directly at 510 after dipping. What was that low that we had in July here that was bringing me to the pits of hell? 407.48. And I'm not, I've already been assigned shares in SMH. We're still wheeling that out. This looks like a 526 open here, Mike. So the second this market opens and I see liquidity flowing into these options, I am getting out of this position. There's no reason to hold on to this with 4 days to expiration. It's worked against me long enough. I don't need to now be a hero and deal with all this gamma risk and stare down the barrel. But I'll find a new way to express this view, but I'm not doing it at 4 days now. I'm going to kick this out. I got to find the strike and the setup I want here. But we're going to do some trimming here. It's low volume in the market right now. We were supposed to go on an hour ago, Mike. We had some technical difficulties. The S&P was trading at 78.04 and a half. In the futures market is trading at 78.04 and a quarter right now on my screen. So let's just see where the volume is before we get too jumpy here. But yeah, 525 open in Western Digital. I see SK Hynix opening up at 172 here, Mike. Micron opening up at 1004. SanDisk 1712, Mike. This incredible run in recent days is just continuing here at the open. Stock's a little bit here on the upside, 78.07 now in the S&P 500.
Catching a bid here. I have a 0-day Super Bowl in SPX. That's likely going to expire worthless, 77.50, 78.85. Collected 35 cents for that. marking at a loss right now, but as long as we stay afloat here, we'll be good. And then, yeah, other than that, let's take a look at some P&L day. Is there any big numbers here? Nope. 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 Yeah, I mean, this is wild. There's nothing on my P&L day that's over $100.
Oh no, that's not me. I'm SMH. I mean, so look, I'm sitting. I got assigned 100 shares at 615, right? And
Mhm.
like this is back in July, and I'm thinking, I think it's like July 10th, 9th. I think it's July 9th. Like, okay, what's the worst that could happen? It's SMH. I'll hold this for a little bit. So it starts going down. I'm wheeling it out. This thing cratered. July 29th was down to 503.63. Not fun. But I've been holding it the entire time. I'm currently sitting short the 630 call with 32 days to expiration, which today it's under a good deal of pressure. And quite frankly, as me trying to milk this particular leg of the wheel, the P&L that's open right now is $17. I mean, like 17 cents, Mike. It's nothing. So it hasn't really done anything. But the position itself has bounced back. It went from being like a $10,000 loser to now I'm only about 2K out on the actual share position here. And as I've said, if anyone wants to take the shares from me at 630, or I'm more than willing to hand them over. But the way that this has been performing and the way that these memory stocks are behaving out of the gate here, I do have some confidence to let this thing run a little bit more. And even if it means that the 630 call gets tested or I have to flip that at a loss, it's not a gigantic loser anymore. It's something that I managed into being a much smaller loser, or even a scratch. So I'm watching the semis here with like a hawk right now. Western Digital needs to go. Semiconductors need to go ultimately, but that's where I'll leave it for now.
I like it. Yeah, I think, SMH eventually, I think we'll get back to highs, just like all these other products. Like there's just I don't see a reality where like 670 is the high in the semis, all things considered. But the beauty of your position, although you're taking some heat right now, is you have full malleability here with this short option. So even if you get tested at 630, or even if you get some more movement to the upside before, you could always buy back September, roll it to October, and I'm guarantee you could roll this up 20 points. Yeah. You could roll this up. You could roll this up to the 660 out in October for a credit. So you have plenty of upside. If you wanted to press on this even more, you could totally do something like that. But yeah, I like it.
I did have one thing that I did at the end of last week, just as kind of on a lark, where the market's been not really moving around. Maybe it continues to grind to the upside here. Vixpiration, monthly OPEX. Who knows how that's going to impact the flow? I was looking over at the triple Qs, Mike. So at 4 days to go, and again, complete lock. So August 21st expiration here. When I put this on Friday, the expected move was up to about 748. So I put on a call butterfly. The 744, 748, 752 call butterfly. That's not the expected move through the end of the week right now. You could do that here at the 743. Let's go 743. We'll do 743, 740, and 746. And that's narrow, right? We're not exactly playing hero ball here, but 23-cent debit right now, 3-point wide call. So maybe we should do some things like that. If it's going to be really low vol, I know you don't get paid a lot to do something like a call butterfly at the expected move when it's a super low vol, because the distribution of outcomes are much more narrow. Nevertheless, I don't know if the vol selling is the right thing to do here out of the gate. That's not sure how I think we should be approaching this market.
Yeah, I think these are the trades that you can utilize in these really grindy markets, especially when you have a 25-cent risk to make 10 times the amount of that. And even the Theo P&L, since it's only 4 days to go, the closer you get to Friday, and if that is paired with a nice little drift higher, you can take out $100 out of this thing pretty easily. But yeah, I think that is a sharp call with the really low volatility, but some upside propensity here in the Qs. And even when you look at the NASDAQ 100 watch list, it's very clear that the semis are driving this rally in the NASDAQ. Marvel, SanDisk, WDC, Micron, AMAT, Apple Oven, and then the downside is the complete opposite. You've got Workday, Meta, Qualcomm, Paychecks, Tesla, Datadog, Microsoft. So it's just like we're back to the semis up, softs down situation, at least today.
Yeah, no, you can definitely see some of that in the read through right now. Yeah, I have my screen up here right now. Top performers in the day so far: Marvel, SanDisk, Micron, SK Hynix, Applied Materials, Seagate, KLA Core. Those are your top 7. And then on the bottom side, the worst: Dell, Meta, Home Depot, Tesla, Microsoft. Mike, the reemergence of the AI infrastructure trade. We got rid of Leopold Aschenbrenner, right? Situational awareness crapped out. All the South Korean traders, they all went bankrupt. Leverage is gone. Rally can continue, as I've been saying for weeks.
It is wild. That whole scenario was crazy.
But we've seen this before. Like, this is not just me being jocular because we're doing this, for entertainment value. Look at the major players who have gone bust in the market and look at what they were trading when they went under. And then look at where those prices performed after those firms went bust. And the prominent one recently for folks that have been trading for a few years, Sam Bankman-Fried's FTX goes down in November 2022, Mike, and Bitcoin bottoms that day. And there are numerous examples throughout history of this. So when do we find out about Leo? Day after the Fed meeting?
Mm-hmm.
Come on.
Mm-hmm.
Come on. It's been a straight line up since then.
Yeah, we were talking about The Psychology of Money book that I read recently. And when I say recently, I mean like 5 years ago. But it's the same thing. It's like it basically highlights a bunch of fund managers that blew up because they just took too much leverage, and that's the story that we will continue to hear into perpetuity. It's never going to stop unfortunately that's kind of the interesting scenario, right? Everyone's trying to get that little bit of edge, and that little bit of edge greater than market returns or whatever. But the way that a lot of people do it is by taking more leverage than they should, and that can and typically does result in getting smacked around a little bit. But that's why we talk about these position sizing as being so important. Like, the market can do whatever it wants, and the MES and MNQ position, like, yeah, if we got a massive sell-off, it would be not great, but I can hold it. I can hold these positions through any kind of turbulence. And that is the key, to be able to hold through, not get stopped out with buying power increases or intrinsic value losses because you traded too small or you traded too big. And if you're only allowing yourself to absorb a 5% move or a 10% move against you, that's just simply too little of a move. Those happen all the time.
All the time.
Especially even even as a NASDAQ, like you can't visualize a situation where we're down 1,000 points in the NASDAQ and 200 points in the E-minis, but it's going to happen eventually at some point. So you got to
happen last month.
Yeah. And the month before, like this year has been really volatile, even though we are near highs and, we're just chugging along. But you got to always account for that.
Well, my 2 books that I found that are, they're not directly related to options trading, but they're good ways to conceptualize how people take risk. Peter Bernstein's Against the Gods, which is one of my all-time favorite reads, about how humanity has understood and developed the concept of statistics and probability. And then I started rereading this, Niall Ferguson's The Ascent of Money, which is about the history of how humans, again, take risk and have developed the industry of finance through math. So, if you're an options trader, you always read like I have the New York Institute of Finance book here on my bookshelf behind me. You don't need to always read stuff like that. Read things that are tangential to probability theory, and you'll conceptualize what you're doing in this market better, which, Mike, that brings me to one of our long-standing ideas around here. When you sell premium, you take stuff off once you get to a 50% profit target. I decided to hold a J&J position through the weekend because I figure just, we'll take a few more days off the board and I can probably get this off for more than 50%. I saw my short put spread here at the 247.5, 250, trading for 29 cents on Friday. It's now at 17 cents here at the open. And we took that in for a very minor 58 cents of credit, right? 58 cents of credit on a $2.50 wide strike is a little bit low for what we usually aim for around here. In that neighborhood, we'd be going for what, like closer to 83 cents. But I like the trade setup, so I took it, and now we're getting rid of it at 17. So in for 58, out for 17, a little bit more than 50% max profit. Happy to do that. Clear the book, getting rid of some things that are in that 4 DTE range right now, if they're in the money. And if they're at max loss, I'm just going to let them run maybe another day or two, see if we can get a bounce back. Otherwise, I don't want to deal with assignment risk. So I will be getting those off at some losses, perhaps.
Yeah. I mean, yeah, really low implied move going forward, trading at 260 right now. But yeah, I think there's always going to be opportunities out there, and there's reasons to kind of press on certain scenarios when you're significantly out of the money. How is my P&L day $500? I don't understand. I guess these two positions are the reason. This Rocket Lab position, long call diagonal spread, long the 80 September, short the 4-day 90. I'm going to hold on to this one because normally I would just close this, bought it for 750. It's up 150 bucks right now. But when you look at this short option expiring on Friday, there's $150. Like, this is a scratch right now, $150 to decay through Friday, into a $4 rally today. And if we continue higher up to 90, this will be, I'll get all the $140 in the extrinsic value of the short. I'll gain much more intrinsic value in the long. As you can see, I'm up $200 today. This could be a $500 winner by Friday. So if this short option was more decayed and it was basically worthless, I would just close it because you're really just leaning on your profitability in the long option. But because this still has some value here to decay over the next 4 days, I'm gonna press on this one. And then USO, I feel similar. Long in the 120, short the 135, call diagonal spread. I put this on when oil was kind of flattening out in terms of the contango and backwardation in the market. And now I put this 15-point wide diagonal spread on for $5. We're trading right in the middle of it right now. And the more we get closer to the short option, if that is paired with a rally or just sustaining these levels, we will continue to see profitability there. And I want to lean kind of long in this space because we are seeing crude oil bounce around here near the low 80s, but the price is kind of in the middle of the range. It has recovered from the recent sell-off. And if you look at the curve of the crude oil futures, you can still see we're backwardated a little bit. I don't think this is going to go into contango anytime soon. So that just helps USO stay propped up at the very least.
I'm with you. You know, for the average, I don't want to say the average bear because that's not like a bull bear thing, but I mean the average person, Mike. USO may be a better way than doing this than try to time the swings in the oil futures market. It's been difficult, right? There have been long drawdowns. There's also been trades where I've taken them. I was on a 97, 98 long put spread when oil started breaking down a few weeks back. I'm like, oh, you know what? It's a little bit in the money. I'll just ride this out. I think I made $22 on that. Oil hasn't touched 94, 97 since, yes, that's the point though. The directional neutral stuff is working. Timing the swings is more difficult. USO, it's just that simple. It's the roll yield. If you're not a futures trader, you make money, and you can break down how you make money in your futures product and how the prices differ from expiration. But I suppose it's the start of the week, Mike. So one last diatribe about this. When you are in a fund like USO and the curve is in the steep backwardation, it means that they sell the higher price contract and then they buy the lower price when they capture the difference. That's positive roll yield. And oil's been stuck in that market for a while, which is why USO is holding up and looks fantastic right now.
100%. And that's really the only reason why you saw this thing go from the mid 70s to and then spike up to 150. It was that steep backwardation in the crude futures. And I think if you're looking for a reason to hold USO or place a bet that USO is going to go higher, or at least maintain, I like this back here where this last week we saw Feb, March, April, May. These were in the 60s. And now they're in the mid 70s. So we're seeing the tail end of the curve lift pretty dramatically, which tells me that long term, we're going to continue to see some turbulence in these crude markets. But yeah, Chris, it's been a blast so far. We still got some time together, but we're going to kick it over to TP right now. Join us on the YouTube chat. We'll cover your questions, trade ideas in just a little bit. We're going to take a quick 90-second break. You're watching Tasty Live.
Preston, the disembodied voice here, and we're just having a few connections problem on the network side, and they're working on that. So it's just going to you'll just see my platform, and I'm going to talk through some of the stuff I'm looking at today. So one of the big, what you're seeing now is my trades on the follow page. Let's see if it went through, and I want to explain what I did. So I bought 100 shares of Tesla. I did not do that just as a speculative trade on Tesla. The reason I did it was on Friday, on my 1 o'clock live trading show, I bought a 0 DTE put butterfly, what was it, 37 half, 337 half, 340, 342 half put butterfly, for 80 cents. The 342 and a half put was in the money. And because I was busy trading other things, I never actually closed. I never just sold it. I just went through assignment on it or exercise on it. And so anyway, got delivered short 100 shares of Tesla, and it's kind of okay. I was aware of it and saw it trading a little bit lower. I thought, okay, I'll just basically scratch the trade if I can buy it anywhere under 341.50 or something like that. And it turns out Tesla just crapped out a few minutes ago. Now it's bounced back, but Tesla, let's just look at a chart here. If I can get it running properly, let's go to the 1 minute chart. And so this is what happened to Tesla on the open. They just crushed it, and I was able to buy it back for 338.10. I think was my fill price. And again, this is no genius of mine. I'm not taking personal credit for buying back short stock when the stock is down. It's just sometimes the distribution of returns works in your favor. And in this case, the sell-off in Tesla worked in my favor. I bought it back here. The stock's rallying back up. Who knows? It may go back to the well in Tesla this afternoon for the 1 o'clock show. I don't know. Haven't decided yet. But what I want, folks, a couple of things are going on in bonds. Bonds are down 3 ticks right now. Notes are down half a tick. I wouldn't. The price changes are too small, really, to compare each other. Those are pretty kind of
should be
very modest moves. But I am long-term bearish on bonds.
Yes, correct.
I think what happened on Friday was the tepid demand for the 30-year bonds from the 30-year treasuries in the auction. That's the competition from all these AI companies issuing bonds and their higher yields is pulling money away from the treasuries, I think. And so kind of one of the disconnects too is the stock market hitting an all-time high with yields moving higher and pushing bonds lower. But I just think as we go into the fall, as we're dealing with some political issues here, I just think it's going to be hard for yields to go back down. And so I'm just selling rallies on bonds and notes. I'm already short call spreads and notes. So I'm not going to add to the notes, but I might buy a put spread in bonds. Volatility is relatively low still in bonds. What else am I looking at today? Gold, let's look at GC. Let's look at the futures for a second. So gold has been ticking up. And again, this is related to the whole bond thing. You say, well, gee whiz, if yields are going up, why does that make gold attractive? I think what you're going to see, perhaps, and this is, talking a little bit about what the Treasury did with the dollar versus yen intervention last week, selling yen, buying euros. But again, pressuring the dollar. And so that I think if the dollar continues to get weaker, and I'm short British pound here, I'm short yen, I'm short the euro here. However, longer term, I am maybe bearish on the dollar, not super bearish, but bearish on the dollar, and I think that could help prop up gold if there is not so much a flight to quality, but just as a preserver of value. I think that's so. I'm already short a put spread in GLD, but that's something that again, if I can see where it's trading now. What do I have? Let's go into GLD and see my short put spread. I have a short spread with 4 days to go. I might be making some money on this trade. I'll have to check the prices. But again, I would reestablish. I'd go out maybe to the September expiration, roll out to another put spread there. But bullish on gold. What else? I want to check the VIX. The VIX is just been brutal to me. I have 1 day to go on my short 16-17 put spread. The future's trading at about 15.5 right now. I need a massive sell-off in the S&Ps that's going to drive the VIX up at least 2 points. Let's say 2.5 points would be nice. Probably won't get it. But again, volatility is so low here. If we look at a chart on the VIX, I'm going to just be reestablishing some long VIX exposure, just kind of naturally. It's not a lot of, again, selling a put spread in the VIX in VIX options really doesn't have too much risk for me. And it's just, I'm just gonna have that long-term position on waiting for, maybe expressed in shorter term expirations, but just a consistent long delta VIX position. Going into crude oil, I'm short an iron condor in here. Crude's again going nowhere. And I'm short, where are my puts? Yeah, I'm going to cover these. I'm going to cover the, well, I'll buy these puts back, and I'm going to look and see if I can get the, I'm going to check my P&L on this trade. Let's clear this out. I'm going to check the P&L on this, see if I can take it off for a little bit better than 50% profit. I believe I can, depending on where I sold it. Let's see, the other trades that I'm looking at, NVIDIA. NVIDIA's up nicely. I'm short, I'm long a call spread in there. That should be making a little bit of money right now. I'm long the 222 half calls, short the 227 and a half calls going out in 7 days. And again, earnings are coming out on August 26th. That's pretty much the, I haven't checked the earnings calendar today, but I believe NVIDIA is going to be the next big one. Most companies have already reported. The S&Ps, SPOOs are down $9, are going nowhere. Before I get off this, let's do that iron condor. Let's do these, do this one. So what I do for this iron condor, the 0 DTE SPX iron condor, is I look for approximately a $2 put and a $2 call to sell. I then go 25 points further out of the money and buy the wings of the iron condor. So I'm looking at on the put side, the 7750s, 7725s, and here on the call side, the 7795s and the 7820s. And I don't know if you're sharp-eyed enough, but these puts, the 7750s, just came down in value about 5 cents as we were watching this. I'm going to ship this off at 290. Let's see if we can get it at 290. It might not be. So that's what I'm working today. And what I'll do is if I get filled on this, and this is my style of trading the 0 DTEs, I will, if I get filled on this at 290, I'm going to put a bid in to buy it back for $1.45. That's it. And I'm just going to let it ride or let it sit there, let that bid sit there. If I get filled, great. If not, I'm not going to manage it necessarily, but that's how I do these 0 DTE options. Let's just take a quick look at the dollar, or specifically the yen. 6J up a little bit. That's hurting me. 6E, the euro, again, they're killing me on these things. And the 6B, I'm short some call spreads in all these things. And that's just a short-term bet. And the pound specifically is a hedge I have on. And I don't like hedges, but that's what's going on. All right. So we have Chris and Mike coming back at 9 o'clock. We have some great guests coming up on today's show, and I will be back at 1 p.m. Central Time for a half an hour of live trading. Again, this is Tasty Live, the only place where you can see us actually trade live. There's no, oh yeah, I did this trade, did that trade. We actually do this stuff. And that's what makes us distinct from everybody else. So stay tuned and let's keep an eye on this market and see if I get filled in my SPX. Nothing done yet. All right, with that, I will hand it back to Control and I will see you guys. I will be back with Chris at 10 a.m. for Confirm and Send.
Si tú eres una bici, yo te voy a dar pedales. Pero con cuidado que no estoy en comprar pañales. Yo quisiera que me dé un piquito. Dale de comerte huerfanito. No me dejen visto. Por eso te quiero desacatar. Dale pa' acá, dale pa' acá. Estoy seguro que te va a gustar. Dale pa' acá, dale pa' acá. Yo estoy seguro que te va a encantar. Dale pa' acá, dale pa' acá. Estoy seguro que te va a gustar. Dale pa' acá, dale pa' acá. Yo estoy seguro que te va a encantar. Ahí, ma, tú eres una malvada. Dale que eso no es nada. Tú y yo vamos a quiquear. Ahí, ma, tú eres una malvada. Dale que eso no es nada. Tú y yo vamos a quiquear. Te estoy esperando en la fila. Yo que tengo tanta paciencia. Contigo quiero una indecencia. Por eso te quiero desacatar. Te estoy esperando en la fila. Yo que tengo tanta paciencia. Contigo quiero una indecencia. Por eso te quiero desacatar. Dale pa' acá, dale pa' acá. Estoy seguro que te va a gustar. Dale pa' acá, dale pa' acá. Yo estoy seguro que te va a encantar. Dale pa' acá, dale pa' acá. Estoy seguro que te va a gustar. Dale pa' acá, dale pa' acá. Yo estoy seguro que te va a encantar. Ahí, ma, tú eres una malvada. Dale que eso no es nada. Tú y yo vamos a quiquear. Ahí, ma, tú eres una malvada. Dale que eso no es nada. Tú y yo vamos a quiquear.
What's up, everyone? We are back. E-minis down 11, NASDAQ up 68, but not too much going on here. We do have some earnings coming out this week, but we've got a very special guest on the line. We've got E live from the SIBO floor, and he is the NASDAQ whisperer. I'm very intrigued to hear what he has to say. Chris, why don't we bring on E and see what the deal is over there on the SIBO floor? It sounds pretty buzzing, pretty vibrant.
Let's do it.
Yeah, it's I would say it's a little mild right now, but just less than 5 minutes ago, it was pretty rowdy in here, and as I say that, it's starting to pick up again. So definitely a lot of range-bound volatility that we've seen so far here on NASDAQ, but I got to give the floor maybe a 5 out of 10 right now.
That's fair. Yeah, we got the NASDAQ 1 minute chart pulled up here, and they haven't left this 100-point range all morning, which is kind of wild, all things considered, but that's kind of just what we're dealing with here in these markets. Do you have any specific levels you're looking at? I know you like to trade this intraday with the micro NASDAQ futures.
Yeah, I mean, right now I'm short at 30,242, and I mean, if we make new highs on the day, I'm going to exit those positions. But because I know we're getting this range-bound market right now, but I would love to see a little bit more follow through to the downside, just for the sake of these scalps right now. But I mean, we're pretty range-bound right now, so it's kind of one of those times where you kind of just got to sit on your hands and wait for the market to give you, some new information. Because starting out on an inside day, it's really easy to get cut or get stopped up in the chop, I guess you could say. But just looking at NASDAQ at the moment.
For sure. We did see a little bit of a rotation this morning back into the semis and out of the software products. You're seeing that kind of perpetuate throughout the day. If you look at the NASDAQ 100, SanDisk, WDC, Marvel, SpaceX, love to see that up 777. But yeah, Micron, AMAT.
That one came from the grave for me, Mike. That one was like a max loser within 48 hours of putting that on. And now I think I'm going to be exiting this for a profit. I guess being able to sell an out-of-money put spread with a little bit of cushion and taking advantage of time definitely worked out in this case, because I was catching a falling knife for quite a bit of time there, Mike.
Yeah, Mike, I'm getting ready to take off the call spread side of my double bowl Super Bowl trade here in SpaceX. We put this on right around their earnings, and their hold on period unlocking, right? The hold up period came, and then the market really didn't go down. It had 25% short interest at the time, so the double bowl was put in place. Still have the 135, 140 call on, but even with this move today, it's not really doing much. I could take it off for $3.10 a credit right now. The max profit is about $4.30 a credit if I held it to expiration. So I'm getting there. I'm just about there to do it. But the one that I want to just harp on with Errol there, you mentioned the NASDAQ. We put on an M&Q trade recently. Just a little quick guy down at the 28,750, 2,900. It cost us $58.25 in credit. Today it's now trading in at 23.25 with 14 days to go for expiration. So it's now below 21 DTE, and it's now more than 50% profit, right? It's a short premium trade. Taking this off, there's no reason to hold it anymore.
I love it. What kind of trade was that again there, Chris, on the indices?
Just the short put spread, right? I mean, these pullbacks into some of these key levels, swing levels that we've had on the charts, where the markets had previous highs before or previous lows, taking some shots around there. This time it happened to work out. But again, the mechanics dictate. It doesn't matter how much time's left on the board. Once we get past 50% profit, on a short premium trade, you just move on to the next one. So we will move on to the next one here.
No, I love that. It's 50%. Might as well take that. Not succumb to our emotions. Just take that off the table. It's a nice trade.
There we go.
Yeah, lots of movement in NASDAQ for sure here. And yeah, this SpaceX position, the one that I have is super long-term, short the 125 put to buy the 300 strike call in the 522-day cycle. Yes, you heard that right, 522 days. But I just wanted I have an assumption that SpaceX, if it rips higher and it continues up from 150 up to 200, you're going to see implied volatility expand in here. And you're probably going to see call skew get infused even more than it already is. That's going to benefit that long call by itself. The short put will still lose value as we make that move. So we're seeing this position come back quite nicely. But again, if we get a move up to 200 or 225 in short order, this will be a $3,000-$4,000 winner just because of the dynamic nature of these strategies.
What was that? What was that? A diagonal you had there, Mike, or what was it again?
No, it was a Super Bowl. So I bought the call bought the call and sold the put at the same time, but the put was trading for $345 more than the call that I bought. So
Okay.
I have a net credit in the middle between 125 and 300, but any continued rally here just makes that call appreciate significantly as we lose value in the put.
Yeah. And you sold, was that the same cycle?
Yes. Yep.
Okay.
Same cycle.
Okay. Cool.
Yeah. So it looks very similar to a standard, risk reversal type trade where you're selling the put to buy the call, but $350 in the middle. But if we get a rally up here, you can see my P&L Theo. If we go up to 220, 230 in the next couple of days here, which would be a huge rally, but regardless, this is such a long-term cycle. If you get this directional move, this will be a couple $1,000 winner. We can close it or hold it. We'll see what happens then. You could also turn this into a call spread. That's always interesting. If you get a rally, I could sell a call above my long call that I own already and reduce basis even more. So we'll see.
No, love it.
But yeah, I agree with you. I think we're seeing some chop, some range bound action in the NASDAQ. I think it's largely because you have the polar opposite moves happening yet again. SanDisk, WDC, AMAT, Micron leading the way, all up 5% or more. And then you go to the downside, you've got Adobe, Workday, Microsoft. So it's just a tale of two swords here.
Yeah, speaking of that, it's such a strong tape for semis right now. Have you noticed what's not gaining ground?
What's that?
Qualcomm. Qualcomm looks like an absolute dog here, down a percent right now. Mike, we do that little technical scan, or at least I do that technical scanner right here. I use we too much when I describe something that I'm doing. But if you are with me, then it's technically a we situation. So
Chris, we're with you at all times. We're always with you.
So today we had a brief bump. Friday and today we had this brief bump where this is a stock that's below its 200-day, below its 50-day, and below its 20-day. And then just on Friday and then earlier today, it squeaked above its 20-day. So it's in that threshold where it's like a sell the rip opportunity. Why on earth is Qualcomm not ripping like the rest of the semi structure here? So, volatility is really low right now. If something is going to fall hard, if this market turns lower on the other side of expiration OPEX, I want to look for the things that are not taking advantage of a strong tape on a sector by sector basis today. So QCOM to me is, I'm looking for some short deltas right now to help balance the boat. I just got filled up, by the way, at a new Western Digital position, WDC. I had to go out a little bit more than I'd like to, but I took 260 in credit on a 60 days to expiration, 440, 430 short put spread there. I really like the structure of the chart right now. So those are going to be reflected on the follow page momentarily.
Love it. Yeah, 440, 430, significantly lower than we are now and kind of right at that bottoming that we saw. Your risk at 430 if it goes fully in the money, like we've only gone below that a couple of times and it never lasted intraday. We got the rally intraday from that level. So I like it. Well, we will let you go. I know you're coming back in a little bit for some more content, but appreciate you as always.
Appreciate you guys. We'll see you in a little bit.
Sounds good. Yeah, NASDAQ chopping around here, up 70. E-minis down 7. Some single name stocks got our eye on for sure. That SpaceX rally, love to see it. It's perpetuating and building on itself, up $9 now. And I think, to your point, Chris, I think it's like it might be a time to consider closing some of these other positions. So this Amazon trade, this was an insane trade, pretty wonky, but we are now net profitable, and I think it's time to close it. I don't feel like I need to hold this one, especially because this was an immediate loser that we turned into a winner. And here's me saying we, but it was really just
Yes.
me here. But no,
I had a Super Bowl. I had a Super Bowl on Amazon as well, and I monetized the short put spread side of it because it was down to like 97% max profit. Like there's no reason to hold on to that no matter how much time's on the board.
Yeah.
I did hold on to the long call spread side, which I'm now having regret over because it was a 285, 290 long call spread. And there was a point right after that big pop where I could have flipped it off for about $3.20. And now it is an 83 cents loser. So Amazon, feel free to do something here between now and Friday.
Yeah, let's see if I can get filled here. I might have to give up a little bit of premium. This is the problem with some of these wider markets. There you go, $1.60. Okay, so this was a wild trade. It was one of those trades where I had the direction right, I had a call crab trade. I bought the 240 September call, sold the 255, 270 crab components. So it was a 15-point wide crab trade, long September, short the 1 day. Amazon gapped well above my long call. So it was completely in the money and it was showing a loss. So instead of taking the loss, I was like, well, I could always just roll this now 0-day 15-point wide crab component out to August and widen it by keeping the same short strike, 255, but I moved my long call from 270 to 275. So I took on an extra $500 of risk to the upside, but I collected $1.70 to offset a decent chunk of that. So I went from a $9 debit, 15-point wide crab, long September, short the 1 day, to a $7 and change net debit and widened it from the 240, 255, 270 to the 240, 255, 275 out in August. Basically just forcing the extension of the trade for credit, playing for a downside move back into the range. And we finally got it last week. And then today we got a big vol crush over the weekend with this kind of non-movement into the Monday open. There's only a couple $100 left of premium to take out of the weekly cycle, but again, this was a losing earnings trade that came back to a winner net. So happy to get out of that for a $1.60 net profit into that sell off there. But that's just an example of how you can manipulate some of these definders trades if you're willing to take on some more risk. So yeah, love to see it.
Mike, this is going to be my trade of the day today, and I'll do more of an in-depth explanation later, but I think I've identified what we should be doing here in a Qualcomm, at least what I'm going to be doing here in Qualcomm. I'm going to go out to 60 days to expiration. Do you mind just pulling up the chart real quick before we go into the actual options chain? And could you do some little chart manipulation here? Would you take a horizontal line and place it just directly at like 190 a share? Yeah. 190 seems to be an area where the market has been treating as a little bit of a support and then resistance right now. You don't need to do this, but I have the 50-day moving average on my screen, and that's going to come up closer towards 175. And the 1 month moving average right now is 166. Again, Qualcomm semiconductor name that's weak in a very strong tape here and has not recovered the way a SanDisk, a Micron, so many others have. And I outsource a lot of my research here, Mike. I'm going to admit it. I find people who are subject matter experts in particular fields, and I look into what they're saying. And if I understand their framework and how they're approaching the world, I take them at face value because I don't know as much as they do about some things. There's this guy, Tay Kim, who has been talking trash about Qualcomm basically since April, and how if you're going to be short any of the semiconductors, this is the name to do it. I haven't placed any trades on that basis yet, but just to watch its share prices underperform here in August, the way that everything else has just exploded higher, it does bring me back to the research that he wrote maybe 5 or 6 months ago. So to that point, this is a super bear candidate in my view. We should be looking short here. We shouldn't be doing just selling a call spread or buying a put spread here. We should be double bearing this guy. And so I'm going to take that risk. I'm going out to 60 days here. It's depending upon the pricing that you're getting, you're going to get a little bit of a credit or a debit. But the 185, 190 short call spread, 140, 135 long put spread. It's 8 cents a credit right now. But it's basically risking one to make one on a 76% probability prop. I mean, I like this. So I'm pushing this through. Hopefully I can get filled. Yeah, a non-bullish trade in semiconductors. How dare we?
Yeah, I like it. And I think it's one of those trades, like if you sold this call spread by itself, you pick up 60 cents for a 5-point wide call spread. So not too much premium, but just because your ability to give up that credit, still route it for a net credit in the middle so you don't lose anything if everything expires worthless, but you're ultimately just shifting where your profit potential is. So if you get a 10-point sell-off, you're at your net credit received, like max profit. If you just sold the call spread, you'd make 70, 80 bucks. If you get another 10 points, now you're tripling that value. P&L Theo is 180 bucks. And
Yes.
if you get that downside move closer to 140, 135, now you're going to be trading for about half the width with plenty of time left. So this neutral 7-cent credit turns into a $250 winner, which is, again, multiples of just selling the call spread, which is why we like these trade setups so much, is you give yourself that, if I'm directionally right in a big way, I'm going to add a ton of winners under my belt relative to just selling that premium.
Right. So I think there's many ways to crack this market. I think that we should be taking advantage of the fact that there's a little bit of lower volatility. And if there are some names, and this is really like where I'm hunting right now, if there are some names out here in the spaces that have been leadership and they have not been able to do well, and we are now going into a window in this market where, just historically speaking, like I'm going to send you a link to the equity clock chart of the VIX, and you could look at what happens August 15th onward historically for the past 20 years. I don't feel comfortable selling vol down at these levels. So where are some places where maybe we can get some short delta exposure, which would actually help counterbalance so much of the long deltas that are on elsewhere? I mean, at least the way that I've been trading, it's been a lot of long deltas across the board. So putting in something like a Qualcomm actually helps balance the boat a little bit for me.
Yeah, I like it. And anytime you can throw in some of these downside trades, like I have a similar downside hedge in NDX here, just to play for, if things really fall out of bed 11 days to go, this can be a couple $1,000 winner. And that'll hedge a lot of these other positionings that I have. Microsoft here getting a big sell-off, down 11 points. So on the other side of the coin, if you're looking for bullish trades to kind of play for a flip of what we're seeing now with the semis going up and the softs going down, you could look at bullish positions in something like Microsoft too. But plenty of opportunity out there, even though we're seeing this choppy day. NASDAQ is selling off quite a bit here. But what do you say we take a quick break here and bring on Tim Knight on the other side of it?
I think that's a great idea.
Cool. Join us on the YouTube chat. If you haven't already, we'll get to your questions and trade ideas throughout the rest of the morning show here. But we're going to take a quick 90-second break. You're watching Tasty Live.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80-plus Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
It's time to trade smart, post PDT rule elimination. And Tasty Trade has the tools traders need. The Active Trader tab's comprehensive market data is designed for rapid order placement in a single click, while bracket orders let traders set entry, profit target, and stop loss all in one ticket. From the Positions tab, you can monitor positions, roll trades, close positions, and create conditional orders. Now, traders of all account sizes have more flexibility than ever before to engage in the market. Smart tools for smart traders. Tasty.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
What's up, everyone? Welcome back to the show. My name is Mike. I'm here with Mr. Tim Knight. Tim, how you doing this fine morning?
I'm doing okay. Happy New Week to you.
Happy New Week to you as well. You see SpaceX up $10 right now. It's crazy.
Yeah, I did. In fact, I've just used that as a segue. We'll just jump right into that. I wanted to talk about that anyway. Yeah, yay, SpaceX. Couple of cool things going on here. One, we're again conking our heads against the top of this range. SpaceX is such a young history. There's not much to review. Basically, at our 3-day pop, a multi-week slide in which everyone just sort of shook their heads, and then finally, as the kind of two ostensibly bearish events were looming, the first earnings call and the first unlock of shares is like, well, God help them. And paradoxically, as the markets like to do, that was the bottom. And so we bottomed here around 104, had a really strong push higher, and stopped short at appropriately what was the base back here and now is the top. And so clearly what SpaceX needs to do somehow or another is leap to the other side of that and alter that line from its role of resistance to support. It hasn't happened yet, but it's SpaceX has definitely had a good showing the past 8 days or so, considering what a wreck it was post IPO.
Yeah, I think this is a classic example of crowd narrative, and everyone's bearish, and then you get the pop, and now everyone's like, well, what's going on here? It doesn't make any sense. But long-term positioning, I know you and I are both pretty bullish on this, and this is a similar scenario that happened with Meta. Meta is always the good example to go back to. Like, they had a really bad beginning in their IPO, but now their stock price is significantly higher. So
yeah, it's kind of an accelerated version of Meta, formerly known as Facebook at the time. And as I've said, the video I did pre-IPO on SpaceX pointed to that as the only example I could find with the kind of cultural characteristics that SpaceX had. And in Facebook's case, same deal. They had a fantastic launch, and then instead of sliding for weeks, they slide for many, many months. I think negative 61% from top to bottom, and then that was the beginning of a permanent bull market for Meta. So yeah, I'm with you on this. 10 years from now, how will it be doing? I imagine 10 years from now it'll be fantastic. In the meantime, is it going to get above that line or not? Search me. I kind of doubt it, because you really need a catalyst. That catalyst could be in the form of like the next quarter's earnings, or some or a terrific Anthropic IPO, something like that, because SpaceX is also an AI company. But I'm impressed.
Yeah, nice rally here, and we'll see if we can keep going.
And speaking of earnings, we're in a kind of the desert of earnings season right now. But next Wednesday will be here before we know it, and the belle of the ball is going to be NVIDIA. For whatever crazy reason, they sort of have a weird earnings cycle. But after the close on Wednesday, they'll announce. And of course, the thing with NVIDIA, there's no doubt that thanks to the nature of the economy we're in right now, they're just printing money. Fantastic revenues, fantastic profit growth. But the requirement for what their valuation needs to justify is a jaw-dropping continuation of this kind of success. And of course, persistent doubts about circular financing. So it's going to, this is range bound, just as the market had been for many months this summer. I have no position in NVIDIA and no particular disposition toward it either. It's just a grind fest at this point, but boy, is it going to be important to the market psyche in about 7 days.
Yeah, I think right now it feels a little light in terms of the implied move for earnings, sitting at about 13, 14 points on this $225 price point. But I think as we get closer to next Wednesday, we'll get a clearer picture of what this market wants to do. Or maybe not. Maybe we'll just chop until NVIDIA earnings. That's also certainly possible with the low SPX implied range for the rest of the week. But yeah, I'll definitely be trading this, but I don't have a position on right now. I think this is one where, given the choppy kind of non-movement in the overall market, I want to wait until the earnings day to place something here. But even if that means we don't have much more clarity than we do now.
Yeah, could well be. I mean, if you look at something broader like SMH, of course, NVIDIA is the biggest component of that. We are right at the trend line. The lifetime high for the, I mean, strangely, because we still see a lot of strength in semiconductors, but it's kind of a recency bias because the past 2 or 3 weeks have been so strong. But the actual high was way back in June. And we have been sort of descending in the series of lower lows and lower highs, the latest of which is like right this second. So it could crack this, but at the moment, this is still in a broadening downtrend, if that doesn't sound like a contradiction.
Yeah, lower lows and lower highs, definitely interesting in SMH. Even with today's strength, with a lot of these sector companies just ripping higher and leading the Nasdaq. Really, the only reason the Nasdaq's still green right now is because of these semis.
Yeah, no, it must be, because I heard you mention Microsoft, which is not of aid right now. MSFT down 2.5%, off $12.50 about. And this was, I was pointing this one out about a week ago because it had been such a terrible laggard. It had been kind of really out in the doghouse relative to its tech compatriots. And it had this tremendous rally, including, and I suppose this must have been earnings day right here, this tremendous gap. And so in short order, this thing tacked on, nearly $200 over the span of a couple of months. But more recently, we had this little shooting star that, in retrospect, we can see was the terminus of this post-earnings euphoria, and this is starting to slip lower. Nothing dramatic. I mean, this is, it's like the thing about we're trading at prices not seen since last week, but it is a bit of an outlier because we are green on the NQ. There's a lot of strength in tech today, but Microsoft has, at the very minimum, is digesting those monstrous gains from the past month.
Yeah, this has been my best ticker symbol this year, just because I was buying those dips every time they happened. When we got sub 400, I was putting on bullish positions and was fortunate to catch a lot of these moves. But from a bearish perspective, that gap from 380 all the way up to 500, if we end up reversing through that, it could be a swift move considering the lack of resistance there through those channels that you're pointing out here. So yeah, I think this could be an interesting one to keep an eye on, especially with the huge volume or the huge move we've seen through that range.
Yeah, no, I just slapped on a couple of quick horizontal rays there, and yeah, there's the kind of the easy target, so to speak, is here, and then if things get really ugly in the weeks ahead, we could get as low as that gap fill down there. Let's see, maybe one or two before while we're still kind of on the tech hyperscaling theme, one item I pointed out on Friday's afternoon show was Owl Capital. This is a big financier behind the hyperscalers, and they had also had a big run. They were down deep into the single digits. They ran from about 8 to about 12.5. But as of Friday, I thought there might be an interesting bearish setup based upon this rather dramatic and gargantuan pattern above it. And so far, so good on this. This is not dramatic. It's down about 1.4%, but it has turned away. You can see kind of the base of all that overhead supply starting to turn away from that. So if for any hyperscaler bears out there, there are different sectors in that. There's the semiconductors and the storage and the places like Meta and Oracle, the giant companies which are now deep into that realm, and then the likes of Blue Owl.
Yeah, it's always interesting to find these ones that we don't talk about all too often, but we have the realized volatility that kind of speaks for itself and another trade opportunity for sure. And
let's just wrap up with one last one. Trying to debate between these two. Why don't we go with the NQ's a little more interesting. We're not at lifetime highs on this. Those highs were established also back in June. And as with the SMH, and this is no coincidence because it's obviously a big influence on it, we're nearing a trend line on this. With SMH, it's kind of like it's now or never. I mean, it's right at the trend line. Got a little more wiggle room with the NQ. Also, as you noted, we are seeing a bit of weakness there. So at the moment, it is still green, but we've burned off a goodly chunk of the strength we saw earlier this morning. So a bit of a shooting star on that one. But this is still hard as it is to believe. It's still in a gentle downtrend since June. It's a little deceiving, like I said, to that recency bias, because we have been so strong for the past since the Warsh Wednesday, and the simultaneous Leopold Aschenbrenner wipeout. But this is still in a gentle downtrend, and as just mentioned before this segment, historically, seasonality is about to kick in for volatility.
Yeah, and to your point of it being kind of counterintuitive to see this kind of sloping down, that 4 days there of the green bars was all the Mag 7 earnings. So you had Microsoft, Meta, Amazon, Apple. Amazon Meta initially sold off 100 points, and then within the week reversed it completely. So yeah, it could be interesting to see where we go from here. It feels like we've received the earnings, and now the market's like, okay, well, now what? Like, where do we go from here?
It's like the old movie cliche. It's quiet, ... too quiet.
Yeah. Well, Tim, appreciate your time. Yeah, lots of interesting opportunities out there. The NASDAQ position, I just have neutral short premium going forward, but that's a small position that I'll keep on into perpetuity. But yeah, we will see you a little bit later.
Alrighty. See you, Gabe. Bye, Mike.
Adios. E-minis up down 9. NASDAQ up 60. A little divergence there, kind of speaking to the indecision in the market. But we're going to take a quick 90-second break. We'll bring back Julia with some research on the other side of it.
Bye-bye.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Step into the futures arena with Tasty Trade's active trader. Multiple ladders, hundreds of indicators, precision control. From micro gold to NASDAQ, all CME one click.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
We built Tasty Trade's web platform for today's traders. Drill into data, find opportunity, and track the action with hundreds of indicators. Fund your account and start trading right in the app. Join the club. Tasty Trade.
Investopedia says we're the best for options trading. Stockbrokers.com says we're #1. And Broker Chooser raves about us too. So what else can we say other than boom? Trade like a trader. Tasty Trade.
It's time to trade smart, post PDT rule elimination. And Tasty Trade has the tools traders need. The Active Trader tab's comprehensive market data is designed for rapid order placement in a single click, while bracket orders let traders set entry, profit target, and stop loss all in one ticket. From the Positions tab, you can monitor positions, roll trades, close positions, and create conditional orders. Now, traders of all account sizes have more flexibility than ever before to engage in the markets. Smart tools for smart traders. Tasty.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
What's up, everyone? We are back with a market measure sponsored by SIBO, which means one thing and one thing only. We got Julia Spina on the line. Julia, how you doing?
I'm amazing. How are you?
Doing great. Doing great. I was joking with Chris this morning that the research segment given the market and the lack of volatility. The research segment might just be pictures of landscapes to coerce people to go outside and do other things,
And touch grass.
But I have a feeling that it's not the case. But you mentioned you're battling with yourself. You have a leech story from the weekend. I want to hear.
It's debating whether or not to tell it because it's really gross. But I went to a lake over in Illinois over the weekend. It was like a local lake, and we were swimming around in it. There were like kids playing and stuff. I don't know. I guess this is normal. I have no idea. But we reached down and scooped up some sand in the shallow water, and there were just like a bunch of clams. And we're like, oh. There's like a lot of clams. That's interesting. When we put the clams down, I looked back at my hand and there were just these tiny little brown leeches just stuck to my hands. And I'm like, oh, that's good. So we proceeded to like Jaws movie-esque run out of the water and pick these tiny little baby leeches off of us. We looked it up and apparently that's like kind of normal, but yeah, now I'm going to be scared about it. I was already like a pool person before this. I already have trust issues with natural bodies of water.
Yeah.
Like, let's give it a go. It's nice out. Let's try it. Nope. The clams and the leeches. I think they were leeches. I don't know.
Yeah. Leeches are kind of wild because they just latch on and drain you of your blood. So, I mean, it's kind of wild.
It's kind of wild. Yeah.
Ideal scenario.
Not an ideal. Yeah.
Last time I checked, leeches can't live in chlorine water, so I think you're good.
I think I'm good with the pool. Yeah, I don't know. I think there were leeches. We tried to find it. I don't know. Natural bodies of water have a lot of living things in them, and figuring those out. I don't know. I'm just going to stick with the pools these days. I think.
That's fair. Yep. Well, what do you got for us today?
So today, speaking of low vol, I'm looking at choosing a DTE for a poor man's covered call play. That's what we're going to be looking at. Because vol is low, as you were kind of talking about. Market's not having a ton of volatility, although that can change very quickly. But when you're trading in low volatility, looking for strategies that kind of adapt well to those volatility and conditions. And so Sahil did this piece, put it together, but basically comparing DTEs for different four-man covered call plays.
Cool. Let's do it.
Okay, so kind of like I said in the intro, but basically as the market pushes higher and higher and higher after earnings, although that may change, we're down a little bit today, but as the market continues to push higher, that pushes volatility lower as well. The VIX is trading at around 15 right now, can go lower, but definitely at the lower end of its range, definitely below its median levels, below average levels. So as a result, that means that, changing strategies a little bit in terms of looking for opportunities for options traders. And if we go on the next slide, selling puts, spreads, jade lizards become less attractive just because premiums are lower and that, chance of a tail risk is overall quite low, but they really stink when those happen when vol is low, just because you're collecting less premium to compensate for those moves that kind of come out of the blue. So one alternative strategy is a bullish play is the poor man's covered call. So AKA the bullish diagonal, which is the cheaper version of the just regular covered call, where you're basically using a long option to substitute your shares and reduce your cost basis. So what should they consider when they're choosing a duration for the long call? And what are the different, we're going to look at a couple longer dated expiration cycles and sort of compare them here. Make sense?
I like it. Yeah, I like these trades a lot, especially for low VIX environments. I like to see it as with low VIX, you can buy these options much further out on the time frame in terms of expiration for similar costs. And I think the further out you go, the more time you have for the thing to work out in your favor. So I'm interested to see what the data says.
Yeah. So let's take a look. So when we go over to the next slide, so basically when we're purchasing longer dated calls that are 6 months and above, that basically functions more as a replacement for stocks, and they're less sensitive to fluctuations in the stock's price when you're going with DTEs that are further out than usually like 6 months, but you can go obviously much further than that. On the other hand, when you're buying calls that are of shorter duration, more, just closer to the 45 to 90 day cycle, that reduces the BPR and potentially boosts return on credit, but they're more sensitive to more recent current moves in the market. So that's kind of that trade-off between the two. And then when we go onto the study slide, we'll be talking about what, basically what we're going to be looking at in our back test. Make sense?
Indeed.
Cool. Okay, so here we're looking at SPY 2013 to present, and we're going to be comparing poor man covered calls with long 70 delta calls of durations of 60, 90, 120, going all the way up to 300 days. And then for our short calls, we're going to be doing short 45 DTE, 30 delta calls. We're going to have our trades managed expiration in the front month, which a lot of people manage these early, but we just wanted to look at, if we kind of take the management element out of this, what do the statistics look like? Make sense?
Indeed. Let's do it.
Indeedy. Okay, our first nice graphic. So basically, the longer you hold the poor man's covered call, the more profit you can make. But that also means generally higher buying power requirements. So, for example, a 92 delta long option requires $3,900 in capital, while a 170-day long option is $5,200. So you can collect more the longer you hold it, but that comes with just the trade being more expensive and then potentially less capital to deploy, in the sense that there's maybe like an IV pop, maybe IVR or IVP pops up because of whatever kind of market conditions emerge. That leaves a little bit less money to be able to deploy in the interim during those 127 days, for example.
Yeah, I always like to say you get what you pay for with long options. You have a higher debit cost, but you have, again, like you're seeing here, a lot more time for things to work out in your favor. And that I don't think can be understated. So these low vol environments are nice opportunities to kind of inventory that delta, I think is another way to say it too.
Mm-hmm. Yeah, that is a good way to say it. I like that. And then when we go over to the next slide, here we're looking at success rates. And what is actually pretty interesting is that success rates increases with longer duration for a poor man's covered call, but not by a ton. There we go. There's that next slide. So when we're looking from 60 to 300 DTE, we can see that our win ratio increases from about like 59% upwards to like almost 66, 67%. You can see that win rate really tapers off. Once you get above around like 180 to 210, that curve really starts to flatten out, and you're really not getting as much upside from a win rate perspective compared to, the shorter dated options, where you're seeing more of an increase from like 60 to 150, for example. So even though you're choosing a longer dated option, that doesn't significantly create a better chance to win when you're going, I would say, like very far out, like 200 DTE plus.
Yeah, and I think this last part, the last point on this slide, win ratio can be increased with management, is really the key here. Like you can go further out in time and get that longer dated option, but holding it to expiration just means that you have to have the market go up even more because you're paying more upfront, and that upfront cost, if it's extrinsic value, has to be offset by intrinsic value in SPY movement. So yeah, I think for these types of strategies, the further out in time you go for a similar cost, the better in my mind, because you just have more time. But it's also something that you want to keep managing like we do with normal trades if you get a nice profit, because all extrinsic value goes to zero by expiration.
Yeah, that's right. And it's really about what your goals are and how long you're comfortable kind of having the capital tied up. That's really the piece of it. So maybe VIX is low right now, but if you're concerned potentially about a VIX spike in the interim, then maybe going a bit further dated compared to, like VIX is low, don't foresee anything, for a while, I'm comfortable having the capital tied up, then maybe a longer duration. Really depends on your goals and how long you're comfortable having that amount invested, really. But yeah, this bit about win ratios I thought was really interesting, and seeing that kind of really start to flatten out when you're going very far out. So that is, going longer dated can have some benefits, but win rate becomes less of the equation, I would say.
Yeah, for sure.
Cool. So now when we go to the last slide, we're looking at return on capital, and where we're seeing it peak at around 5%, that really reaches maximum between 90 and 150 DTE. And that is what we would call kind of like a sweet spot when we're considering high success rates and when those start to kind of taper off, reasonable BPRs. And that sweet spot is really between 90 to 150 days. But like I kind of said, and like you kind of talked about, it really depends on what your goals are and what you want to be using the strategy for and how long you'd like to have that capital kind of working towards the strategy.
Yeah, I would say for any kind of diagonal spread or poor man's covered call, however you want to view it, I haven't gone beyond this range, the 90 to 150, but I've definitely gone past 90 days for a long option, especially when vol's super low. Like that's another thing to consider is when vol's really low. If you're trading an equity that has like low 20s implied volatility, going out further, 90 days, 120 days, 150 days, if it still fits in your wheelhouse in terms of risk, I think it makes a lot of sense, especially because you would then cover 3, 4 earnings announcements at the very least that could bail you out if you have a loser.
Right. Yeah, that's a good point. But again, really just depends on your goals and what you're trying to do. But maybe more for like active traders who are really looking to have that reserve capital sort of ready to go in the event that conditions change, or who are looking to sort of manage these early, which a lot of people do. Then that 90 to 150, kind of like you said, just from the statistics, is kind of a sweet spot there.
For sure.
Cool. Okay. So some takeaways. So poor man's covered call is a compelling and can be profitable alternative to the traditional covered call strategy. And this is especially interesting when IV is low. So choosing significantly longer dated options does not significantly increase our chance to win and increases our buying power reduction. So important things to keep in mind when choosing a DTE there. So going with kind of the conventional wisdom, the 60 to 90 days is a good play for smaller accounts just because of the capital requirements. But overall, when selecting the sort of like long call duration, the sweet spot that we found when just looking at return on capital and weighing pop as well, win ratio was 90 to 150 DTE for that long contract, which gives you that benefit of those higher success rates and higher return on capital. And while also leaving your capital, like I would say, yeah, invested for a shorter period of time compared to some of the much more longer dated strategies that we looked at, like 300 days, for example.
Yeah. And I think, these strategies especially work when you have really low implied volatility, like really, really, really low implied volatility. We were looking at TLT earlier as just an example of a product that has almost single-digit implied volatility across the board. And these prices are shocking. Like an at-the-money call in TLT, 82 strike, 150 days out. So at the tail end of this example, only trading for $200. That's actually insane. And if you right click on that option, you can see that it was trading for $500, $600 just a month ago. So these are the opportunities where if you're looking at inventory delta in a product and you have a directional assumption and that product has really low implied volatility, these are the types of strategies that I think make sense to consider.
Yeah, for sure. So really cool piece from Sahil if you want to follow him over on X. And I think that's all I got.
Sweet. Awesome. Well, Julia, appreciate it as always. Great content. Enjoy the rest of your day here, and we'll see you a little bit later.
Talk to you later. Peace.
See ya. E-minis down 10, NASDAQ up 75, down the Russell are down just a little bit. Bitcoin up, interestingly enough, through the turbulence of today. But yeah, I think with these poor man's covered calls and call buying situations, I love seeing really low implied volatility, especially if we're trying to go further out in time. I mean, these prices are crazy. $200 for an at-the-money option. I feel like I might just buy this just out of principle. All things considered, we're trading at the annual lows, 2007 lows in TLT. So you know what? I will do that. I'm going to do just an at-the-money $200 82 strike call here and just inventory it. See what happens. But yeah, we're going to take a quick break here. We'll be back on the other side. I'll do a little recap of some positioning that I made adjustments on. And I'm going to scan over to the YouTube chat, see if we have any trade ideas that we can go over. But you're watching Tasty Live. We'll see you in about 90 seconds.
You bring it, match it. Get a 3% match on all qualified.
Welcome back to the show. Real quick recap on trades that I placed today. So Amazon closed a $160 winner. This was the earnings trade. It was the call crab trade. Amazon gapped higher, well above my risk profile for the original crab trade, but I made the adjustment by manipulating it and pushing it, forcing a credit here in Amazon by widening that call crab component out 5 points. So I started with the 240, 255, 270, 15-point wide crab trade, paid $9 for it. And then after we gapped higher, we were sitting around 275-ish. I widened my 255, 270 crab component to 255, 275. So I turned it from a 15-point wide to a 20-point wide, moved it out to August, and collected $1.70. So I took on $500 more risk, but offset that by $1.70 with the credit. And then we finally got that sell-off in Amazon, resulting in a net profit of $160 with my 240, 255, 270 benefiting from that recent sell-off. So nice win there after that adjustment. And then TLT after the segment today, just now with Julia, just going to inventory some delta here. TLT 82 strike call, 150 days out. Only $200. And yeah, I mean, if you lose $200 in here because TLT just continues to slide, so be it. But I like looking at this options chart and seeing this option is trading for $2 now. It was trading for $600 2 weeks ago. It was trading for $1,000 a few months ago. So plenty of reward relative to risk here. Especially if I assume this option trading for $200 currently, 150 days out, probably won't go too much lower in value, even if we continue to slide here 2, 3, 4 points. You can see these options are still trading for $1 up here. So that is the two adjustments I made today. I saw the YouTube poll. Where do we think crude oil is going? 85 or 81st? The vast majority said 85, and I couldn't agree more. I mean, when you look at this tail end, these options, Feb, March, April, and May for 2027, these are trading at 68, 69 last week, and now they're elevated at 73, 74, 75. So this tells us that we should expect to see higher prices for longer. We're seeing backwardation continue to stay bid here in the crude oil markets, 81.40, 80.23 in the next active cycles here. So yeah, I think we'll chop around in crude oil. I would not be shocked at all to see us get back to 85. I have this perpetual straddle on the MCL contract. It's working out nicely right now, sitting at the 80, 31 days to go, 11.75 in premium collected. And I can always roll this out if I decide to close this and go from the 31 day to the 59 day. Currently trading at 80.26, the 59 days. So if I use the same strikes, I'm actually neutralizing my delta even more, and I can pick up another $300 in premium. So I'll definitely look to do that. I think oil, as long as we have this elevated implied volatility and these back months continue to lift towards 80, why not have some premium on in here? That would bring my total credit received to like $1,400. I saw someone in the YouTube chat looking at long-term year-end short puts, and I believe they're looking at NVIDIA and Micron. So NVIDIA year-end short puts. So I think you can do stuff like this if you really want to. But from my perspective, if you're selling a 220 put, or even if you're going to the expected move and you're selling a put at, in NVIDIA, the expected move is all the way down at like 190, 180, 185. If you're collecting $5, even if NVIDIA chops around here, you're going to be waiting a long time to get any kind of value out of this position unless NVIDIA rallies. If NVIDIA rallies 25, 30 points, you're going to be able to close this for a 50% winner. But from my perspective, you're playing for a 25, 30 point rally in NVIDIA to capture this value sooner. Why not give up some of that value and really accentuate your max profit potential? So getting into like a Super Bowl type setup doesn't even have to be an option that gets rid of all of your credit. Even here, if we look at like a 300 strike or even a 320 strike, like these are out of the money, but this is such a long time frame that if you do get a rally in NVIDIA earnings for next week, you could watch this $2 option turn into a $5, $6, $7 option. So if we look at this, still picking up 250 in the middle. If we look at the curve analysis mode, and we'll zoom out here, very similar to my SpaceX position. This put by itself, if you get a rally up to 300, you're looking at a $250, $300 winner. But by giving up a little bit of that credit, you still have a high probability trade, P50 at 90%, pop at 78%. If you get a rally from 225 to 300, this is now a $3,000 winner. You've multiplied your max profit by giving up a little bit of that premium in the middle. But even if you get a rally from 225 to 250, this is still about $1,000 P&L Theo here with the longer term trade. So in NVIDIA, I like that kind of setup. In Micron, I believe was the other one, more expensive product, much more expensive product. So this is going to be out of my wheelhouse in terms of risk reward here. But I do kind of like that NVIDIA trade, just getting that 250 credit in the middle, playing for long-term bullish move here. But same thing in Micron. If you're going to the expected move around 700, picking up $3,000, but you're using 10 grand in buying power requirement, it's actually pretty good in terms of return on capital. 30% return on capital with a high IV of 72%. Even though the IV ranks on the lower end, 72% is super healthy for any equity in terms of premium collected and implied volatility. I always look for 20% return on capital or more if I'm selling undefined risk premium, which would bring you to $2,000 in credit received. So if you're getting 3, that is a nice return on capital there. But same story. Selling the put here in December at the expected move. The only issue with Micron is there's so much call skew in here that it kind of eliminates the ability to do this. Like you'd have to go, this is nuts. You'd have to go all the way up to the 2000 strike. If you were to create some asymmetry here, you'd give up way more premium in the middle relative to the trade we just looked at in NVIDIA. You'd have to go significantly higher. You're going 100% higher in Micron, and you're giving up 2/3 the value. Still, you can make a ton of capital if you do get a big move in Micron, but I don't like this setup nearly as much as the NVIDIA one, where you're giving up half of the value to go 25 points higher, which is, twice the earnings expected move for next week. This one, you're giving up significantly more premium in the middle, and you need the stock price to double to get a ton of value out of there. But you could still make some money on a rally there. So just something to consider. But I think the call skew in Micron prevents you from getting a nice risk reward there with that same sort of setup, where NVIDIA, the call skew isn't as impressive there. So you have the ability to do that. But that's it for me. Again, check out the follow feed. I'll continue to place these trades here. I've got a trade of the day at 11:45 for me, but we're kicking them off at 11:30. And don't forget, 3 o'clock today, we've got TastyCrumbs with Jem and Jermal. So check that out every single Monday. It's always a great conversation between those two. So yeah, plenty more content coming your way, even though the market here isn't giving us all too much to talk about. But if you want to reach out to me on Twitter, I'm at Trader Mikey B. But we're going to take a quick 90-second break here. I'm going to pass it along to Chris and TP next.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize profit and loss with risk analysis tools, and place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join.
Really matter, but that's how I trade this stuff, and would have been a nice trade. What I am trying to decide, though, is in crude oil. I'm short an iron condor, the 78.79. This is zero DTEs. I sold it last Friday.
Sure.
I'm short the 78.79 put spread, short the 83 half, 84 half call spread. And I think I'm gonna let the put side go. I'm
Sorry,
gonna roll the dice.
do you mind giving me those strikes and expiration once more?
Yes. So in zero DTEs in the August 17th kind, right where you are. I'm long the 78 puts, and those are just dead. I'm long the 78 puts, short the 79 puts, short the operative strikes are the 83 half calls and 80. So I'm short the 83 halves, long the 84 halves. One strike, couple strikes up. There you go. So that's it's gotten even cheap. Well, 80. Did I get that right, Chris? Yeah, 83 half, 84 half. Right now, I'm seeing that trading for, I don't know, maybe 6 cents or something like that. I may just close it out. I sold that for 33 cents, so it's a nice little profit. I think I'm gonna try to close that call spread out right now. I will try, because I'm kind of neutral on crude oil. Chris, what's your take on this the Treasury Secretary, what's his name, Scott Bessent, is starting the economic hammer on Iran? Do you have any thoughts on that?
I love the Bloomberg report that came out today. Scott Bessent is convinced traders that he has one goal, and it's to prevent U.S. yields from going up. Yeah, we've been saying that for months. Isn't it funny how every time the 10-year gets to like that 4.5 to 4.7 area, something happens? We get a memorandum of understanding. We get an Iran oil waiver. We get a yen
intervention.
What a coincidence. All these things keep happening right when yields at the long end of the curve keep trying to break out, because they're demanding that we get rate cuts in an inflationary time, which doesn't really work out for the curve. But anyway, TP, before we get into that further here, our man in the back, Frank, he wants to point out real quick that we do have an important roll coming up here. Oil will be flipping from the September to the Octobers in a couple of days. Please pay attention.
Yes.
Yeah, right. So this was, this morning, U6, we're now in V6 here. We go out in time. You got a little bit of clock in the V6, but just if you're in anything shorter data, that just don't get trapped. Don't get trapped.
No, see, that's exactly where I'm sitting here. Is I knew the risks of this particular contract going in. I'm okay. I've done this a couple times before. So, the question is crude oil going to rally up another $1? I think I'm a 5 bid for that 83 half, 84 half right now. Nothing done yet. I may give him 6 cents.
Can we talk about how this market has just gone total boy who cried wolf on President Trump with respect to his threats? He's talking about bombing Iran. Marjorie Taylor Greene's out here talking about how they want to nuke Iran. And oil today is like, we're off by 0.0. We're down by 3 cents. Okay, like
the bottom line is if the fewer people that die in this whole thing, the better. Is general thesis and all this stuff. And if the economic stuff is preferable, if that actually squeezes them a little bit more than bombing Iran or whatever, awesome. Let's try that. But I do think the market, I think maybe Iran and the Strait of Hormuz have maybe jumped the shark. I think maybe that was the early summer, springtime's news. I think all the headlines and stuff have been played out, and that the long term, and Chris, I think I mentioned this to you too, long term, they're going to find a way around the Strait of Hormuz. The market will not allow one country the size of Iran to stand in between oil and the rest of the world. They won't let that happen. And they'll find other ways of transporting it around the Strait of Hormuz, with pipelines, trucks, or whatever. They'll do it. So I think Iran might be overplaying its hand here. And, just like, does anybody actually think they're going to slow down oil long term? I don't. Short term, maybe, but I don't know. I just think oil's going to continue to trade up and down on a range. I don't think anybody knows which way it's going to go.
Yeah, TP. I mean, I only have one thing sitting here in the 92 days, which is the 69.71 short put spread. I put that on a while back when oil was pulling back in because I don't see a world in which oil stays low, at least through midterms. My opinion, no proof behind it, but I have a feeling the Iranian government wants to make this war as painful as possible for Trump and the Republican Party, which would mean political kickback here at home, keep gas prices high through November. Has that happened before with Iran around a U.S. election?
Yeah,
TP?
I mean,
yes, with Jimmy Carter and Ronald Reagan. The day that Jimmy Carter leaves office, the hostages are released.
Well, the thing is, yes, Iran.
It's not a new playbook for this regime. They've done this to us before.
Right. Iran can try to do that, and maybe they'll succeed, maybe they won't. But the problem is, I think everybody, if I know that, Chris, and I'm not speaking for you because you're a sharp guy, but if I know that, I'm still thinking Pokemon is the popular thing for kids. Okay.
It is, though.
It is?
It still is, yeah.
Okay. All right,
you know how great that is, by the way? My daughter's
So
like,
I'm in
watch
touch.
Pokemon.
So
It's like, I've got all that knowledge I can use still.
Chris, I'm in touch. So the point is, everybody already knows that. And so there's only so much leverage that Iran actually has.
Yeah.
Who knows? They're going to try and play it out for the politics of the United States. Hell, we can't even figure out the politics of the United States. So my point is, I'm happy selling premium, selling strangles, actually selling iron condors. I don't want to take that much risk in naked premium and crude oil. The other point too is I am going to continue to sell any rally in bonds or notes. I am already short a call spread in ZN.
Like that.
Talked about that a little bit earlier at 8:45. So I'm already short. What's my position? I am short. I'm short the 109 half call spread in ZN in the 18-day options. That was just me because I thought, okay, I'll sell the call spread. Yeah, just really narrow, half a point, $500 worth of risk. Do I have something in ZB? No, I don't have anything in ZB, but I know you're longer put spread in ZB, I think.
Yeah, well, a few weeks ago, you said that friends help friends and you wanted to help me make some ice cream money. And so you said I should look, instead of just selling a call spread here, Chris, just buy a put spread. It's so cheap. And I did. And I've been rolling them down now I guess it's been like 2 months now, TP.
Yeah.
And so currently in a 108, 107, it's been a real simple, it's not 2 months. We'll call it 6 weeks now since early July, but just riding the rails. That yellow line on my chart, that's the 1 month moving average. We get these bounces into it. It sells off from there. 2 steps down, 1 step up. I'm still in at 11 DTE. So the 108, 107, it's working because I got it on that rebound after CPI.
Mm-hmm.
I mean, what vindication for my own worldview last week, TP? CPI comes in on the screws, bonds rally. I buy a put spread because why are bonds rallying if the Fed isn't going to hike?
No.
And now we're a full point lower. And so we're seeing this dynamic play out in real time. And so for me, as long as the Fed isn't hiking, doesn't matter what oil's doing, ZB is not going to be having a good time right now. So I keep pressing on.
And I think at another level, the relative weakness of the demand for the Treasury auction on Friday and over the past couple of days, the 10s and the 30s. And I do think the AI bonds, the big CapEx expenditures, the bond offerings of all these companies needing to raise money is in competition, with the treasuries. So that's pulling dollars away from treasuries, I think. And if the market continues to rally, make all-time highs, even if it is a completely incongruous with higher yields, it doesn't matter. It's going to pull money away from treasuries. There's a whole bunch of things I think that are going to pull money away from treasuries. So that's why I'm going to sell any rally. And like I said, I'm making small profit on my call spread right now. But next I would either load up with a long put spread in ZB or something like that.
TP, this is Confirm and Send. So we do have some questions to get to here. Well, you can't see our
Ruh-roh.
faces, you can hear our voices, but you can send over those questions in writing to research@tastylive.com, research@tastylive.com. We'll go to the first question here. The Russell 2000 hit all-time highs 3 times last week, while large caps mostly chop sideways. Small cap IV usually runs richer than large cap anyway. Does rotation like that change where you'd want to be selling premium, or is it just noise? TP, I mean, I don't consider that noise. It doesn't necessarily change where I want to sell premium. It gives me greater confidence that I'm selling premium because the rally has breadth. It is widespread across the board. Today is not fantastic for breadth. RSP's in a little bit. We can go to QQEW. It's off a touch. But we were looking at all-time highs in the equal weighted indexes a few days ago, including that Russell 2000, the small caps here. And so, no, I don't find it to be a problem. Now, because of that historical tendency where small caps usually have more volatility than large caps, we have to examine, is this something that's idiosyncratic? Is this something for the moment? Is something broken? The tech names have all this volatility embedded because of what's happening in the AI trade. So maybe on a relative basis, you could do something like short NASDAQ vol, long Russell vol. But I'm not playing this market that way. This is a market that looks like it's going up. When small cap shows strength alongside the NASDAQ, it's usually a sign of a very healthy equity space. So I'm treating it like that. It's just noise. Find the math. If it works, it works. If you get paid a third of the width or more of the strikes, then you go in. And if not, then you think twice about it.
Right. I think, does that rotation change the way I approach it? Not really. And as far as noise versus something that's more structural, no, what you're seeing is, the intraday stuff, it's noise, right? The vols up here, vols down there, whatever. But realistically, just Russell 2000 volatility is almost always higher than S&P 500 volatility. What you can do on here, Chris, is type in RVX. RVX is the Russell 2000 IV. It's the VIX for the Russell 2000. So comparing RVX to VIX can give you some context for what's going on in the volatilities. But you did see just persistent. You will see persistently higher IV in the Russell. It's just small cap versus big cap.
Yeah, TP, I'm still holding on to a position here in the Russell. Last week, no, not last week, 2 weeks ago, Friday. Yes, Friday, not last Friday, the Friday before. Russell short put spread 290, 29.75, 29.50 here. Why? Listen, I like to use charts and the options to express my view. We had made this jump up through 3K. We ran into the former highs. We pulled back and we started treating 3,000 as a shelf. Our 50-day moving average was sitting around there. The 1 month moving average was sitting around those levels, creeping up. So it seemed like a good, okay, maybe this thing holds. Do we hold on to it still? I am, because it's about a third of the width of the strike, right, is what we sold it for. It was 25 points wide, and that gave us about 680. So not perfect, but I like the setup. So I went a little bit beyond what we usually do here. It's only at 455 right now. So in an ideal world, I'm looking for this to decay down to about $3.40 or so before I take it off. We're getting close. We're not there yet, but with a little bit more time, it's 25 DTE here, TP. Maybe by the end of this week, maybe midweek, this thing can get to 50% profit, and then you can take it off and look for the next one. But the chart setup and the math, it doesn't really matter what everything else says. Period.
All right,
go to the next question.
Question.
Nothing else to say. Walmart reports into a quarter where retail sales dropped and jobs went negative, yet the stock is near highs. When a defensive name is priced for strength while its own macro backdrop is deteriorating, which side of that does the options market usually get wrong?
I love that. So the idea is a defensive stock, hey, no matter how bad things get, people will always be shopping at Walmart. But, it's the macro stuff. Inflation's still going up, increasing maybe, energy prices still high, et cetera, et cetera. So Walmart, let me just check out a chart on Walmart. I've traded Walmart fairly actively. I wouldn't say that Walmart has been outperforming necessarily, but if you look at the volatility skew, and they're coming up, their earnings numbers in, I think it's Thursday. So right now, stock's at 114.44. Let's call it 15. So down a buck or down $5, up $5. Yeah, the skew is pretty even in there. So which side does the option market get wrong? That's I wouldn't say which one it gets wrong. It's just implying certain risk right now in both directions. And that's there's nothing that is bullish or bearish in an option pricing model. Let me just state that. And it's not like people are, or at least market makers, they're not buying up out of the money Walmart puts, buying up out of the money Walmart calls because they are bullish or bearish on Walmart. That's not how it works. It's market makers are responding to outside, retail buying and selling, institutional buying and selling, people who are putting positions on for bullish or bearish bets. Market makers, they just reply to or respond to supply and demand. So which side does the option market get wrong? Neither or both, I should say. Neither or both. And looking at Walmart, Walmart's options are pretty actively traded. I might 4 days. You can get
a lot of this volume in there.
Just outside the expected move. Let's just see what you get for selling the 107, 109 put spread in the 4 days. And the 120, 122, 68 cents. So that's how I would trade Walmart. I don't have an opinion on which way it's going to go. I would use defined risk trades in this sort of thing going into earnings. But like I said, which side does the market get wrong or the option market get wrong? Neither or both, right? That's not how the option market thinks about. Does the stock go up or down?
Agree. Next question here. The guideline is 75% of your buying power in undefined risk and 25% defined. Flip for smaller accounts. Does that split change with the VIX, or does it say VIX no matter the environment, TP?
Yeah. So I would pare back the capital on the undefined risk side. With the VIX down at, sub 15, you're just not getting rewarded enough in short naked options to put full allocation in it.
Yes.
Because what you do, a couple of things you want to avoid. You don't want to get into a situation where you have naked risk to the upside or the downside, and you get a surprise, right? The VIX is low. Everybody's complacent. You could get a huge rally, huge sell-off. You don't know. One of those big moves could wipe out a single short strangle in SPX, for example.
Nothing.
So increasing. So having a huge 75% allocation in short naked strangles, for example, when the VIX is this low, I don't like it. I would pare it back to maybe 30%. And again, why would I do that? For risk purposes? Also, you want to have spare capital ready to deploy if the VIX goes back up to 20, 25, 30. If you have 75%, 25% all booked up, if the volatility does increase, you got no bullets left. And so you're not getting rewarded here for naked short options. Pare back your allocation. Like I said, maybe half. Instead of 75% of your capital, use maybe 30%, something like that, for naked.
Yeah.
And
you just don't get paid right now in this environment. No, you don't get paid right now. Right? Since 2005, when the VIX is below 15, it currently has a 14 handle here on the screen right now. So this fits the bill, 1494. Okay. When the VIX is below 15 since 2005, the average daily return for long ES position is 0.13. Short strangle is just 0.06. The volatility of daily returns, excuse me, is 0.5% for the long ES and is 0.7% for the short strangle. So how can one justify looking for a positioning that gives you more risk with less reward? There are times, TP, when you sit like a 40 or a 30 VIX, doing the short strangle, you're going to get better returns, lower volatility. That's why you do it.
Yeah, right. And so that's it in a nutshell. So yes, it is VIX dependent. When VIX is low, pare back your allocations for short strategies.
And especially the naked stuff. I have nothing, outside of the shares I have in SMH. Everything else is defined risk right now. I'm not doing anything else uncapped. Maybe if it's like I've been thinking about a VIX lotto ticket, like buying like the 18, VIX, spending a few $100 on it. But like outside of that, I'm not doing anything naked right now. TP, we got one more question here for confirm and send. The VIX is below 15 and credits are tiny everywhere. The rule says use less buying power when vol is this low, but does that mean barely selling anything? How do you keep selling premium here without forcing trades? I'll tell you what I'm doing here. Can I tell you what I'm doing here today?
Please.
I'm looking for names in the tape that have been weak. And that's why this morning I went into Qualcomm, for example. Okay, and Qualcomm's had a rough morning here. There's not a ton of volatility, but when you have semiconductors up 3, 4, 5% as a sector, and Qualcomm was down 0.75%, 1%, I go, where can I put on something that's kind of short premium, but with a little bit of juice? Super bear, double bear here. Short the 185, 190 call, long the 140, 135 put spread. So when I see these low volatility plays or regimes here, it tells me that I want to maybe push my view in a little bit of a more aggressive direction by, augmenting something like a short call spread or short put spread with a kicker, like a long call spread or a long put spread if I'm doing a super bear or a super bull.
That's the answer. It's not that we are forcing short premium trades. It's that we are looking beyond SPX, Qs, IW1, whatever. We're looking outside at individual stocks that naturally are more volatile and that have higher IV. Simple.
Period. End of story. And right now, you're going to find more volatility on an individual name basis than you will at the index level. And TB, this is the takeaway here. Volatility is coming in everywhere, by the way. It's coming down in bonds. If you're looking at measures of vol in stocks, in commodities, in currency, it's really falling off. So VIXpiration this week, OPEX monthly on Friday. Let's be mindful that this could be the end of a good thing, perhaps. But hey, until then, we're done here. Research at tastylive.com, research at tastylive.com. Send in your questions. We're taking a brief break. More Tasty Live after this. Errol, Coleman, he's here. See you there.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
You bring it, we match it. 3% match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus advanced tools built for traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
What's going on, everybody, and welcome back to Risk and Reward. We've seen a little bit of choppiness today. We're finally starting to get a little bit of follow through to the upside, but I want to talk about everything that's in the portfolio today. I want to touch on things like gold. We'll talk a little bit about Bitcoin and just the overall market today. But one that I want to start off with is SpaceX, man. Shout out to SpaceX. I mean, I wasn't giving SpaceX much love just because of how disappointing, post IPO it really was. And it felt like trading something like SpaceX was like trading a falling knife. And that's what it felt like up until the last 7 days. Right now, SpaceX logging another really good day, up about 8.5 points on the day, 6% altogether, trading at 148.39 right now. The IPO price was 150, so anybody that was getting on any type of long position, if you at least sold the options or bought the underlying stock, your positions are most likely not as underwater as they once was, over the last month. So nice to see a little bit more volatility into SpaceX. That one was a max loser, I think, within 48 hours of me putting that one on, and then it was just resurrected from the grave. So 148 today on SpaceX, a little bit more volatility there. It'll be nice to see the volatility keep up, and it's nice that we're finally getting a little bit more historical price action on SpaceX, right? Because what is too expensive when it's trading at a price that it's never traded at before? So now that we have a pretty prominent swing low, at 106 that we put in on SpaceX, it's given us a little bit more to work with. So with that being said, we do still have our oil position on. This is one I've really kept a close eye on when it comes down to oil headlines, anything to do with Trump and Iran. So anybody that is just joining us, we did get long oil at 74.33. This is one we're going to be looking to hold a little bit longer, potentially into the highs of 86. I know originally we were looking at that 84.5 level, which is that previous swing high that we had just came down from on oil. But we're really hoping on this macro context to really help this trade see any level of continuation. So we're going to be patient on it. We've pretty much been consolidating the last 3 to 4 days, so it's been a waiting game here, and that is what it's felt like just trading this entire Iran conflict, right? With the geopolitical events, Trump going back and forth with the Strait of Hormuz, like it feel like we've made no progress, and we're kind of just stalling out here. So we're going to hope that the cards land in our favor on that one. So we're going to be holding long there. We were looking at micro NASDAQ a little bit today. We'll talk about what we did in there. Really not too much. And then Apple, we sold an out-of-the-money call spread, $5 wide. We collected about $1.98 on that one. So $300 worth of risk for the max loss. But it's been working out pretty well, right? Apple was one that was slowly trading at all-time highs, under the radar. But now trading at 304, had a gap down post earnings. So that was another trade of the day that we had put on. And I mean, most of these positions are from, trade of the day. And we kind of just manage these ones as we go by, as each day passes. But that's going to be Apple, sold an out of the money call spread. App 11 was another one that continued to sell off near its lows, right? This was one that felt like you were catching more of a falling knife. We've been consolidating the past 3 days now. We are down on the position, about break even on the day, but we do have an out of the money put spread. So we got on a little bit of long delta there. We collected 335. So just a quick update on App 11. Post earnings, very big downside move, but we're looking to recoup a little bit of that potentially over exaggerated move to the downside. And this has 32 days left till expiration. It is a $10 wide, so we're collecting a little bit more credit on order entry there. But this one's going to be a waiting game, right? I like some of these post earnings trades, especially whenever it feels like that move might have been, maybe a little over exaggerated. So whether we get a pop to the upside or start consolidating for the remainder of this trade, we should be able to squeeze out a bit of profit on this one. And then INTC, man, these memory names are so extremely resilient, right? I mean, if we go to the daily chart over here, you can see we've been rallying off the lows on INTC from 82, now trading at 104 just within the last couple of weeks. So my thesis remains the same. I do feel that we have put in a short-term top, so I'm going to be trading these to the downside until that thesis is proven otherwise, right? Maybe you feel differently. Maybe you feel that the momentum is still going to be going strong. Maybe you feel that, we could put in another all-time high. Maybe you feel that short sellers are starting to get a little bit overzealous on a lot of these memory names because everybody was waiting for that backside because it's produced such a large range. Whatever the case might be, right? Just the fact that we finally got any level of pullback in these names finally gives us more defined ranges, at least to work with, whether you're trading this from the long side or the short side. But with that being said, we have more short delta on an INTC. We purchased the put. This one was what? I think it was last Friday or Thursday. We purchased this put that expires in 32 days. It was the 90 put. It was a 90 strike on INTC September 18th, which goes in tandem with the Micron position that we have on here, right? This one expires in about 4 days, out of the money call spread. So that little pop that we've been getting over the last 72 hours now, right? We were consolidating between 928 and 768. Then over the last 3 days, we finally got that break to the upside where we then closed at 949. And then on Friday, we had gapped up. We didn't see any signs of continuation yet. We had pulled back, but we did gap up overnight from Thursday to Friday. And then today we're getting more continuation to the upside, now trading back above 1,000. So that round number of 1,000, I think is going to be really interesting in terms of the overall sentiment of this underlying. So anything above 1,000, I don't think all-time highs is out of the question. But for right now, I'm not going to be trading for that. But that's going to be Micron. Those are some of the memory names. I know SanDisk at the same time experiencing that same rally, if not a little bit more pronounced, than Micron and Intel. And if I didn't already have some more short positions on, right, this obviously looks like a better potential entry point. So anybody that's been feeling bearish on, these memory names, they're setting up for you. Not that the trade has to work out, but in terms of the risk to reward opportunity that's presenting itself, like the risk that's worth taking, in my opinion, is there. It's not to say the trade is going to work out, but I do believe the opportunity is there, whether you're on the long side or short side. That volatility could potentially continue. Now, QQQ, we had sold an out-of-the-money call spread there. We have 4 days left till expiration. We'll be patient for it. SMH was a semiconductor ETF that we got on a little bit more short delta on in there. Another trade of the day. And then bonds are down on the day. I don't know what's going on with bonds. Gold probably having a pretty good day considering bonds are trading at its lows right now. Let's go ahead and check out what gold has been up to. See if we can get anything to load here. There we go. Yeah, gold's still experiencing a little bit more of a rally. I know we had seen a pullback. What was it last? I think Wednesday or Thursday. Now we're kind of trading above that point of control on oil, which we consolidated on for a couple of weeks. But it looks like that upwards momentum is continuing. And again, to my dismay, because whenever gold is in an uptrend, typically, bonds are slightly pulling back. So with that being said, this is a zebra trade. Bonds aren't an extremely volatile trade, but this does expire within 4 days. So we're going to have to get out of the zebra trade within the next, 3 to 4 days. So we'll have to talk about how we might want to manage that one. If we continue to see a continuation in gold, we may have no choice but to get out of some of this bonds position. Morning, Ranch. Morning, Big Deal. Morning, guys. Just taking a quick look at the chat here. Frankie said, I've had 3 terrible experiences with copper tubing. I can't tell you what copper tubing is. I thought you were going to say trading copper. I don't think I've traded copper. But I think we could take a quick look at it as well. But I don't think I've done any copper tubing. I'm not sure if that's like a practice that you do, I don't know, like in the warehouse, copper tubing, or I don't know what you got there, Frank. What else do we got over here before we take a look at copper? SpaceX, yeah, Frank's talking about the SpaceX making my 155, 160 short call vertical a little on edge. Yeah, no, I'd be on a little on edge too. You're kind of rounding the bases right there, Frankie. But no, with that being said, we do have our Microsoft position as well. That's doing pretty well. I know we skipped over that one. We had sold an out-of-the-money call spread, got a little bit of short delta on in there, just because this momentum with Microsoft was absolutely insane, right? I didn't get to take advantage of the meat of the move to the upside after we got the gap to the upside, and then we got a continuation to the upside. I'm pretty much just playing for a change of momentum. Maybe we get a little bit of consolidation. Maybe we get a little bit of sideways movement. Maybe we get a deeper pullback, right? But again, like I said, Mikey Butler is 8 for 8 on Microsoft so far this year, and he has a little bit of long delta on. So I don't want to fade that entire sentiment, right? I like my statistics. I like the odds. I like the probabilities. So when I hear something like that, I got to give myself a little bit of cushion to the downside. So we went with selling the out of the money call spread, collect a little bit more delta, credit and then hopefully we get a cool down on momentum, maybe a little bit of consolidation here. Happy Monday, Ryan. What's going on, Mike? What's going on, guys? What have you guys been looking at today? What have you guys been trading? I know this morning we didn't experience too much volatility. I think the scalping opportunity was definitely there. If we can go to NASDAQ here, but you know, it was a pretty tight range. I know we're starting to get a little bit more continuation to the upside right now. It's starting to look like, but things were pretty choppy. And you know, this morning I gotta say, you know, it was pretty rowdy and loud at the SIBO this morning. And then whenever I had hopped on at around 9, it gotten pretty quiet, and it had looked like the market was pretty much range bound from then. So there we go. MRVU, got you, Kyle. We'll see what's going on over there. Looking like NASDAQ finally pulling back into that morning range that we were trading in. This morning, actually, on the micro NASDAQ, I placed a trade on my phone this morning. I was trying to connect to the Wi-Fi, right, at the SIBO. And as I was doing that, I wanted to get on a little bit of, I think it was short delta initially I was getting on the micro NASDAQ. And I gotta say, I really don't know how people trade on their phone. That was such a, I mean, my cortisol was spiking as I'm trying to enter and exit trades on my cell phone. So, I mean, if you guys know how to keep your cortisol levels down whenever you're doing that, let me know. But with that being said, we were actually looking at getting shorted around 30,243. So there was a moment we were up a couple $100, we were up around $300, but we were actually looking for further downside. So I had put my stop loss about $50 to $60 in the profit. So we ended up getting stopped out of that trade, but we were also buying some QQQ puts at the same time, because if this morning low would have broke, I was looking at potential continuation to the downside. So once we started to chop around a little bit too long for my liking, I started to de-risk. I ended up getting out of those futures contracts on my phone, actually. And then I had set a stop loss for the 0DTE QQQ options. So we were leaning very short this morning, and we had some really great we had a really great cost basis on these trades, but you can just see that risk management is going to come number one every time, right? We bought a couple contracts on the 0DTEs. We're only down $56 on that, and we're only down 59 on the futures overall, given how short we were and how convicted we were in that potential trade. So came back, stopped us out on that one, getting a pullback right back into that range. But it's looking like it could potentially be an inside day, or maybe this one's not going to fool us, right? Sometimes whenever we have an inside day for the entire morning session, we usually get more follow through into the afternoon session. So sometimes that is kind of nice to see, but maybe it is going to be an inside day. But I think it's too soon to write off there being more directional opportunity. I think it's too soon. We have too many hours to trade. It's not even lunchtime yet, technically. The market could be setting up for something in the afternoon session. Alex said, I just opened a 0DTE credit spread on my phone while I'm making my morning coffee. Easy. Yeah, no, I gotta say, I will say, I think the Tasty app is probably one of the best when it comes down to entering options trades. But I should specify scalping. So Frank, if you're doing any type of scalping, let me know if you scalp on your phone. But when it comes down to like quicker decisions or trying to do a little bit analysis and really manage that risk very precisely, I find it pretty difficult on the phone. But you're right, Alex, maybe it's just a skill issue. Maybe I just need to get better with my thumbs, and that's what I need to do. What do we got here? Options on the mobile? Yes. Scalping I only do on the desktop. Yeah, 100%. And I gotta say, I remember I was telling Julia this a couple of months ago, or a few months ago. I was like, I actually think the mobile experience for the options is actually really good. Like the options chains, like find me another mobile app that's gonna give you such an in-depth options chain that you can actually read before sending the trade through. So when it comes down to options, I definitely agree with that. We got Frankie scalping HG. What was that again? Is that the copper market we can take a quick look at? Yeah, hit the thumb, Jim. Yeah, I can't skip that. I'm not gonna skip that because this weekend was actually leg day, and I'm not very fond of leg day, but I've gotten to the point where I'm starting to look forward to it. So I think it's one of those things, right? You gotta stay pretty consistent, and then I think it'll be a little bit easier. But no, just taking a quick look at, this is Hamilton Insurance. It's definitely not copper. Sergio says, I can't scalp without the ladder. Yeah, no, I hear you 100%. I know I can't scalp without the ladder whenever I'm trading on the Tasty platform. But whenever I have the broker connected to the Tasty, or to the TradingView charting interface, the in-chart trading is very, very practical for that scalp as well. User Supertech says, I scalp with AI now to really automate and control my exposure and exits. That's really dope. What kind of information does that AI kind of execute for you? Is it more like levels? Is it more indicator based? That sounds pretty cool. We'll have to look more into that. Thumb Wars, that's how I get the movie I made. Yeah, no, Thumb Wars. Shout out to Thumb Wars. But no, quickly, before we get too far off track, I really want to check out how some of these other futures markets are moving. I want to check out copper, but I'm blanking on the ticker. If anybody wants to throw that ticker out for me. Was it HG? I think it was. No, maybe it was. It says it's the AI executing the trades or only on signals. Yeah, curious about that as well. And in order to scalp, the underlying must be bouncing. Yeah, I think Frankie makes a really great point there. I think that volatility within the price is going to be really important. HG, appreciate you, Frank. Thank you. Thank you, guys. Appreciate you, chat. Thank you. /HG. Let me see what we got here. There we go. We got some copper futures there now. Right now I'm on the daily chart, so each candlestick is going to represent one day, just to give a little bit of context as to what we're looking at. But no, it looks like there's a little bit of a lack of volatility in these copper products. I don't know how you guys feel about it. /MHG is the mini. I need to double check on what that point multiplier is for copper as well on the futures. Again, I've never traded the futures on copper, at least. MHG micro copper. There we go. We'll start taking a look at it. I mean, it looks like a product that seems pretty feasible to swing trade, at least. It doesn't seem like it has, definitely that level of volatility like something like NASDAQ has. But I mean, just looking at these ranges as I go into the hourly chart now, and then as I go into the 5-minute, no, the volatility is definitely there. Just definitely moves in a different point range than something like NASDAQ. But what do we got here? USA Supertech. Predetermined deltas, IV differentials. I built my own app that has an MCP connector I built for Tasty's platform. It calculates limit prices based on P&L entries. That's really dope. From what I hear so far about that as well, I think what I like the most is how it calculates everything on order entry, right? Like, especially whenever you're scalping something like futures, right? You kind of have to set up that risk to reward yourself. You kind of have to set up the entire trade idea, right? Whenever we're using something like options, if we sell an out of money vertical spread, if it's defined risk, our max profit and our max loss is already defined for us. So we kind of already know the parameters for the trade. But when it comes down to the futures, I think automating something in that realm, it will be interesting, again, because of the fact that you kind of set your parameters for whatever that trade might be. So with that being said, if anybody is exploring with AI, always feel free to put your thoughts out there, because I think as the industry develops, it's going to be really cool to see how traders, especially retail traders, get really creative with the tools that we have at our disposal. But with that being said, speaking of tech, speaking of tools, we've seen a little bit more volatility in Tesla. I feel like Tesla's been pretty quiet lately, trading at 341 right now. Very low IV rank. About 11 million shares traded on the day. I don't have any data pulled up in front of me, but I could imagine that Tesla is trading at lower, volume levels than it was used to over the last couple of years. But it's looking like we had that gap down potentially off of earnings to around 340, sold off to a low of 297, now trading at 341. So this little bounce from the downside that we have had hasn't been anything too aggressive, but I mean, that's still a pretty decent range for a trader, right? I mean, 297 to 341, that's about a 40 something dollar range to still take advantage of there. Let's see, we got in the 1-minute chart also when scalping 100%. Sergio, Frankie, have you ever used Sierra charts? I've actually used Sierra charts. except for the one that's on the active trader page. No, I'm just kidding. No, I actually think Sierra's pretty solid. I think it's a solid, more so order flow based software that I think they're one of the ones that's kind of been in the space for quite some time. So it's kind of got a very retro look. It's not one of those up to date kind of platforms or pieces of tech, but I see what they got going on over there. But yeah, no. Speaking of some of these memory names, I know that SanDisk is up on the day, and I'm curious, anybody that's in chat right now, how are you guys looking at some of these memory names right now, and are you guys positioned in it? I know we have a little bit of short delta on in things like Micron and INTC right now. I almost wish I wasn't in those short positions because today looks far more attractive for some potential short delta on something like SanDisk, but we don't want to overexpose ourselves to the downside either. Apparently BYD is Boyd Gaming. Gotcha. BYD. Yeah, we can take a quick look at that as well. Yeah, that one's gonna be Boyd Gaming, trading at about $82.50 right now. Yeah, and I see some really good conversation happening in chat right now, right? Like Frankie pointing out that it's good to point out that paper trading doesn't always give you real fill price, 100%. And especially if you're somebody that's a scalper, right? If you can find, right, Tasty, we don't carry paper trading, we don't carry that kind of function, but I think paper trading is a really great tool to maybe test strategies, right? Potentially automate strategies, at least get an idea of what you're doing. But Frankie makes a really good point about the fill price, which I think makes a massive difference, and I think even more so for a scalper. Giving up an extra 5 to 10 points for a scalper just because you're waiting on a fill, or maybe you get slipped on the fill, is going to make a huge difference and will definitely skew the data and stats after you run something like that. What's the Chinese car company? I forget if it was what was it? I think it started with a Y. But let's quickly go to our watch list and check out these oil products very quickly. I'm gonna go to the natural expirations. Yo guys, Mikey Butler actually had a really good video breaking down contango and backwardation, and really just going over it was a refresh, right, kind of video on some of the knowledge you might already know. But he had a really good video out on the channel about the contango and backwardation and how you're gonna be more likely to see, right, that curve go from contango to flat, then to backwardation before we get any type of significant sell-off in the market. So if anybody's kind of on edge about a potential sell-off in the overall market, I would definitely brush up on a video like that, because I think it provides a lot of context as to what the market is actually pricing in, and I think can give you a little bit more insight. So right now we're looking at the oil market right now, and it's looking like we're still in backwardation. Because this front contract, right, is trading at 82.72 right now. The very back month contract is trading at 73.62. So we can kind of see those nearer months trading at trading more expensive, than those further months out back. So that curve is pretty easy to visualize on the oil markets. And then when I go back to the vol watch list, you can kind of see how right now we're trading in contango on these volatility products. Is there any way to transfer old drawings from an old desktop to desktop beta? That's a really good question, Premium Decay. I'll ask around to see if we can get an answer for you, but that's actually a great question. That's a great question. Because sometimes, right, traders have their charts marked off, and it takes a lot of time sometimes to do the analysis on your charts, so you don't want to have to redeploy that same exact analysis on the new program. So I hear you on that. Rand said doing great in SPX 0 days again, $500 in winnings so far today. Took the 25% limit in the last round. They've all chimed in together. Very nice getting back in. Good stuff, Ranch. Love to hear it. Ranch taking advantage of the 0 DTE SPX options, which we've seen, an explosion of volatility in those type of products. What else do we got here? And lastly on that conversation, I know Alex was saying, I have a slippage model in the back test and paper forward test. No, that's amazing, and we love to hear it again. You know, we're all in this trading community together, so it's always nice to hear what other people are working on, you know, what they're building and those kind of things. But we are coming to a close here, guys. Just a quick wrap. We are still long on oil. I'm hoping we get some type of headline. I don't think Trump is going to make it easy on them. I think he's going to... I know he's made a couple comments in the past already talking about how, you know, U.S. consumers are going to need to handle or, you know, kind of deal with higher gas prices for a little bit longer, you know, to keep nuclear weapons from out of the hands of Iran, you know. So he's really been touting the same sentiment. So I'm hoping we see a little bit more follow through here, even though the headlines have been pretty wishy-washy. But we're coming to a close here, guys. These are some of the trades that we had put on. We will be back later today, but Ranch, Point, Base 8, big deal. Premium Decay, Alex, appreciate you sharing everything with us. Ryan, guys, thanks for hanging out for a little bit. We are going to be back here with some more amazing content, and we do have more trades of the day coming on later, so we'll talk a little bit more about the new trades that we're putting on and how we're managing the trades that we have on right now. But again, appreciate you guys. We'll catch you guys here in a little bit. Be sure to stay tuned, and we'll be back in a minute. You're watching Tasty Live.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
In the world of investment.
Hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on
futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than trade like a trader? Tasty Trade.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
What is going on, everybody, and welcome back to Futures in Focus. Today we are joined with Glen. We're going to talk a little bit about this Forex market, see what's kind of been going on in the market. I know last time we had briefly touched on the yen, and I think since then we've seen a little bit more volatility in there.
Yeah, it's definitely been an interesting one.
Yeah.
Probably if you're trading it actively, not as interesting as you'd hope. Here starting the week here, we're looking at dollar yen in the spot market around 159, and that level we've been stuck at for the better part of a week. And
is that a good or bad thing, or does it depend who you're asking?
It's not normal.
Okay,
so
unusual.
It is unusual, and a guy like you who likes looking at the tape action, I think would find it fairly interesting because we've not only been consolidating in a level of about 50 pips. So in the spot Forex market, that just tells you the kind of decimal to which traders are looking for. And 50 pips in some pairs is around average volatility. 50 pips in this dollar yen is actually about half of what we see on a normal daily basis.
In the yen.
Exactly.
Okay.
Right. So this dollar yen's been pinned between 159.50 and really 159 flat. And if you dig a little further, you've seen that this chart, dollar yen, meaning if it goes down, the yen is strengthening.
Yeah.
Any kind of run with some momentum nearing 159 to the downside has been bought up almost immediately. Here I'm looking at hourly candles, and this can take place often, at 6 a.m. or 3 a.m. around the European Open. So less tradable for us U.S. traders unless you get no sleep like our good friends Chris Vecchio and
we got a couple night
Ilya.
owls.
Yeah, they're all on it. But we've seen that behavior be the most aggressive in the space, but really losing steam around 159 half. So that's a market that absolutely. I mean, if I had to put a guess for the week ahead, was just that regardless of direction, it would be very rare if we are still talking about this dollar yen at 159 on Friday. So it's a pair I'm absolutely looking for this week. But overall, we're meeting this Monday morning with some dollar softness as it clears way for some greater risk sentiment, but still a bit of a bid, a bit of a floor in it, as a lot of the geopolitical stuff far from settled.
I'm gonna ask you about that too. How sensitive are these products to a lot of the geopolitical headlines? Like we know oil on a scale of 1 to 10 sensitivity level, about a 9.5, pretty high.
Yeah.
What about for some of those products? Have you noticed?
Yeah, it really depends on the mood. As we've seen, when crude oil gets interesting around some of these bigger price levels, that's when it starts to seep into all asset classes. U.S. dollar being one of them. But right now, we've really seen the dollar move on a rate sensitivity here for whether rate hikes are in play or not for the rest of the year, and by extension, how crude oil fits into that is just on this kind of monthly cadence of, is it still an inflation concern? Or do we have it, or rather, under control? Now, sitting here today, we've gotten the latest inflation report that had a crude oil throughout July around this level, ticking up from definitely $60 a barrel into the 70s. So this is looking a little tolerable, but absolutely sensitive to price shocks to the upside.
I gotcha. It's nice to see volatility in some of those markets there. Do you think this conflict might be I guess, prolonged a little bit into the later months of the year? You kind of just like, you kind of just over a lot of the headlines and just waiting for some type of decisiveness?
Definitely over it, but what you can say is when you're looking through the lens that I am in this U.S., but also to an extent, speculation, and people very willing to get into metals markets, gold, silver,
And no,
and beyond.
gold's booming. To my dismay right now, though, I'm long bonds right now.
Okay.
And a wise man once told me when bonds are down, they're a buy. And the dip dipped and the dip kept dipping, and I'm in the dip right now. So I'm hoping to see a little bit of a pullback in gold so that we could see a little bit of a recovery in bonds. But it's kind of been my story the last 3 to 4 days.
Yeah, absolutely brutal. But I mean, you do have solace, like some of these yen traders as well, where you do know there's a level of hurt in which not only you are saying, please stop the bleeding, but the federal government is saying, please stop the bleeding.
Good point.
You have
Not
some
alone.
stronger demand, just might be at lower levels, might be a little bit more pain ahead.
A little bit.
What are you excited about this Monday morning?
You know what? I've really been keeping an eye on oil lately. I think over the last couple of weeks, I've been long oil around 74. So I've kind of just been hoping for a little bit of continuation.
Well done.
Because it's kind of one of those trades where if it reverses on me and I don't close it out, I might be able to close for a small green, but something like that being so far into the profit would sting a little bit if it comes back on you. But I am looking for a little bit more continuation. So since there's a pretty decent cost basis, I'm going to give it a little bit more tuned, a little bit more wiggle room to see further upside if we get it. But it's so reliant on headlines and whatever's happening. So we're kind of just in the void of uncertainty for oil at the moment.
Yeah, but reassuring sign for you, especially that we've been able to hold around $80 at least time and time again. The fluctuations getting a little bit more muted
Getting a
there
little bit,
recently, but not seeing a big shakeout that would absolutely hurt your position. But yeah, good on you, because it's been a market that you need a little bit more conviction to get in.
Definitely.
Every price level looks like middle of some range recently.
That's a good way to put it.
Your floor is someone else's ceiling.
Yeah.
But good on you.
What else? No.
Yeah.
What else you been excited about?
Crypto's holding in.
Yeah. How do you feel about that? What's the sentiment like? It feels like it slid into the land of irrelevancy for a little bit, but a lot of the time that's where opportunity is also at. So how are you kind of viewing things over there?
You're absolutely right. But this is also a market much like gold.
Is this time different?
You need excitement. You need that kind of institutional demand that now we've had from a product set perspective in terms of ETFs and other kind of packaging, the ability to support a big inflow in demand. It just hasn't been there.
Yeah.
You still have the sailor troubles of forced sells. But in spite of it all, and in spite of all of the rate hike kind of speculation, has held in, especially just looking at Bitcoin. But
are you still bullish though overall? Like as a Gen Zer, are you still bullish on crypto? Your perspective from your generation, generation.
I would say as long as the people that are smarter than you and I keep working on actual capabilities and developments using a lot of the blockchain technology, I don't.
That's a key word right there, blockchain.
Yeah,
There you go.
I definitely don't think the use cases are all dried up.
Yeah.
Whether that bleeds into direct token prices, definitely not one to one.
Yeah.
But I definitely still see a future for crypto in the world.
Just a one-off question, not to dive into the crypto realm, but like, you know, with AI getting so developed and like us questioning certain things and if this is real, if it's not, when it comes down to verification, do you think that the blockchain could help step in when it comes down to public verification of having a public ledger to be able to identify the authenticity of any type of digital IP, whether it's a digital asset, whether it's a whatever it might be that's digital?
Yeah, that's such an important question, and one that has absolutely both answers.
Yeah.
And it just depends on kind of what I was touching on earlier is, are people still working to defend it and make sure they're on the right side of this?
Yeah.
And I think the answer for now is yes. You can see kind of the defense of the quantum kind of shakeout, like, oh, will quantum be able to crack all these verification protocols and render crypto
It is a good
obsolete?
question. Yeah.
There's at least been some defense of that.
Yeah.
And so as long as the technology is able to stay on the side of relevance, then I think there's not a huge risk that it gets circumvented entirely. But we're moving at a speed that we've never
insane.
seen before. So
No, it's insane.
anything can happen.
Yeah, it almost seems like it's like a self-fulfilling prophecy. I feel like most things is kind of a self-fulfilling prophecy. It starts with a belief, and then that belief kind of comes to reality. Curious about it. We'll see what happens over there. Again, I know it's been really quiet in the crypto world, kind of just been consolidating around 60,000 right now. So I'm a little bit hands off, but it'll be nice to see a little bit of follow through.
Yeah, the nice part is with ranges historically as big as they are, I don't think a prudent trader is missing out on the generational wealth or anything by waiting and biding their time, and not a huge risk to reward on being early.
Yeah.
If and when crypto comes back. But we know from the countless studies that volatility in assets like crypto historically have been positive for the asset class. And in this stage of muted volatility, unlike what we've seen before, it being supported and not falling through the floors.
Yeah, it's a good point.
I think is absolutely a good sign.
It's a good point. It is always just interesting to hear like the excitement and tenacity for things like Bitcoin when it's at 129 and it's just like crickets at 60. It's just like human nature. It's like it just plays.
So odd.
It's over and over again, and whenever you see it, it's fascinating every time. Like I get it. Like I feel it too, but it's interesting to see from an outside perspective. Volatility right now trading at 15. Had a little bit of a gap up in volatility over the weekend. It was getting pretty muted down here. I know at the lows of last weekend we were trading at 14.18 on volatility. I was like, yo, are we gonna get to 12? Like, what's going on? Like, it's getting a little too quiet. You know what I mean? So we'll see if we get any type of expansion there soon, but hoping for it. But no, outside of that, I know some of the trades that, again, we're looking at oil, micro NASDAQ. I got a little bit of short delta on an Apple. I feel like that's been a name that has been a rock star, like kind of surprising everybody. But, you know, behind closed doors, they're trading at an all-time high, seen its first gap down into earnings. But I mean, amazing year for Apple, even though it feels like they haven't innovated in the last 15 years.
Well, that's what's funny about it is Apple has been able to be on both sides of, being outside the AI supply chain is a bad thing. Oh, it's actually a good thing. We're diversified from a giant collapse when all of the AI names are taking a hit. So the greater picture, who knows? But I think you can trust, or you have been able to trust the leadership of Apple, but that's where you get into a bigger picture because a lot of their senior leadership is leaving.
Yeah.
I know if I had Apple money for the past 20 years, I would be out of there too.
Would have been out of there. Yeah, would have been out of there yesterday.
So don't blame any of them. But yeah, so is this kind of run of muted volatility right around 300 to 310, is that something you're starting to get interested in, or do you see sticky here for longer?
Oh, on Apple specifically?
Yeah.
I'm hoping, to be honest, I'm just hoping to cool down off of the momentum to the upside. So sold an out of the money call spread. So even if we stair step down very slowly here, that'd be nice. It'd make you feel more comfortable within the position. But even if we kind of just move sideways, it's just nice to pump the brakes a little bit here. Let's see if we get a pause of that volatility to the upside. But yeah, no, looking at Apple here, seems like they're too big to fail, from a macro standpoint, because they're absolutely crushing it. They're killing it. Other than that, also keeping an eye on things like Microsoft, got a little bit of short delta on in there. But something that I've been trying to get on some short delta is these memory names. And look, I don't want to be the one to step in front of this train back to the upside, right? Every bear has been licking their chops, right? Like on these names.
Or wounds.
Or wounds. Both. Licking their wounds and chops. Without the bears, we probably wouldn't have even got to this point in a lot of these names. But I could imagine, right, seeing that first real pullback in these memory names, I could imagine that they've been kind of stalking this, waiting to get on a little bit of short delta. Maybe I'm just projecting right now, because that's kind of what I've been doing. But we've seen that momentum back in those memory names over the last 3 to 4 days. So, again, I will say Leopold got liquidated at the bottom of this move. Legitimately, he was the bottom. That's tough to see memory names back up like nothing happened.
Yeah, I mean, there's got to be some downside for being able to control that much money. So,
hey, 80%, that's pretty solid.
He's all right. In your mind, when we're thinking about tech stocks, specifically AI, memory, what have you, are you coming into this week looking at single names, or is this more of an index week for you? How are you thinking about NASDAQ as a whole, or
you know what?
Other indices?
I think that the indices are in a really interesting spot, right? Because we've seen one of the larger divergences between both of those assets, S&P and NASDAQ, than we've seen in quite some time. S&P is continuing to put in an all-time high. The Qs and NASDAQ trading just below its all-time high. So I know for me, the big question has been, is QQQ going to catch up to SPY, or is SPY going to catch up to QQQ and kind of get closer to that, not a direct one-to-one correlation, but get closer back to that correlation that it usually trades at. So I think for me, it's been about just keeping an eye on that overall narrative and at the same time managing those individual underlying positions. And I guess that's not really an answer. So I guess it's more so sitting on my hands and managing what we have on right now, because of the fact that I have that uncertainty between both the indices. So it's made me a little bit more cautious on the individual underlyings, at least. And I mean, I say that as I have on like 7 live positions, like 8 live positions. But no, we have been doing trade of the day a little bit more often. So I've been getting on a trade a day. So it's been causing me to do and stay up and more management with a lot of these other positions on a day-to-day basis.
100%. I mean,
yeah, that's how we're coming this week so far.
Yeah, it's tough. Volume still a little light. Looking at ES futures, micro NASDAQ over 1 million, but on the indice level, still a summer month for sure.
Yeah.
So hard to maybe that's easier to play range trading on the indice level, but that's been, if you've been burned there, you remember. So takes a lot of conviction.
No, it does. I mean, there has been such a lack of volatility. I mean, I'm on the daily chart right now on micro NASDAQ, and you can kind of just see that such a small range that it's put in today alone, even last Friday. And I'm still surprised we haven't really seen much follow through, I feel like, from CPI last Wednesday. It was pretty muted, right? Monday, Tuesday last week, we had an inside day, which isn't rare to happen, especially given we have a binary event that Wednesday that the market is sometimes waiting on. But post CPI, I was expecting a little bit more follow through. Still not much follow through. Still a lack of volatility in the overall market. So coming into this week, been the same story. And that's all I guess I have right there for the NASDAQ. It's a lack of volatility lately for sure.
Yeah, but I guess much like Bitcoin or anything else we've been talking about, its day will come.
Yeah, its day will
when it's back, and
will.
It's just a question on whether you want to be positioned before that or capitalize on momentum after the fact. But yeah, it's a wonky market out there.
It is a wonky market. It might be another inside day. We're kind of trading at where we or near where we opened up at today so far too. But But I mean, other than that, some of the memory names, some got a little bit of long delta on in bonds, got a little bit of short delta in the semiconductors and SMH, that ETF. App Lovin had earnings last week, had a pretty big gap down. This has kind of been one that makes you feel like you're catching another falling knife. And I got to say, speaking of falling knives, it's funny that when I say falling knife, I think of SpaceX. SpaceX has finally seen a little bit of a recovery.
Oh, they're so back.
First rally, so back, like nothing ever happened. We're almost at the IPO price, 150. How are we feeling about that?
It's pretty funny. I have just thinking of my short-term memory. I have completely wiped the moves up and down the whole first week of trading, and now it feels like that SpaceX is very strong, but it is important to remember that lens of, oh, this was once priced at $200 a share, and yeah, this is
$225.
Yeah, this is much less, resurgence as still finding its fair market value. I'd say
it's been in price discovery mode the whole time. It felt like
100%.
Yeah.
But have you been keeping a close track of options in here? Is volatility?
I mean, a little bit. So I had sold an out of the money put spread. I think I'd sold like the 135 strike or something like that. I was like at a max loser within 48 hours of putting that on.
Yeah.
So when that went to break even the last couple of days, I took it off immediately. I think I made like $10, and it was like the best trade of the year for me.
So back.
It's just like a max loser turning to break even, or like $10. I'll take it, especially because SpaceX legitimately had like 12 consecutive days to the downside. So day after day, I was like, yeah, this thing's not recovering. But it did. It gave me a buzzer beater because I think those contracts would have expired by the end of this week. So it was nice that the pop came in time.
Very nice. And
Yeah.
from a psychological perspective, does that make you excited to get back in?
No,
or is
absolutely.
this-
Bro, one thing about I hate sitting in drawdown.
Yeah.
Like I rather cut a trade and reposition rather than just like sit in drawdown for a month. That's like the worst case scenario for me personally, at least. So it was pretty uncomfortable.
That definitely tests. I'm sure you feel the same way, or younger minds. That tests my attention span like no other.
Oh yeah.
Just can't stop looking at
Yeah.
it. So it's like I need this to be out of sight, out of mind.
Exactly. I'd open the portfolio each day. I'm like, I forgot SpaceX was in here, but I'm reminded of it. Next day, I forgot SpaceX was in here. It's the same red number, but I'm reminded of it. So shout out to SpaceX. And I would say, most traders, if you were getting long SpaceX around that IPO price of 150, we're teetering the line. So for the most part, if everybody's still holding those positions, you're probably just now getting out from underwater. So yeah, not an easy one to hold. You definitely need some diamond hands here. But if it wasn't for Elon, I probably would have been like, all right, I don't know about this. I was waiting on a tweet. We just never got it.
Happens.
Elon's been actually pretty quiet lately, I feel like, in just the headlines in general in media. There's certain times where he's definitely has more of a relevant presence, but now that I think about it, he's been pretty quiet.
Yeah. Sounds like he's trying to get in better graces with the
Is that what he's trying to do?
administration.
No. With that being said, I know we just got about a minute here left. Anything else that's going to be top of mind for you for the rest of the day, rest of the week? What are you most looking forward to?
Yeah, I mean, we've got a lighter macroeconomic calendar this week. We've got FOMC minutes Wednesday, but the latest CPI, PPI should have, outdone that. Any new information that would surprise broader markets, I'd say, would be to the hawkish side. If anything, would reprice a rate hike back in for September. Otherwise, base case is, carry on. Outside risk for geopolitical tensions. You're hoping for a little flare up
Just
from
a little
the
bit.
financial side. Nobody gets hurt, but if crude oil goes up, that'll be good for you.
Plus, get advanced tools built for active traders. Visualize profit and loss with risk analysis tools. And place trade in a single click. All of the best platforms for options trading, according to Investopedia. Tasty Trade.
Like a trader, Tasty Trade.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others battle up and ride that 1-ton ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
It's time to trade smart, post PDT rule elimination, and Tasty Trade tools traders need. The Active Trader tab's comprehensive market data is designed for rapid order placement in a single click, while bracket orders rapid order entry and bracket orders that let traders manage entry, hit target, and stop loss, all in one ticket. Tasty Trade.
Tasty Nation, what's happening? How you guys doing? Good to see you. It's been a long weekend. We are back. It is Monday, and guess what? We're looking at a trade of the day once again. It's always interesting doing a trade of the day on Monday because you're reflecting on the last week. In my case, sort of point is you got to wait for the right moment a lot of times, especially if the name is not, if you're trying to make a direct play, a little bit harder to. This is from the volatility newsletter that SIBO puts out every week. And look at this. I mean, 1 month implied volatility, XBX 11, RTEY 16, Russell 2000, Qs 18. When you're looking at internationally, you can see, in Europe, 12.2 12.6%. When you see the DAX, 12.9%. It's all fairly low. Even FXI, low volatility. When you look at cross-asset volatility, the oil in the form of USO, 20.7%. That's down the most over the past week. GLD, 21.7%. TLT, really low vol. IEF, which is another bond situation. The last three are all bonds. IEF, LQD, and HYG, all low volatility. So it's very low right now, right? And even when we look at the VIX, I mean, we know volatility is very low. So what do we do in this environment when volatility is extremely low? Even today, with a slight move to the downside in markets, you're seeing a little jump in vol, but that's as a result of the weekend effect, something that Jim Karsan and I discussed last week. As a matter of fact, we'll be on again today at 3 p.m. Central Time. Join us and watch that for Tasty Crumbs. But the weekend effect is in place when you're looking at VIX. It was low going into the weekend. We had a low of 14.18, and now you're seeing a little bounce back per day, but still 15 VIX. So where do you look? Well, like I said, I do have my eye on the healthcare names. I think that could be something very particularly interesting when you're talking about midterms going into later the year. I got a list made. I got a list made of high vol tech names that, sure, I could probably sell vol in right now, but I just don't feel comfortable doing it because volatility is fairly low across the landscape. Now, I could sell it in those, and I showed you guys that a couple of weeks ago when I sold a strangle in AMD. That worked out really well. As a matter of fact, at the time when I did it, the volatility that I sold, and this is crazy, September, it was a 70 vol when I did it about 2 weeks ago. You could see it's 57 now. So volatility in the single names has definitely come in really hard more recently. I was talking to a friend of mine this morning about the name LRCX, where it's like, yeah, this is a 39 IVR, it has no earnings. You're free to sell this vol at 62, but this vol has definitely been higher, and should things get crazy again, we could easily see, a 1 to 2% down day in the market at some point. I don't forecast it. I'm not trying to predict it. That's why I'm not short vol right now, but that's also why I'm not buying vol per se in a lot of places. So the answer is I'm going to go to something completely different. We see a day where Bitcoin is up. We've seen that trying to make moves more recently. You can see it seems like it's coming into a bottoming process here. At least it looks like to me, just from a chart standpoint. And I see some of the other names moving around, Ether, etc. So I have a list of different Bitcoin names too. MicroStrategies, of course, we all know about that. I've stayed away from this one, even though it has a similar pattern. I tell you, this is one to sort of, I think I'm waiting still, just because of the structure of the company, the way they do things. It's always a tough buy, I would say, and or a tough sell when things get going. It's almost like trading, USO. This thing really has it really sort of moves off of the strength and weakness, like times 3 in Bitcoin. And so I'm waiting on this one, but I decided to go with Circle. I decided that this is a name that looks a little bit better. We just looked at MicroStrategies, very similar chart to Bitcoin, as you would expect, and it's still kind of going through its bottoming process. I feel like this one went through the bottoming process, and now it's at the next level, and it's waiting for a little bit of a breakout, I would say. I don't say a big breakout, just because I'm playing it for a little breakout. How about that? It could easily have a much larger breakout, but I'm playing it for at least another move above 85 here, which would be the next level of resistance, I think. So I decided to take a look at the options here, and I actually forgot when it most recently had earnings, but truthfully, it doesn't really matter. I can see that it possibly has earnings coming up in October. Whether it does or not, I decided to establish my long position there, and a lot of plays in the book more recently, I've been getting long October. So we went with a crab trade. Now with these crab trades, remember, this is kind of similar to doing a butterfly, except across time to some degree, where you're doing the upper part of a butterfly, in this case, a call butterfly, where you're selling the upside and buying that further upside just to close off risk. But basically, that part is the part that I would say you want to, if you can push that to closer, that's a nice thing. And that's what crab trades do, right? So typically, and I think I did a 20-point wide. Say I was doing a regular 20-point wide butterfly, right? These would be my strikes. And this would be, how it would look. And if I'm going 20 points wide, the most I can make on this one, let's just say it's 345. The most I can make is $16.55, right? And I would have to essentially in this case, it's only 20 points wide, which, this stock can move if it gets going. I just referenced an 85 area that I'd like to define. But like looking at this, let's just take a look. You can see the stock would, well, just like for those, a lot of you understand this because you trade butterflies, but there's a few of you who don't. I mean, you're going to make some money on this, theoretically, if it starts to make a move up towards your middle strike, possibly $400, and that works well. But it's going to be slow moving. And again, these are all in the same expiration. So there's sort of a slow moving nature to this, because for every time these for every time you're getting a movement in the 75 strike, you are obviously getting an equivalent somewhat movement, even though it's further upside in the 95. And so my point is this 95 is not going to decay as much, and this 115 obviously won't appreciate as much, but the bigger thing where you make money on this trade is by the decaying of this 95 strike. But in the same expiration, that doesn't quite happen, right? The thing about the crab trades is you can be long further out October, which is probably a nice place to be right now as far as long gamma in something, especially if volatility picks up. You want to be long Vega for now. This is somewhat Vega, being a little bit further out volatility, long the October, and this doesn't succumb to the much seen vol crush in a 45-day type cycle. So we're long the 75 here. And then we're selling 2 of those 95s and buying 1 of those 115s. We're doing this in a nearer term expiration where you would expect, unless there's a huge quick move to the upside, you would expect for the most part that this is going to sort of decay while this is gaining in value further out in October. So that's why we kind of like a situation of doing the crab trade. This one worked out because I was able to put it on. Again, this is a 20-point wide spread. I was essentially able to put it on for $6.45. They actually gave me a little bit of a better fill. Now, again, we were looking at the P&L feel on the first one. This was showing you a P&L feel that would actually, the first time we were looking, it was up to around $400 or so with stock around 92 and 93. That was a nicer, definitely a nicer P&L feel, if you will. But the way that I'm playing this, and I expect it to play out, is that as this stock starts to go, as long as it doesn't explode to the upside, we're going to hold that value in that 75 call further out in October. And the 95 in September will probably not appreciate as much, if anything at all, if it moves in, somewhat of a slower manner, right? So, but overall, you always want to take things expiration just to really fully understand it. You can see here it's saying my max profit would be $13.58. Just let's take it from the standpoint, if I bought it for $6.45, then it's really $13.55. Again, it actually gave it to me for $6.42. And that's why it's showing $13.58. But this is, one way to play it if it's going to make a move, but not to completely explode to the upside, which would sort of go in hand with the kind of moves we've seen in Bitcoin. And make no mistake, this thing does move off of Bitcoin, right? So there hasn't been these crazy upside moves or downside moves in Bitcoin. It's been somewhat dormant, honestly, and volatility has been low, like much of the other market. But at least the other market had, some crazy time in volatility about 2 weeks ago. It's just calmed down in the doldrums of summer here. So I'm going to go with Circle. And I also look. You can also do a similar type thing in MicroStrategies. I did look at it. I just think MicroStrategies has a little bit more of an uphill climb, but you could go with something like this as well. You can go 20-point wide in MicroStrategies. Let's just say 120, 140. We could also do something like that. In this case, you're paying $7.14. Similar deal. I do feel like MicroStrategies can be a little bit more volatile than something like Circle, but you could certainly see a situation where MicroStrategies makes this type of move as well. So, I'm gonna back off on this one. I'm gonna say, I don't think I'll get filled at this level, and I'm doing this on purpose. I'm doing it for $7, $20 wide spread. I'm gonna put one on for MicroStrategies too for today. If I get filled, I'm moving away. Because again, if you put a similar position on in similar type of stocks, you don't necessarily want them at the same levels. You want to sort of layer into them, right? And so in this case, I'm doing a similar spread in MicroStrategies. If I don't get filled today, that's absolutely fine. But just showing you my thought process, I don't mind putting on a similar trade. I'm just moving it a little bit away from the market. So just in case these stocks end up falling today, we already see both of them up. If for some reason MicroStrategies drops about $2, I'll probably get filled on this spread. and that's fine. It's actually a little bit away, and obviously I'll be losing on the circle spread, but that'll be my entry point for a MicroStrategy spread. So we can get the P&L graph up here to round out this trade of the day. Doing a circle call crab. I got filled for $6.45. Of course, that's $645. You do feel like there's a chance to make some money on P&L FIO as this, if it grinds higher. Again, the most I'm going to lose on this thing is $645. And that's if stock completely tanks away from the 75 strike, or if it completely just explodes higher and it ends up trading well over 115, which is my upside call in September. That is essentially sort of bracketing off some risk for me there. But what I want from this is to kind of grind higher as we see some strength potentially in Bitcoin, particularly over the next 30 days or so, which is where the September options are and where's my short 2 calls are. And so you want those to expire worthless at some point. So if we get to a point where we get stock trading to 92, 93, and it's towards the end of September, I think I'll at least be flat, but possibly even making some money on this because that one call in the October cycle will be at least $20 in the money. So that's the play. Circle call crab. Trade of the day. Hope you guys are liking this. That's my trade of the day. I'm going to get you over to Mike for his trade of the day.
The trade idea for you in Home Depot. That's where I'm going today. And they have earnings coming out tomorrow, August 18th. Got about a 12-point, 13-point implied move here on a $340 stock. So really not too high of implied volatility. And we can kind of see that across the board when you look at the actual implied volatility, the raw implied volatility for the September cycle, which has 32 days left to expiration, and then the October cycle that has 60 days left to expiration. Both of those are around the 30% range. Actually, October goes below 30% to 28%. But you still have a high IV rank in Home Depot, and that is driven largely by the earnings report that's coming out tomorrow after the close. So there's a couple things I want to talk about specifically with Home Depot and the implied volatility range that it's had. I think this is a really important concept to understand when it comes down to implied volatility rank and the raw implied volatility. So this is a newish feature that you can add onto your charts on the Tasty Trade platform. If you go to indicators and then you type in implied volatility, you'll see implied volatility and implied volatility rank. I like to look at implied volatility and the range of where implied volatility has been, because IV rank is basically charting a 0 to 100 range of where implied volatility has been. But it just takes the low point and the high point. So one of the potential issues with IV rank is if you have a 30% implied volatility floor and a 32% implied volatility ceiling, or in this case in Home Depot, we literally have over the last year, or I should say year to date, we've got a high of around 36% in terms of raw implied volatility, the IV index, and a low of 25%. So about a 10% range, which is pretty decent. It's not too bad, but the 36% is going to be your IV rank of 100, and your 25% is going to be an IV rank of 0. So the more narrow that range is between your IV low and your IV high, you still get an IV rank reading of 0 and 100. So with just looking at IV rank, you don't see the actual range of implied volatility and where that's been. So with Home Depot, a 10% range from low to high is actually pretty decent. But when you look at something like Tesla, which has an IV rank of 5, the current implied volatility is 42%. And looking year to date, if we zoom out, we've had a range of 42% at the low. We're currently near the low in IV rank, but we've gotten as high as 55% and even higher late last year of 70%. So this is a much wider range, a 30 percentage point range for IV's change. So when you look at Home Depot, we're not seeing nearly as much range if you look all the way back to that same level. We've had 32% at the old high, down to 22, and then we're kind of sitting around this 5 percentage point range. Like we literally haven't left this 5 percentage point range for 3 months, 4 months. So
this is what I like to focus on. And I think this is something that we should have on charts when you're looking at IV rank and you're looking at premium selling opportunities or even premium buying opportunities, just looking at the range of implied volatility, because IV crushes and extracting premium from an IV crush is going to be much greater if you get a crush that's 30 percentage points from the high to the low versus a 10 percentage point range between the high and the low. So Home Depot, kind of a narrow range, and that speaks to the low implied volatility here that we see in these expiration cycles. All the same, 30% implied volatility or sub 30% implied volatility for any equity is very low. So I wanted to go in here in Home Depot and create a longer term directional assumption slightly higher. I went with the 350 strike calendar spread, and looking at the chart, the 350 area is kind of near the upper end of where we've traded, but we have gone above it, up closer to 360. We've sold off each time what we've hit that level, but I just wanted to give myself a conservative window to reverse from if we get a rally in Home Depot from earnings and beyond. So I went with a 350 strike calendar, bought the long option in October for about $1,000. That's typically my max in terms of risk on any type of trade, but I knew that I was going to sell something against it, which brought our total debit paid down to $750. So I went long at the 350 in the October cycle, and I sold the 4-day, which of course includes the earnings announcement that will take place tomorrow. And we're going to get all that premium out of this trade this week in terms of the short options value relative to the long. So when we look at this on the analysis tab, let's view the analysis. We'll isolate just the trade that I have on the screen here. And we can see I'm paying $10.45 for the long option, selling that option in the 4-day cycle for about 25% of the value. So over the next 4 days, I'm reducing the cost basis of the long option I'm buying that has a 60-day expiration cycle by 25%. Love to see it. Also, if we get a sell-off in Home Depot or a rally in Home Depot, ideally, we're going to be looking at a nice profit potential. If we look at the profit side, let's analyze that first, and then we can talk about the defensive maneuvers that I'll have in my back pocket if Home Depot sells off. But looking at this evaluate date, so we want to push this to Friday and just give ourselves the benefit of the doubt of, hey, if I hold this to Friday and I keep all this $250 premium, what is my max profit or theoretical max profit in the middle here if we get a rally to 350? Well, first of all, I'm going to have to crush implied volatility by a few percentage points. But looking back at the chart, I don't feel like I need to really crush this all that much, because if you see here, the low of last year was 22%. Recently, all of this year, we never got lower than 25% in Home Depot implied volatility. 27% in the end of June and 25% at the end of February. So if we are looking at 28.75 right now in this 60-day cycle, if I just drop this down to 25%, that basically encompasses most of the range in terms of implied volatility that we've been trading at this entire year. If you wanted to be conservative and drop it down to 22% or 21%, that would encompass basically all of the range we've traded in this entire year. So we can take a look at both, but I think bringing it down 3 percentage points is fair. And if we evaluate at that Friday date, this Theo graph assumes we get all this premium out of the short option. And if I crush implied volatility 3 percentage points, that brings me to 25.75. We're looking at about a $500 theoretical max profit with the vol crush, with the move to Friday, and getting up to 350. So nice return on debit paid. I paid $750 for this thing. That would be a great return on debit paid if we get an inside up move for earnings. Now, if we crush this one more percentage point, bring us down to 24.75, we're still looking at a $500 winner. 1 percentage point to the downside is basically bringing down my max profit 75 cents or so. But if we're really conservative and we say, hey, what happens if this thing goes down to 21% or 22% in the 60-day cycle, which is representative of a 7 percentage point collapse in implied volatility? This would bring us to the low of the year in terms of Home Depot's implied volatility range. This still gives us a max profit of around $330. So on the most conservative analysis, where we're crushing implied volatility substantially, 7 percentage points, bringing it down to the low 20s, we're still looking at a 50% return on debit paid if we get that rally. And our break even is basically like right where the stock price is right now. So I like this trade as kind of an inside up move type of trade. If we get that move, we'll be able to just close it. And even tomorrow after the close, or Wednesday after we open up the trade, if we get a window of around 350, I'll probably just close it. I don't need to hold it until Friday because we're going to get a vol crush in this 4-day cycle as well. So we'll see what happens to the upside in Home Depot. But just going through the analysis there, we can see we're still profitable even if we get a crush that brings us down to the level of implied volatility, or the range of implied volatility of where it's been. And again, if you want to add this to your chart, you can just go to the indicators tab, type in implied volatility, and it will just by default show you the chart of where the implied volatility 30-day IVX has been. And that's this number right here. If you click on the overview tab in the upper right corner, this IV index, 30.3%, that is where this is pulling from right here. 30%, 0.30 is how it's reading. But ultimately, it's just looking at your 30-day or near 30-day implied volatility, which is right around that 30.3%. So lots of information can be gleaned from that. I think from premium selling standpoint and a premium selling buying standpoint, you want to see some really wide ranges if you're selling premium. Tesla's a great example of a product that has really wide ranges of implied volatility. And if you're buying premium, you probably want to see lower ranges, or at least expanding ranges where you're buying at the low of the range for implied volatility, similar to like what we're seeing in Tesla. But let's talk about downside moves. So if Home Depot sells off after earnings, we will have the ability to manage this trade a little bit. It's going to be tough to see exactly how much premium we can get out of this thing, because if we get a sell-off of 10 points or so and a pretty big vol crush, that's going to kill my ability to sell premium against the long option that I would still hold. But we will have the ability to bring that to September. So I could buy back the 4-day. This 4-day option would go to 0 pretty quickly if we get any kind of sell-off after the close tomorrow for Home Depot earnings. But if we can, I'll still look to diagonalize this or calendarize this. Depends on how much premium I can get, right? Because I have this long option out in October. One of the reasons I wanted to go to October instead of September is because the implied volatility is in the 20s, and there's not much more implied volatility for another 30 days of time, twice the amount of time going to October relative to September, and only 5 points of a difference in terms of implied volatility here. So went to October instead of September, and you can see the September option is trading for $600. The October option is trading for $1,000. So it's not double the value. That's because you have a discounted implied volatility. And of course, going to October relative to September, you're going to realize less of a volatility crush with 60 days to go compared to this 32-day cycle. But I will have the ability to buy this back in the 4-day and roll to September. If I can roll to a calendar spread and this is still trading for like $2, sure, we can do that. Bring our basis down to $500 and just recalendarize. In a better world or a better situation, if Home Depot doesn't sell off aggressively, if it only sells off like 4 or 5 points, and I can sell this option, the 355 or the 360 in September for $1 or $1.50 or something like that, I would much rather do that, because I would arrive at a 10-point wide diagonal spread if I got into the 360 September and I've already got the 350 long October. This would get me to a 10-point wide diagonal spread with a cost basis of around $600. So well under that max width of $10 if we were to make that adjustment. But that's really going to be the defensive maneuver. We could also turn it into a crab trade. So my basis is already under $1,000. So I could get rid of the 4-day cycle short option and go into the 360 twice and then buy the 370 once. And this would get me to a 350, 360, 370 long call crab trade. And this is one way that I could get more premium to reduce cost basis more now that the binary event would be gone. And I can ultimately arrive at a 10-point wide crab trade for a debit that's less than $10 as well. So those would be the two defensive mechanics: selling the 360 by itself or selling the 360, 370 call crab component and getting into a crab trade here for a defensive maneuver for Home Depot earnings, but hoping for an inside up move. And if that happens, I'll just close the trade. Even if we get a big vol crush down to the low 20s, I'll be able to capture $300, $400, $500 profit there from a theoretical standpoint. But let's throw up the graphic. We can talk about this one last time. So bought the 350 call in October, much lower implied volatility there compared to September, and only a couple $100 more for twice the amount of time. So I'm always going to go to the longer term cycle whenever that is the case. Sold the 350 call against it for this week, 4 days to go. Total debit paid is $750. So that's my max loss if we go deep out of the money to the downside or deep out in the money to the upside here. Theo P&L around 350 at expiration on Friday with a big vol crush is going to be between $300 and $500. This one we're showing 483. That was with a 3 percentage point vol crush at Friday's expiration. So yeah, that's the trade. Again, if the market moves to the downside, I'll be able to hopefully manipulate this trade into a diagonal spread or a crab trade by getting out of the 4-day cycle, rolling into September. That's another reason to go to October. You give yourself that window from the 4-day to the 32-day that you can roll into. But that's ultimately the trade. Let me know what you think in the YouTube chat, and we're going to kick it over to E right now for your next trade of the day.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
What's going on, guys? Welcome back to another trade of the day. I know we had Jermal, we had Mike. Now it is my turn, and we're going to have some more amazing trades of the days coming on here in a little bit. But with that being said, I know volatility has been pretty low right now, so I want to put on a trade that's going to be able to take advantage of this potential expansion in volatility that we could see. I'm hoping to see a little bit of that potentially into this week, maybe into next week, but I really don't see us sitting down at such a low level on volatility over the next, well, at least 14 days. So with that being said, right now, volatility has been trading at about 15.21 today. The market is trying to stair step lower right now, so I kind of been looking at the cues right now. And I would love to see a little bit more of a pullback. And we're in a really funny spot right now because QQQ is just shy of its all-time highs, and SPY had already surpassed those all-time highs. And like we've already talked about a million times over the last couple of weeks, is we're trying to figure out if SPY is going to catch up to QQQ or if QQQ is going to catch up to SPY. So I'm hoping to see a little bit more of a continuation to the downside on SPY. As to why, I have a little bit more of a short bias right now on the Qs. So this is going to be more of a directional trade. This is going to be a trade that I will manage, I guess you could say, a little bit quicker than other trades, but we have been in a pretty tight range all morning. And if I go to this daily chart over here, I can at least pull up this volume profile to give a really good idea or a visual picture as to the current action that we've seen all day so far. I'm actually going to jump over to the micro NASDAQ. But I'm actually going to look at these QQQ contracts very quickly. But we've been trading inside a pretty tight range all day. I'm going to be looking at the August 4th, or I'm sorry, the August 21st, 4 days left to expiration contracts. So these are going to be expiring by the end of the week. And we're going to look at something out of the money, just looking for a brief pullback, a little bit of downside. This is going to be one where we'll have a stop loss on these contracts. But the 728 puts are going for 307 right now. We're trading at 732 right now on the Qs. This would be 4 points out of the money. Which isn't too bad. That's going to give us about $3.06 for a debit here, our max loss is going to be the debit that we have on in this specific trade. And I like this one, $300. Let's see, the 727, that's going to go for 278. I wouldn't look for such a large downside move, but this at the money or this expected move, 723 put is going for about $1.82 right now. So again, you can kind of see the pop is going to be a lot lower on something like that because it's further out of the money. But this is going to be more of a directional trade. So with that being said, we're going to look at maybe the 727. We'll look at the Qs. The lows on the day is going to be around 731. So we'll go 728. We'll go 727, 731. We'll go 728. Hopefully we get a little bit more of a continuation to the downside. There we go. We got filled there. So it's looking like we're filled at the 725 contract. Which one did I just? Well, 728. Just looking at these strikes right here. 28, 173. There we go. We're going to give that a little bit of room to work, a little bit of room to run. We're hoping for a little bit more downside right now. We are currently in a short position on a NASDAQ. So I kind of wanted to trail this trade right here. So we got short into this consolidation, really just looking for the day low. And then we could take that futures contract back off. But that also adds to that short sentiment that we kind of have right now. And I think this also reflects some of the positioning that we had on earlier today. We were already looking for some downside action as to why we got short the futures right here. But this morning we were getting short at around, and if I turn on the execution labels, you can see we were getting short around 30,238 this morning. One at 30,238. The other contract got filled at 30,246. We were up about like 300 something bucks down here at the lows, but we continued to reverse. And if you're looking at the tape, you'll be able to recognize there was a ton of aggressive selling that was getting absorbed down here at the lows. But what we were looking for was next time the market gets down here, if more aggression steps into the market, we might be able to fully eat through all those passive buyers, right? That might be sitting at the low. So that was pretty much the idea on the trade, but we didn't want to sit in any type of drawdown. So we cut this a little bit earlier for about 10 to 15 points of profit. And then now re-engaging kind of with that same idea, except we're at a different cost basis now, right? Earlier today, we were short at around 30,238. Now we're short at 30,178. So clearly it's not going to be the same type of trade and the risk to reward is going to be completely different. Because of course the market wanted to come and stop us out here, do all this shenanigans before then giving us that downside action in which we were originally looking for. So this 30,190 area has been the main culprit all day. I know right now what time is it? It's about 1 o'clock Eastern time. So we're finally out of the lunch hour. So maybe we get a little bit more volatility kicking into the market here now. But with that being said, we bought the QQQ puts, and if we get any type of legs to the downside, we're going to be taking those off. I spent about $300 on that QQQ put. So I'm not going to be overstaying our welcome on that one. And because this expires by the end of the week, whenever we do get that directional move that we're looking for, I think we're going to have to be pretty quick to take that one off. So again, just looking for a directional move. Right now, it looks like oil is continuing to head in the right direction for us, at least. If I come back over here to micro crude oil, we can see oil right now trading at 843. So over the last 4 to 5 minutes, we're getting a pretty large spike in oil. If anybody knows what headlines might be hitting right now at the moment while we're doing this analysis, let us know what's going on in there. But it's looking like specifically about 4 to 5 minutes ago, there seems to be some type of catalyst, or maybe it's just the flows finally kicking back in. But if we zoom out here, go to a 30-minute chart, you can see here we're filled at 74.33. So we're going to hope for a little bit more continuation to the upside. Something that I've also been looking at on this oil trade is the fact that on this point of control, we've kind of been hovering around or consolidating around the point of control. And I'm taking this volume profile from the previous swing high at around 93.70 to the current trading price, which encompasses that swing low at around 74.33 as well. So with that being said, when we have that range of data, we can see our value area high is sitting at 85.40. Our point of control is sitting at 82.21, and our value area low is sitting at 77.80. So we started to get a lot of consolidation around this point of control, which is the precise point in which fair value is at for that time frame of data that we're looking at. So now that we're seeing a little bit more of a continuation to the upside above that point of control, it makes me feel a little bit more comfortable to potentially see this value area high come and get tested. So if we can make it all the way to the value area high at around 85.50, that'd be great. And then from there, we'd really have to ask ourselves, do we want to get out of this oil position, or do we want to see if we can catch a further run to the upside? Maybe the narrative that we've been kind of stalking continues. Maybe you already do have an oil position on it. Maybe you want to start scaling out as we make higher highs. Right now, I'm long only one contract, so I don't have the luxury to be able to scale out. So I really have to be pretty decisive on if I even want to be in this position when it comes down to taking profit or scaling out of this trade. But the fact that we're now getting more momentum to the upside above that point of control definitely makes me feel a little bit more comfortable. So we'll be patient for that. But it does look like there's some type of catalyst right now in the market. I know we're just looking at the micro NASDAQ as well. Small trade that we have on in here right now. And if I go back to the 15 seconds, you'll be able to see we're trying to sell off towards that day low. And it looks like we actually swept the day low. So we can debate on taking this contract off. That's a pretty small scalp. But if we do get any more continuation to the downside, we definitely have some room to run. So that's just something that we have to negotiate with ourselves. And right now, if I pull up this volume profile, you will see that we're finally starting to trade outside of today's range. So we're kind of breaking outside of that value area low on the day so far. We pretty much had an inside day all morning so far. But getting a break outside of that value area low lets us know the market could see a little bit more directional type of price action. So I'm not going to be too stubborn on holding on to this short that we have on right now, because we also bought the QQQ puts that we could take advantage of if we get more of a pullback this week. I'm not one to just kind of bag hold my option contracts. Like if I recognize that I'm wrong on a trade, I'm just going to get out. I'm not going to hold it until it's at a max loser or I lose all the value on the specific contract that I traded. But with that being said, we're getting a little bit more continuation here. And again, at the same point in which we're seeing more follow through on oil right now. So we'll keep an eye on it. But again, it would have been so nice if the market if the market could have just reversed over here when we were scaling in at 30,208, right? We'd be up almost 100 points at this point if that was the case, but we'll take whatever the market gives us. Sometimes it'll stop us out and we can always re-engage with the same type of trade idea that we had already had that initially stopped us out of. So I think the key focus is just going to be managing the risk, because whenever we do manage our risk, just like we were forced to on this initial trade, it gives us the liberty to feel comfortable and confident enough to at least pull the trigger on this next trade. But if this were to have been a trade that we allowed to run against us, maybe too far, maybe it's getting too hot in the kitchen, and then we're like, all right, I'm down too much money, I got to stop out of this position, that next trade is going to be a little bit more difficult to get into. So we got our stop loss in. We're going to let this run for a little bit longer. We just took out today's day low. We'll see if the market wants to bless us with some further price action to the downside. I mean, if we had more than one contract on right now, that day low would definitely be an area that you could consider at least starting to scale out of some of your position. But since we've been in an inside day pretty much all day, it'll be nice to see a little bit more of a follow through on this current market. If we don't get it, we don't get it. But the risk is intact, so we have the opportunity to at least test that trade idea. So we'll update you guys on that. Again, if you have been joining us for Trade of the Days, this portfolio has been getting a little bit more beefed up because we're doing this consistently on a day-to-day basis. And right now we're long oil, got a little bit of short delta on in the micro NASDAQ, got our stops in there as well. Short delta on Apple, $5 wide, out of the money call spread, 32 days left to expiration. That's been working out pretty well so far. App 11, we've seen a little bit of a recovery in this underlying. This is the one that had a pretty large gap down post earnings. We're trying to catch a bid here, but that weakness remains so far. 32 days left to expiration. INTC was another put that I purchased with 32 days left to expiration. So we're hoping on, again, a little bit of a pullback in these memory names, whether that's in Micron, whether that's in SanDisk, just the whole sector as a whole. I mean, even if we start to consolidate, that'll be nice. But since this is a debit that we paid for this put, we are going to need to see a little bit of downside over the next month in some of these semis. So if we continue to rally to the highs, we'll have to manage our risk there. Microsoft doing really well today on the day, actually. Out of the money call spread there, 32 days left to expiration. Microsoft down on the day about 3%, just over 15 points to the downside. Maybe we can come and fill this gap that's sitting between 466 and 474. But I'll be sitting pretty patient here because even if we get, some type of consolidation, that'll still be conducive for this position. Short delta on in Micron, short delta on in QQQ, short delta on in SMH, and a little bit of long delta on in bonds. So we got a handful of trades on deck for us here. So we'll continue to manage. We'll be patient. We're getting a little bit more directional flows to the downside right now on NASDAQ, which has been really nice to see. So we'll probably be covering this position here soon. And then we're going to let that QQQ we're going to give it a little bit more time to cook. Maybe we get more fall through to the downside over the next 24 to 48 hours as NASDAQ continues to make new day lows as we speak. And makes me now want to quickly check out what this crude oil market is doing. Maybe we're getting more rips to the upside. Looking like oil still trading at that 83 kind of 50 range right now, near its highs on the day. So that's really nice to see. If I go out to this 5-minute chart very quickly, anything above this point of control, again, I'm going to start feeling it a little bit more comfortable, because whenever we get below this point of control on oil, that's when I start, considering, all right, maybe we're going to have to stop out of this position. Since we're so into the money on this current oil trade, we're not going to make this one stop at break even. We're going to make sure we secure a little bit of profit, but it would kind of suck to have to give up, half of this range that we've already put in, whatever the case might be. But I'm going to be paying attention to these levels of value here. This is going to be our value area low at 77, 76. If we get all the way down here, that's where we got to start having a different conversation about managing that trade as it's pulling back on us. But right now, momentum is to the upside on oil. We're gonna keep an eye on the micro NASDAQ position as well. With that being said, guys, we got Chris on the other line with another trade idea for us. So be sure to stay tuned for that. And let's see what Chris has for us. We'll catch you guys here in a little bit.
This is Trade of the Day. I'm Chris Vecchio. Did you guys see the retail sales report on Friday? It wasn't a good one, but it was bad enough that it may have changed the tone of this week's earnings reports. There's a lot of consumer-centric names due up in the days ahead. Walmart, Target, TJ Maxx, Ross Store, a whole others as well, Lowe's, Home Depot. We have to ask ourselves the question, was that slowdown that we saw in July in the retail spending report something that filtered through into the earnings of these companies? And maybe we should be looking for an opportunity in these names. Maybe what retail sales did on Friday was give us a little bit more vol to play with in a space that didn't really have much opportunity before that report came out. And you know what? That is my read on this situation here, because I was looking for opportunities in these earnings for this week. It's a bit of a thinner week. We're waiting for NVIDIA for the most part next Wednesday. And last Thursday, Friday, when I was checking out Target, Walmart, Lowe's, I didn't see anything I liked. But now here at the start of this week, we actually see that there's a little bit more vol around these consumer names. And so the trade of the day here, for me at least, is short iron condor in the earnings plays around these retailers. So we have 3 trades coming up here on the board. We're going to start with Target, we're going to go to Walmart, and then ultimately we're going to make our way down the board into Home Depot. Okay, so let's just start here with Target right now. The structure is a short iron condor, 4 days to expiration, using the 139, 144 put spread and the 165, 170 short call spread here. So mechanically, we're buying the 139 put, we're selling the 144, we're selling the 165 call, we're buying the 170. So the short strikes are 144, 165, longs are 170, 139. Okay, the total credit received for my trade was 171. So mechanically, this is a $5 wide iron condor. We typically like to use about $1.67 as our basis there, a third of the width of the strikes as a target for what we deem to be an acceptable trade as a risk to reward right now. So being able to take in $171 while risking $329, better than a 2-to-1 risk to reward, seems reasonable here. And it's sitting just on the bounds of the expected move for this week. You can see that the upside strikes, they go at $2.50. When you go downside, they only go into single digits. Market makers can do that sometimes. So we had to tinker with it to find the equidistant strikes on either side. But either way, I think $1.71 in credit around a market that has had quite the run up here. Maybe all the good news is priced in. Maybe it gives you a little bit of a pullback. Where do those short strikes lie? 144. That's going to take you below your 1 month moving average. And you could see here pretty much Target has not done a close below its 1 month at any point since early July. So if dip buyers step in there around 147, around the recent swing low, around 145.50, this could all work out just fine and well. Not too concerned about it. But so much good news has been priced in. So really, will we extend further in the context of having these retail sales that are showing consumers are under a great deal of pressure and sentiment's falling. No. All right. So break evens here on this trade, just looking at the quick math, lower break even is 144 minus the short put of 171. So it's 142.29. The upper break even is 165 of the short call plus 171. So $1.66.71. So target can move around after the earnings here. There's a little bit of wiggle room right now. It just needs to avoid a real break below the 142.29 or 166.71. And then this thing can make money. Max losses here are below 139 or above 170. So we have our target trade in. As I said, it's iron condors across the board here, which brings us to Walmart, because Walmart would be the second of those three trades. Another short iron condor, 108, 109, 121, 122. Short strikes of 109, 121. Long strikes, the wings of 108 and 122 to cap the risk here. So with a dollar wide iron condor, we'd be looking for something like 33 cents, as it were. Here, in this case, I was able to put this on for 35 cents. So that does meet the criteria. And right now, you could put this on for 37 cents in the market right now. But we talk about this being a decent risk to reward, again, or better than a 2-to-1, risking $63 to make potentially 37 at a 64% probability of profit. That all is very clean and well. We're getting more than a third of the width of the strikes. That's fantastic. And as it were, because it was at 35 cents here for me, $1.09 minus 35 cents brings you down to a break even about 108.65, and the same thing 121 plus 35 cents 121.35. Okay, so as long as it stays within 121.35 and 108.65, we could have something potentially going on here. Walmart's a different chart setup than Target, though. This has been a lot choppier here in recent weeks. It had a breakdown. I actually tried trading this at the end of May, going into June, thinking that we could get a hold at the swing level here in March, as well as, and we could scroll back, and we're actually just going to change this to a weekly real quick. This is the weekly uptrend from the low that we had here in April of 2025, right? Trump's tariff scare. And so, the idea was that maybe we'd bounce uptrend, swing low. It worked out for a little while, ultimately came in, crashed back. I did not take advantage of this initial bounce back to get out of a position that really was starting to look a little crummy. So this isn't like a revenge trade or anything, just Walmart hasn't been strong in a very strong tape right now. And we've known that background data has not been fantastic. Does that curb the appeal, so to speak, of traders piling too long or getting too jazzed up to the upside? I think so. Either way, though, this is smaller, this is tighter. Walmart is a very disciplined operator. Putting on my CFA charter holder hat here for a second, if you look at their balance sheet over the course of a number of years, they run a very smooth operation. Fewer hiccups than some of these other major retailers, especially compared to like a Target, for example. Fundamentally, it operates at a higher level, so to speak. But that's why I want to keep this tight, because if there is a miss, Walmart's not one that usually misses by a lot, and it could lead to an oversized reaction in what is a fairly low vol environment. The VIX is dipping below 15. Volatility across the board has come in. So I still like the short iron condor here. I just didn't want to go with $5 wide, $2 wide. I think $1 wide was plenty. I did put on 3 contracts though, instead of just one. So risking a few $100 to make what would be, a little around 110. And that's okay with me. But finally, I do want to go over to Home Depot. So all 3 retailers, different flavors, so to speak, of the consumer. Likewise, going out for those $2.50 strikes here, 32.5, 32.25 on the downside, 352.5, 355 on the upside here. Received was 96 cents credit. So on $2.50 wide strikes, we're looking for like 83 cents. And so if I can get 96 cents on a short iron condor, I'm more than willing to take that. In this case today, and the market is you to go in for the same strikes, it's $1.05. If you were to make a small adjustment here, you're going out to the expected move, maybe around 94 cents credit. Either way, it's still north of that 83 cents right now. Home Depot, very much like Walmart, hasn't had a spectacular chart here. And quite frankly, it's sitting equidistant in basically its summer trading range right now. So looking for a move to stay around the midpoint of that summer trading range through the end of this week didn't seem like an unreasonable ask. No one seems too excited about Home Depot right now. So 250 wide, collecting 96 cents of credit, 154 on the risk, risking 3 to make 2, even better odds than risking 2 to make 1. So happy with that little outcome there. Break evens 324.04 or 353.46, given that 96-cent credit right now. This is more housing sensitive. And obviously, that's a different read than Walmart, which has groceries in the chain. It's a different read than Target, which has groceries, but more about what are people wearing, so to speak, home furnishings. Home Depot is going to perhaps answer two questions for us in the coming days. Does housing-related demand stabilize enough to protect the downside, or because of the move higher in yields, the long end yields are going up, mortgage rates are higher again, closer to 7% than they are 6% at this juncture. Has that sapped the need for some of these materials? Or is it like a COVID era thing where because mortgage rates are going so much higher, people are saying, you know what, I'm stuck in my little bungalow here. We're going to renovate this thing. Mike Butler has talked about it on air, how he said, couldn't find anywhere else. And so why not just renovated the bathroom? Great idea. You go to a place like Home Depot or Lowe's for that. So there's an interesting read through there for me. They also have some idiosyncratic issues with their CEO. I got a note here from production. Ted Decker, their CEO, is taking a temporary medical leave. So anything on continuity management could play a role. Maybe Home Depot is a little bit riskier to play than Lowe's, which, if we wanted to play Lowe's as well without that idiosyncratic risk of management potentially turning over or a surprise announcement there that could send a stock reaction well beyond the expected move. Lowe's at 4 days to expiration here in those 2.5 wide strikes. I was trying to get filled on this. Have not been able to do so yet, but 202.5, 205, 227.5, 230, 90 cents of credit on that $2.5 wide strike. So clears the 83 cents threshold. Again, risking about 3 to make 2, near a 63% probability of profit. Check. Stock's a little bit softer here, but given the confines of what the trade's calling for, you'd effectively have to see new yearly lows for this to be wrong, or you'd have to see lows charge up into a place where it's breaking out to new multi-month highs that we have not seen in at least 3 months, because the last time we were through 230 was back in May. Hopefully this gets filled here. Maybe not. Maybe it gets filled at 90 cents right now, and we could take the other leg off. Still not. So let's get rid of you, and let's see if we can keep the other one initially in place to get going. But that's what I'm thinking here this week. We have a start of this week with not many catalysts. Volatility is exceptionally low. Right? Volatility being exceptionally low means you need to play your strikes a little bit tighter. You should play your strikes a little bit tighter. You don't need to. No one needs to do anything. But the math and history tells us, the research shows us that when vol is really low, you can't give yourself so much slack there because the moves can go one-sided very, very quickly. And with respect to that, Walmart has a $1 wide strike. We're looking at $2.5 wide strikes in other names. I did go around a little bit bigger when we're talking about Target here with $5 wide strikes, but that was the max, nothing like $10 or so. And given where these shares are trading, these are not $1,500, $1,700 stocks like a Micron or a SanDisk, for example. Either way, though, I feel pretty comfortable taking these trades. They're all defined risk. The sequencing of this, though, matters. And I think I want to talk about the calendar here for a quick second before we ultimately roll this off down to Ilya for his trade or trade idea of the day. My idea here is short iron condors and consumer-facing names reporting earnings this week. So not one ticker, but a broader idea. Home Depot reports tomorrow morning, okay? If Home Depot, for example, is down 5 or 10%, but it's only after there's a management update, for example, with Ted Decker, that to me would give me great confidence that Lowe's is probably going to stay pinned or lower within the range, but not break out of the range. Why? Because if Home Depot's own earnings, which has a very similar customer base as Lowe's, isn't jarred outside of an idiosyncratic issue, then Lowe's without that risk probably isn't going to face the type of management-related reaction after hours, unless they guide lower. But material personnel turnover is not one of the risks in the field to play here right now. So Home Depot, if Home Depot works, it's going to give me a little bit more confidence that Lowe's will work. If Home Depot blows out to the upside, right, and has nothing to do with management, they don't make no mention of text, still temporary leave, he's going to be back soon, yada, yada, and really it's the market reacting to the earnings themselves, then I wouldn't be surprised if Lowe's starts to move higher ahead of its own release. I might want to take off that position should it be filled, because the Lowe's earnings are coming up the next morning on Wednesday. So we can use Home Depot to help guide us, if you will, for what's going to happen with its counterpart in that space. Wednesday, if you're trading TJX, Target, those kind of go as a pair. And then on Wednesday, you have Walmart before hours. And then Ross Stores here, ROST, after hours, which is having a pretty negative day today, down 3.51% back to its 50-day moving average here. But doing something like a short iron condor in this name, keeping in mind the risk that we have right now, we're going, $2.50 wide. You could play this just to the expected move and maybe get around $1.28. These are not tight markets, though. The bid-ask spread here, 30 cents wide or so. Volume and open interest exceedingly low, which is one of the reasons why I avoided talking about it today. When you look to Home Depot, at least you have hundreds or thousands of open interest and volume in the strikes that we've been looking to operate in around here. So those are your trades of the day. Short iron condors, Walmart, Home Depot, Target. Their earnings are due up Tuesday, Wednesday, Thursday this week. Maybe we can use Home Depot's tomorrow to guide us for lows, whether or not we want to keep that position on or not, maybe add to it, widen out the strikes. But retail sales, Friday, it changed the equation. Vol a little bit higher in some of these individual names, even with the market vol continuing to press lower. Don't push on the indexes if there's no vol there. If you're a premium seller, look to where the action is, and that's in these consumer-facing names this week. Up next, Ilya Spivak with his trade of the day.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than trade like a trader? Tasty Trade.
There is a sea change happening for the US dollar. There's a sea change happening for gold, and it's all coming from what looks like a weakening of US consumers. That's where my head is at for the trade of the day here. We've, of course, been following this story really for the past several weeks, and we can go straight to the charts here. The idea has been that the situation is shaping in a way where we have a turn in Fed policy odds starting to echo across the broader markets. And as we've been talking about last week, the shift in gold was really the beginning, and now it is turning, finally, it seems, to the US dollar. Now, just to review here, we started looking at this as gold was finding a bottom through July and saying, well, how come this is happening at a time when the markets are speculating on rate hikes? This is not something that should be happening to gold. After all, it is an asset that yields nothing in real terms. How come it is holding up as well as it is right here, while, never mind nominal interest rates in the bond market, real yields are surging higher? This was that rise in July, an increase of close to 3% in real inflation-adjusted interest rates, looking at this TIP ETF, a basket of real rates across maturities, the TIPS ETF. But when we look at what gold did through that, it pointedly held up, as did silver, by the way. And the question, of course, was, why is this holding up as well as it is? are we in fact looking at the start of a rethink on these Fed rate hike odds? And indeed, the move has unfurled. So we started buying gold down here. Of course, last week's focus was adding into this position on the pullback here. That seems to be holding up for now, and we're going to look for the next leg higher to maybe look for another opportunity to add. But an opportunity to add has already presented itself on the currency side because, of course, the other side of weakening Fed rate hike odds, now at their most soggy since basically mid-June, looking at Fed funds futures, the likelihood that we get even just one rate hike this year has now declined to the lowest in 2 months. That's in the wake of retail sales numbers that were soggy last week, consumer confidence numbers that were likewise negative on Friday, the CPI and PPI numbers that showed weakness in core services prices where most consumers do their shopping, which can't be explained away by the digestion of crude oil influence on inflation thanks to the Iran war. So the market is catching on, and the rate hike odds are fading. The dollar has been slower to respond than gold has, but we seem to have something now unfurling. Now, when you look at this euro dollar chart, and I'm looking at spot here, but I have this trade on in a variety of flavors. I have it on both as M6E futures and as spot. They both offer a good amount of flexibility. I'm not using options. I'm using straight up long deltas in the euro here, just straight buying the futures, and also, of course, having exposure on the spot side. But I like these spot charts just because they're continuous. They're clean, they're smooth, lots of liquidity, of course, in spot markets. That's sort of where most of it is in currencies. And so you look at this and you get a good sense of what sentiment is. And so because in the platform here, we can just type in the currency ticker and look at the spot. That's what I like to use as my benchmark to set up charts and to look for opportunities. So you can see here, we have the euro as a kind of anti-dollar avatar that's attempting to break out here. Here was kind of the bounds of the decline since the beginning of the year, thanks in large part to that Iran war stoking those rate hike expectations. And so here we are. We're attempting to break through that. And it looks like we're trying to hold this range top. But if we zoom in even just a little on an 8-hour chart, we can see that the break has already occurred, and now we seem to be retesting. So this is an attractive setup for me. I got a little bit more long here, having already added some longs back here. I've added some more now to this. And so I've increased this position. Another spot in the dollar architecture here where you can look at something similar is the Aussie dollar, which has a very similar sort of thing occurring. And again, if we look at the daily, it looks like we're testing through what was an important level of former support now acting as resistance. And on the daily, it appears inconclusive. But even when you go to an 8-hour, never mind the 4, the break is already there. And so, again, the risk reward seems compelling. It looks like there's a bit of a backfill here. And so we might look at this point for a push to test the 72 figure here. So what I've done is I've added to this position as well. Now, of course, as this story unfurls this week, it'll be earnings reports from the retailers that take center stage. They are going to tell us whether, in fact, we are getting this kind of sogginess starting to happen for consumers. The story on the macro side is a little bit more constrained until we get to Friday. Of course, those FOMC minutes we get on Wednesday should be interesting to the extent that they tell us whether the Fed's reaction function to inflation from the oil side is picking up and whether they are, in fact, as hawkish as the markets thought, or maybe they're just biding their time. If it doesn't look like there's a sense of urgency there, that will, of course, encourage these ideas. That is to say, will encourage the dollar lower. It might encourage gold higher, silver too. But the big kind of cyclical number for the week will be the S&P Global PMI roundup. Suppose we'll call those numbers. They're coming out for the Euro area, the UK, but of course, most importantly in this calculus, since we're focused on the Fed, from the US. The expectation is that we're going to get a slight cool off in manufacturing, a slight cool off in the service sector, but the numbers are a little bit like tinkering at the margins. It doesn't look like we're going to get a big change. If there is, in fact, a downside surprise, and indeed, U.S. economic data has been soggy, as we've just discussed, for a couple of weeks, from the payrolls report to CPI and PPI to retail sales and consumer confidence. So if that continues and these PMI numbers come in soggy, you're only likely to see less of a chance that the Fed needs to hike rates reflected in Fed funds futures. And so all of these dynamics might get a still further push. So I'm adding to being long Aussie today. I'm adding to being long Euro today. But I'm also very much paying attention to, again, what's going on in gold and whether it makes sense to add more there. We're still flirting with this these highs up here. We're not really trying to make a push through them yet. So I'm not quite ready to add more just for now. And then, of course, likewise, if we look at silver, there I have a bit of exposure through a call vertical in SLV. And looking at silver here, it's a very similar story to gold. We can see we're testing the highs. I started to get long on the break of this range down here, or the SLV equivalent. If we take a look at the ETF here, where I have my call vertical set up, you can see where that break is down here. So I still have that on, and looking for that to continue. There's the break there, but we can see for now, we don't as yet have the kind of confirmation we would need to say this now level is overtaken. So I'm not quite in the market to add more here. We're still, if we look at the 8-hour, kind of jostling at the top here. So if we get the close, even on a 4 or an 8-hour basis, I might add here too for the next leg going into 65 or so, maybe even 66 on SLV. But for now, that is going to have to wait. For now, it's the dollar, and we're going to hold on metals. But certainly, if the price action gives us an opportunity to add some more, this looks like a trend that's developing. And so that's what we'll do once the price action gives us that permission. And that's what I'm looking for this week. I think so. Wanted to give you enough time for a break.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us. And so does Broker Chooser. So what else can we say? Other than, boom! Trade like a trader. Tasty Trade. Make your move.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Investopedia says we're the best for options trading. Stockbrokers.com says we're #1. And Broker Chooser raves about us too. So what else can we say? Other than, boom! Trade like a trader. Tasty Trade.
What's going on, guys? Welcome back to the show. We got a segment now live for the Trades Desk. And we do have a very special guest with us today. And I'm really excited for him because we've never got to hop on live together and chop it up, talk about the markets, talk about life. But we got... How was that? This is like a 2 out of 10.
There we go. Oh, that was...
I left a margin of error so that I can look a lot better the next time. You know, you got to...
Well, you did a great job of that.
Thank you.
I can tell you that much. We'll get it next time. But E, what's up? You're right. We've never been on together. So
yeah.
This is very fun. Very fun. What's going on? How you been?
Pretty good. Pretty good. I mean, I'm doing well. It's been pretty humid out here. That's the weather in the market. Volatility has been pretty low. So we kind of just been, I guess, hanging in there. What about yourself? How we been?
Yeah, no, good. I mean, that's a lot of what we're hearing from the customers that because vol was just so high for so long.
Yeah.
Right.
We're used to it.
Yeah. Right. And so a lot of our customers are generally premium sellers selling options, naked options, spreads, things like that. And so whether it's either equity options or futures options, right, that high volatility will help those strategies typically. And so, yeah, we've been seeing a lot of people, you know, are like, market feels a little sluggish right now. I mean, we just saw a bit of a move in the S&P just now before coming on here. But yeah, I mean, right now the volatility is not what it once was, like last week.
Yeah.
You know?
100%. Yeah, I mean, I don't remember the last time we were trading below a volatility of 15. So anything down there, it gets you also kind of on your toes a little bit because you're like, it's getting a little bit too quiet. Is there something around the corner? I don't know.
Right.
But that eerie sense you get when things are too quiet.
Yeah. Also, let me tell you, on Friday,
right,
I was getting a very eerie sense.
How
of
so?
The market. I was like, because especially for a Fridays and Mondays are usually our busiest day on the desk because Monday it's like, all right, the weekend just happened. Now we're ready to get trading again. Okay. And then on Friday it's like, all right, let me manage all of my risk before the weekend gets started.
You're getting a lot of calls.
Yeah,
Fridays,
that's
questions.
when we get the most calls are Mondays and Fridays
for
sure. And so, like, you know how, like, there's the whole, like, work from home culture where it's like, oh, like, I'll work from home Monday and Friday, extend my weekend a little bit, things like that. That is non-existent on the desk.
Okay.
Those are our busiest days, right? And so on Friday, though, it was a little quiet. I was like, are we like making money and stuff? I was like, what's going on? Are we still in
the lights
business
on?
here?
Right.
Yeah, right. And so it was a little quiet. Not a lot of questions from the customers. Maybe a lot of people on vacation as well. You know, that happens in the summertime seasonality, if you will. And so, I was like, like this seems
is
a little
off.
weird.
Something's different.
Yeah, exactly. But today, I mean, this morning on the trade desk, we were super busy.
Yeah.
Oh yeah. Right now it's a little bit better, but yeah, we were super busy, and I was like, okay, that's more like that. That's mean reversion.
That's normal. There we go.
Right there.
There we go.
You know, and so we didn't get a lot of calls on Friday. Now we got a ton of calls this morning.
Yeah.
I'm sure going into the close, it probably won't be so bad. But yeah, again, a ton of calls this morning, and that's exciting though. I love hearing that the phones are going on.
Is there any particular symbols that you recognize there's been more questions on recently, or is it usually the indices that a lot of the conversations revolve around?
Recently, it's been a lot of the like semiconductors,
really,
things like that. Yeah,
okay.
Your Microns of the world, your SNDKs, then a lot of the other tech names as well.
Yeah,
and, you know, we can get into it though. Top 20 symbols. Go
let's do it.
And their IVRs. We can get that pulled up here. All right, at number 1, we've got Micron with a 33. SpaceX with an 8, surprised that it's number 2 there. NVIDIA 25, Tesla 6, SNDK 32, Meta 30, Microsoft 30, AMD 30. A lot of 30 range in here, looking across all of it. Apple with 36, Amazon 14, Intel 36, GLD 33, RAM 29, Marvell 56, SLV 25, Broadcom 33, NBIS 44, Google 11, SOXL 47, and Palantir with a 12. 30s, not bad for the premium sellers. But I feel like those 30s last week and like earlier in the month last month, those 30s were like 50s before. And so there's been a lot of change recently with volatility just getting absolutely crushed.
You guys been getting any calls about SpaceX? We finally caught a bid in SpaceX for like the first time across the last 7 days. It was like a falling knife post IPO the entire time. Any conversations around that?
Yeah, for sure. Anyone who caught the falling knife, good for you. You know, like, because right after earnings, you know, that's a great job out of you if you did something like that.
Yeah.
But yeah, I mean, right when it came out, I mean, people were, and the days before, people were obviously asking about it. You know, when can I trade it? When are the options going to be listed? And I would say, I mean, could maybe ask some more, you know, experienced individuals, some more veteran people who have been in the market. But I would say this has got to be like the most liquid IPO for sure when it comes to options trading. Oh yeah, I mean, people were ready for the options right away. The options came out as soon as possible, more or less.
I think it was within what, 5 days, I think, of the IPO. I think the options were
I forget exactly. I think it was
pretty
maybe
fast,
like 3 days, something like as quick as could be.
Yeah.
You know, and it's on our top 5 like almost every day.
Yeah.
And so yeah, a lot of people are trading that, whether it's directional or like you're being neutral selling volatility. A lot of people are trading that because the premiums, like, they're just so high in SpaceX. Yeah, especially like right when they came out too, the premiums were just so high. And even like if you're buying the premiums, that just like becomes attractive to trade when you see a lot of volatility because that's where the opportunity lies, right? So been seeing a lot of customers trading that and asking about it as well.
I love it. And you're right. I mean, that's where traders typically view opportunity. It's in that volatility. So that's a really good point that you make there. Oil's been kind of ripping in one direction here now too. Do you notice that there's a lot of commodity trading going on as well, or is it mostly just a lot of like that Mag 7 basket of stocks?
Yeah, I would say it's really a lot of the Mag 7. We don't get too much. Like, I mean, obviously we had a lot going on with the metals, right? With silver.
I mean, that was like a one-off, right?
Yeah.
In your experience, I mean,
well, that was absolutely absurd.
I mean,
that was crazy.
I mean,
some of the moves in the metals were.
I mean, it looked like a meme stock, and that's gold we're talking about. That's a
like silver
value.
Oh, that's such a great point.
Massive
Silver
contract
looked just like a meme stock,
didn't it?
Which I mean, that's probably one of the biggest features out there.
It's a huge futures contract. I mean, I can barely even trade it. I mean,
yeah, right.
I mean, that thing is
even the micro SIL is still a big
massive contract.
You know, maybe CME if you're listening, maybe come out with another.
We need a nano. I think I heard the nano's coming around the corner.
Yeah, those are a little bit tough to trade though as well, just due to liquidity.
I could imagine.
Like that.
It's like a tenth of the micro.
Yeah,
the micro's already pretty.
Yeah,
pretty small.
you want to make sure to watch out for that when trading those types of products. But yeah, I mean, those are such big contracts. And I would say with oil too,
massive
right now, we haven't been hearing too much about trading, like people trading the metals, oil, things like that. Not as much. I mean, most of our business just comes from like the equity and ETF options. So that's what we're getting most of the calls about. Obviously, we have plenty of customers who trade the futures and futures options as well, but not as much as they once were, though. When it comes to like gold and silver and oil, not nearly as much activity right now.
I got you. I was going to ask you about the bonds. So I've taken my second bonds position. I'm not much of a bonds trader. I don't mean, how many Gen Zers, TLT?
TLT, okay.
How many Gen Zers are actually actively trading bonds? I mean, I don't know.
Not many.
We have the youngins trading bonds or?
No. Well, because like when it comes to the futures, ZB is another massive
Is it a big one? I've never traded it.
ZB might be the biggest product, actually. But yeah, ZB.
Larger than silver, potentially?
Yeah, I would have to do the actual.
I've never looked into it.
I don't know off the top of my head. Whenever we get Craig from the CME here, you could ask him.
Cool.
But yeah, ZB is a difficult product to trade. TLT, though, is interesting.
It's pretty manageable.
And it's volatile too, right? There's a lot of movement, especially with like some of the interest rate environment we're seeing right now. Where like, it's not actually 100% what the Fed's going to do. Usually, like we were talking about this the other day, usually with the Fed, it's like 99.9% of the time, like everyone's saying that they're going to either like raise it or keep it the same, whatever, like usually know what the decision is going to be. But like this time recently with the new Fed chair, it's been a little bit more 50-50, closer to that. And so it just makes it a more interesting market to trade interest rates and stuff like that. So yeah, TLT is probably our most popular bond product for options trading for sure. But it can
liquid.
The premiums are, they're not very large, the premiums in those options. And it's a smaller product. So when it comes to bonds, it can be a little difficult to trade because you're either trading ZB or, ZT, ZN, whatever, which is a massive product, or you're trading something like, TLT where the premiums aren't as large.
Yeah, it hasn't been too bad. I know as we step down here at lower prices right now in TLT, I know, gold has been on that rally the last 7 days. So seeing that rally to the upside in gold has definitely made us see a little bit more of a pullback in TLT. But yeah, to your point, it's a volatile product, but pretty manageable. It's cheaper, around $80, so not too difficult to get involved.
Yeah, especially when it comes to like the credit to buying power ratios for naked options. With smaller accounts, that's something a lot of our customers look at to make sure that like they're able to, collect a lot of premium, but it's not taking so much to like sell those naked options, right? So TLT can be good for that too.
100%. Right now, I do have a long zebra in TLT. So if you want to put in a bid on TLT for your boy, I'd appreciate that, Q. But no, I mean, other than that, I know we've had a lot of volatility in the semiconductors. I know things like INTC, Micron. I know Apple was one of those underlyings that has been trading at near the all-time highs that would kind of catch you off guard. I feel like this one hasn't been, I guess, socially as popular. And not to pivot too hard right now, but I got to ask every time I talk with somebody else, what is your perspective on the crypto markets right now? As in, I asked Glen a minute ago, right? It feels like crypto's kind of slid into the land of irrelevancy a little bit.
For sure.
Right? Not an answer from the trade desk guy. I need like Q.
I would say, from the trade desk, not a lot of questions about crypto.
I can imagine it's quiet right now.
Yeah. Once it fell from like the all-time highs, people were still talking about it like as it was, crashing, if you will. But when it comes to like people trading it now, not very much going on. There's not even a lot with like the smaller coins either. Like,
are you a believer though?
Yeah, obviously with like Bitcoin and Ethereum, it's just not as popular right now. Not nearly as much volume as we've seen in the past.
Like the crowds are attracted to volatility, right?
Exactly. Yeah, always.
No. With that being said, we are coming to a close here. Q, it was a pleasure, brother. Always really nice chopping it up with you, bro.
Thank you.
Of course. I'm going to get the D. Yeah, right. We're going to step that game up too. I'm going to get that in there. But with that being said, guys.
We start with a low bar.
So. You got to start with a low bar. Exactly. So whatever you do next is impressive regardless of the outcome. But that is going to be the show for live trades from the trade desk today. And with that being said, guys, be sure to stay tuned for more amazing content we have coming on next. You're watching Tasty Live. Oh.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Investopedia says we're the best for options trading. Stockbrokers.com says we're #1, and Broker Chooser raves about us too. So what else can we say other than boom? Trade like a trader. Tasty Trade.
Hello, I'm Tom Preston, and it's 1 p.m., and let's start trading here. But first, okay, our system is back up, running perfectly now, so you can see me, And, my complaint earlier was, hey, guys, I need a heads up when I'm not going to be on the video because I spend hundreds of dollars a day on a makeup team. And it's like, I could have saved some money if you just gave me a notice that the video wasn't working. Because, it takes a team to look this good, right? Anyway, so earlier this morning, I was talking to Chris Vecchio, and I got a vent about this. So I went to see the Odyssey with my wife and older daughter yesterday, downtown Austin. Yeah, I thought it was a good show. It was really, and I studied that stuff in school, so I translated the whole Greek stuff and all that. So I read it, and I kind of know what the story is. And basically, the Odyssey isn't the actual tale isn't that compelling. It's compelling in that sort of Greek heroic theme stuff, and it's great for that. But I thought, what's his name, Christopher Nolan did a good job at actually, turning into a story, using a story, or creating a story that used the Odyssey as a backdrop, kind of. And that's kind of how I saw it. I didn't want a faithful representation of what the actual epic was. But one of the things that disappointed me most was the scene with the Cyclops. And in the movie, you know, they stab him in the eye and he's shrieking. Yeah, 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 yeah. The actual story is a little better and somewhat more tragic. I think it is one of the tragic events in all of Greek literature where they get the Greeks and Odysseus, they get Polyphemus, the Cyclops, drunk, and they stab him in the eye with a thing. And I forget the actual sequence of events. Actually, no. What they do is they get him drunk. And in one of Polyphemus's weak moments, he says, "And what's your name?" And Odysseus says, "No one. My name is no one." Utis, I think, is the Greek word for it. And so they stab him in the eye, and he's shrieking. And they sneak out on the bottom of the sheep. And then when he goes outside, it's a little community of Cyclopses. It's a little town, you know. So the other ones come out and they say, "Who stabbed you in the eye? Who did this horrible thing?" And he shrieks, "No one, no one." And they'll kind of make fun of him. And they said, you know, "You should consult the gods for this insanity," that sort of thing. So it's really kind of tragic. And he's standing on the beach, you know, with the Greeks sailing away, throwing rocks blindly at them. It's really kind of sad. It's very depressing. One of the more depressing parts of that tale. Anyway, enough about that. So I missed my SPX Iron Condor this morning. I was offered at 290, didn't get filled. Okay, that's the way it is. Would have been a decent trade. The SPUs, the SPX is down 31. Nice little sell-off here. The VIX is up, as the Romans would say, mirabile dictu, marvelous to say, or, you know, just, oh my gosh, look at that. It's actually up, not nearly enough. I'm short the 16-17 put spread in there. I got 1 day to go. The VXX, I'm long a put spread in VXX. That's up today too. Still okay with that. But let's see. I don't know. Do we want to do a trade in SPX just for kicks? Just to strike a blow for old Polyphemus the Cyclops. All right, let me put it out there. Honestly, the Odyssey Woke version is a failure. Yeah, maybe, Cindy. Yeah, I mean, maybe. I think if you take it literally, I thought it was a pretty good tale. You know, with the you know, the whole killing all the guys off. You have to do that. But it is true that you can. The Greeks always thought you can't escape your fate. And hubris is the worst sin to commit. And so they missed some of the hubristic stuff that Odysseus got everybody into trouble with, but whatever. The Flipper said, thanks. And now I like that movie just a little. Yeah, it's okay. I mean, it's, but they got the dog right. Argos' faithful dog. He sees Odysseus walking up the path, recognizes him, lifts his head one last time and dies. You know, yeah, good for Argos. How's real estate looking? I don't know. Let's take a look. Well, all right. Are we bullish or bearish on the SPX going into the close here? What do we want to do? Bull, bear? Let me put it out to the crowd. By the way, I have the YouTube chat open. So if you have any symbols you want me to look at, any questions you may have that I can see with my one good eye, a la Cyclops, Polyphemus the Cyclops. Oh, Ryan, glad you like those videos. Yeah, we're starting to push out a whole, a lot of people talking about the changes. A lot of big changes have happened to Tasty Live. I get it. And see some new faces and all that. But we are getting a lot of new visitors to the videos, a lot of new eyeballs on this stuff. And I appreciate everybody's input. Bearish with the VIX moving up, the dog saw some recipe. Yeah, little Argos, poor little Argos. All right, so we're going to do a bearish trade. 0 DTGs. There's no unbroken butterflies. Did I say that properly? There's no. So if I load this up just for the sake of arguments, people, buy one, sell two, buy one. Come on, buy one. So $1.15 for that butterfly, for that Flutterbeak, and I drag it down 2 points. It's still a debit. They're just you just don't get the embedded. You don't get enough credit for the embedded verticals. By the way, I am going to do a video on breaking down multi-leg butterflies and the synthetics that you have inside them. So that will be coming hopefully this week. I've got some other things popping for this week too, but I want to get around to that because it's an interesting topic. For people watching the show who are already trading and know a couple things already. So let's just do, anybody else bearish on this stuff? T-Bot to the naked put D on G. Let me look that up. Neutral, bullish on XOP. Okay, let's take a look at that. Yeah, all right. Let's just do a bearish trade in this. Let's buy with these indexes 77.55. Let's buy the 67 $2.60. Let's ship it. Let's do it at 270. I think yeah, let's try 270. Submit. Not going to get filled immediately on that. Let's go in on GCV6. GCV6. Yeah, so gold. I am bullish on gold long term. I outline why, every day in the morning, 8:45 to 9 o'clock, I get on air and just give my thoughts about what I might be doing during the day, trading wise. I'm bullish on gold long term, not because of some flight to quality or, always got to own gold. I just think we might see some weakness in the dollar, and despite higher rates in the long end, short-term rates don't seem like they're going to climb that much. Maybe we'll get a rate hike at one of the upcoming FOMC meetings, but the probabilities are a little bit lower. And that, I think, overall could be bullish on gold. I'm thinking, sure, let's do 1DD. Let's try it. Let's do, I don't know, let's do the 44. How much does it cost? So you sell one of these, and you can. I mean, $25,000, $26,000. I don't want to spend $26,000 on a short put in gold. Let's do a vertical. See, that makes a lot more sense. So it's a big product, and I understand why it's $26,000. But most people don't have $25,000 to do on one trade. So I'm going to do just 45.05, 44.10. Let's sell this, risking $360 for 140 max profit. Ship it, submit, working. XOP. Let's see. In the book, the Cyclops didn't remove the boulder before answering his Cyclops friends. Yeah, Colonel, thank you for pointing that out. I studied that 40 years ago. Filled on SPX, got our SPX trade off. Let's do XOP real quick. So yeah, let's do a lot of open interest in XOP. Let's check the skew. 100. Can you guys see this, by the way? Let's zoom in. This is what I like about the web-based platform is I can zoom in. And if you're old like me, or if you're like a Cyclops and have so vision, it's a little bit easier to see. The skews 182.40. So right in between here. So down 5 points, up 5 points. 75 puts to 365. The 90 calls are formed. It's bullish. So let's do this. If I sell a 175 put for $2,900, too much money. I don't want to do that. Sell the 70, buy the 70, sell the 75, $1.31. It's a little on the low side. I would like to get 5 points divided by 3 is about $1.60. Let's see if we push this out another cycle. Actually, with 39 days we have single point strikes. And when you all vote for me for president, I'm going to mandate single point strikes. Nah, the market's stinking here in XOP. Let's see if we can find, because I like to do trades that you folks point out. Let's just see a 1 day. Let's do this one. Let's do bullish on XOP, 78.80, 52 cents. I know it's not quite a third of the width of the strikes. Throw caution to the wind, or maybe we can do this one. No, let's do this one. Do this one. Don't know if we're going to get filled or not. Ship it. Boom. Submit. Filled on XOP. Couple of the stocks that I was looking at in my little watch list. If you want an earnings stock, XP, I was looking through the earnings calendar. There's some symbols, obviously, that are reporting tonight, but most of them, their options stink. The markets are thin. In other words, the bid-ask spreads are wide, very little open interest. You can't trade them, right? So, and I don't buy stock just to trade on earnings. So XP, on the other hand, I don't even know what XP is. And people said, Tom, how can you trade these things without even knowing what they are? There's nothing that I could possibly know about a company that everyone watching here and the cumulatively doesn't know, or the thousands of people that study this stuff, or the people that work at the company. I can't compete with that. So I just look at the options. So XOP or XP 1555 numbers coming out today. The nice thing about it, at $15, the margin requirements are going to be kind of small, which is nice. So down a half a point, up a half a point. It's marginally bullish. We've been through this fight before. Let's try $27. $27 versus a $258 margin requirement, buying power requirement. Not bad. That's not bad. I'm going to ship it. Let's do it. Let's do it. I'm at 27. Let's see if they show my offer. It didn't get kicked out, so it's probably sitting. Whenever you see this, it's probably working at a liquidity provider, and they don't necessarily show these publicly. They'll sit on them maybe a little bit. Nike, they just did it. Not sure if they're right, but why isn't there a micro MES options contract in August 27? Let me see, GK. Let me see. I don't trade a lot of the minis. Nothing wrong with them. Nothing wrong with the minis. So why isn't there an expiring August 27th? I don't know why they don't have something this week. Well, the August, or next week. I bet they're going to come out with it maybe on Friday, maybe on Monday. I bet, and I do not follow the MES options very closely. Full disclosure, I don't. But what I would guess is, as soon as these come off the board, as soon as they expire, they're probably going to launch the ones expiring on August 27th to be the 5-day options. All right, let's go into, don't see, and Nike posted what was done. I don't know. Nike, I already have a position in Nike. XP, working XP. Let's go back to my watch list. FCX. So one of the things I was reading was a squeeze in London for copper. And copper itself, the futures you can't trade. It's a big, ugly contract. There's very little trading in it as far as I can tell. Yeah, volume 48,000. That's not a lot for a copper future. And the options, the markets stink in here. So it was up a little bit. But I've reading a story about a copper squeeze happening in the LME, the London Metal Exchange. Again, what do I know about that? Nothing. You've got all the dealers and all there working with the big buyers and sellers. It's an international business. But let's go into see what I mean. So if you look into these options, there's not a whole lot of trading in them. There's some open interest, but it's also a huge contract. So one of these things is, $17,000. So what I do is trade a company like FCX, which is Freeport McMoran, which is I think it's mainly copper. I know it is. If it is not the biggest copper miner producer in America, it is one of the biggest. And I think they have some exposure to other metals too. But I was looking at this trade, 4 days to go. Earnings, where are earnings? Let's go down here. What do we have? 4 days. So let's look at the skew, 68.61. So in other words, this is just, if there's going to be a squeeze in copper, maybe it'll pull FCX higher. If you want to look at a chart, let's load up a chart. Yeah, it's up a little bit today. maybe it'll stay up above 64. I don't know. Let's check out the skew. Stocks 68, 63, right in between here. So down, let's clear this out. So down $2, up $2. The 66 puts are trading 54. The 71 calls 65. So the skew is pointing to the upside. Again, let's say I sell, and the way I start to look at this stuff, it's about 42 days. If I went, the problem is going out 32 days, which is where I started, is they have 5 points between strikes, which makes no sense with a $68 stock. So I started pulling in the expiration a little bit closer. Single strikes here. So if I go to here, if I start at the 67, the option has a 67% probability of expiring worthless. Can I create a vertical here? 55, not quite there. And then what I did, so 69 is good. Now let me pull it back. 67 here. 53 here with 11 days, 33 here. So let's do this. Let's go into FCX and do this one here with 18 days. Markets are kind of wide. I don't know if I'm going to get filled. Let's see. I've traded a fair amount of FCX in the past. So we'll see. We'll see if somebody bites. Crystalline, can you share how you find your trades? Any particular screener? What I do is generally what I'll do is I have this cherry bomb watch list that I create for the show so I can remember what symbols I'm looking at. So everybody can kind of, Tom's looking at FCX. Tom's going to look at SPX. So, Oklo, XP, looking at Oklo. I'm going to look at Micron, SMH, etc. So I create this watch list. But what I do is go in here, and sometimes I'll start with, Tasty Trades, top hour, the most popular stocks traded. Let's just start with that. And they say, okay, what's everybody else trading? These are just the symbols. Doesn't say bullish or bearish. What I then do, Crystal, is I will sort by liquidity. So this liquidity indicator, this star liquidity, is a number or a metric that I created about 11 years ago. And it is my way to measure the relative liquidity of a stock's options. So right now we have Tesla, high liquidity, SpaceX, high liquidity, NVIDIA, Apple, Intel, Palantir. So I start with that. Then I look at the IV ranks, or even just the, I don't have it on here, the implied volatility, the overall implied vols. So I just go down these lists. Maybe I'll go down this is what I also did. I'll go in and look at my nuclear stock list. And this is kind of a stretch as far as some of these aren't exactly nuclear companies, I guess, or maybe most of them are. And again, I'll look at the liquid products. So SMR and NXE is very liquid. The problem is they're cheap stocks. Oklo, 3 stars, not bad. So this is how I do it. And I just go up and down lists of symbols, looking for liquid products that have either relatively high volatility for credit spreads or relatively low volatility for debit spreads. It's pretty simple. It's just cranking through the symbols until you find something. If you look at charts, great, look at a chart. If there's some other fundamental analysis you want to do, great. Look at some other fundamental analysis. No problem with any of that. All I ask is no matter how you arrive at a bullish or bearish bias, please use a high probability strategy to express it. So that's in a nutshell how I do it. Let's look at Oklo. Were we talking about Oklo? We just got off of FCX. Oklo, so here's my argument for nuclear. I'm pro-nuclear. And if we're going to build out all these data centers and all this brave new world of AI, we're going to have a lot of power to run it. So I'm bullish in general on these things. One of the issues, I like trading CCJ. I like trading, sometimes I'll trade GEV, Genova, or GE Verona, whatever it's called. But Oklo, $44 is kind of a sweet spot for option pricing. So it's not too high, not too low. Let's just see what the options look like in Oklo to see if we can come up with maybe a bullish trade. Let's check the skew, $44. Again, single point strikes, love that. I have a short call spread loaded up, or short put spread loaded up already. 44 down $2, up $2. The 42 puts 256. The 46 calls 305. Skews point to the upside. What I have loaded up here is buying a 39, selling a 41 put. So in the metrics I look at are the P50 number, which is the probability of making half of its max profit. What's this trade's max profit? $77. If I sell it for 77 cents credit, half of that's about $36, $37, something like that. There's a 72% probability of making that. My next step is how much theta am I making? 93 cents. That's not bad for a max loss of 124. So if I can make $38, $37 versus $124 in 25 days, that's a decent return on capital. That's how I find trades. And those are the metrics that I look at. Let's ship it before I forget. Yeah, let's do 76 cents. I'm getting a third of the width of the strikes. I may take that down to 75 just to get in there. Let's go into the watch list. Let's go back to Cherry Bomb watch list. KRE, the banking sector. I'm kind of bullish on banks. Let's go into KRE. The options are semi-liquid. Look at the open interest in this stuff. This stock's at 77.50, so down $2, up $2. The 75 puts her at $1. 79 calls her $1.58. Yeah, they're absolutely bullish, or the skews point to the upside. If I sell that naked put, yikes, that is $2,800. Too expensive. Let's buy this. So I'm only getting 43 cents for this 2 point. Let's pull this up one strike. 51 cents, not bad. Let's push this out to 39 days. And now I'm kind of getting in the range here. This is a 1 point. This is a 2 point. I'm going to do for 39 days, I'm going to buy the 74, sell the 76. 80%. Let's go through these metrics again. 76 fluctuates 77, 80% of making $29, 50%. Filled in my gold. Yay. On my gold put spread, making $29 versus $142 in max loss. That's how I look at return on capital. Let's ship it. Boom, send. Let's go into filled on KRA. Let's go into Micron. Micron is surging again. Everybody loves Micron. It's the way we trade today. So anyway, this is Micron. Bullish on Micron, bullish on that in that world. It's they like the semis today, at least most of them. And let's take a look at the skew. I've done pretty well with Micron, so 1,020. Let's go down $20, up $20, down $20, 65.85. 1040. It's the skew is pointed to the upside. And someday I can explain the skew if that's confusing to folks. Let's get down here. 68% probability of expiring worthless. It's where I start. Buy one strike out, 10 points wide. A third of the width of the strikes is about $3. Not bad. Not bad. Okay. So that kind of meets it. Let's see if I back off the, I get 5 points. Let's do a shorter term one, maybe. Just to play. No, I'm not getting it. I'm not getting it. All right, let's go out here. Let's go back out to let's go back to this one. Buying the 910, selling the 920. Again, the metrics look good. Ship it at 308. Ship it. All right. Put a bullish. I looked at path. NLR for nuclear. I'm running out of time. NLR. Let's see the options. No. NLR, yeah. If you want to buy the stock for $118, the options stink. They're too wide. The options, there's no, please explain, please. So 10:30 let me do that tomorrow. I'm running out of time right now, and I have to push these trades out to the follow feed. And it's, what have we done so far? Working our MU, filled on our KRE, filled on our gold, working OCLA, working FCX, filled on XOP, filled on SPX. So it's been a fairly active day right now. Given that SPX is down $30, it really hasn't moved much, and I'm probably losing money on that put spread. I think I sold it down, and they were like $38 down, something like that. No, actually, it was around here, 77.55. If we sit here, I'm okay with that put spread. And skew, by the way, just really quickly in my 2 minutes, 1 minute, skew is the different implied volatilities for the different strike priced options. Options, as they go up and down the strike prices, have different implied volatilities. That fact that they're priced with different IVs is called skew. I'll talk more about that tomorrow. So I've got some fills, working some orders. I might adjust some prices, but none of this is a trade recommendation. If you want to do this stuff, please do so. Do not take any more risk than you are comfortable with. With that, folks, stay tuned for some more great programming and more live trading. This is the only trading network that has live trading, and I will see you guys tomorrow.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Coming up on Bad Money with Jim Blamer. Blamer's hot stock tip of the day.
Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
We're back. You're watching Tasty Live. This is Futures Power Half Hour. Too Fast, Too Futures. We're still sorting that out. It's sponsored by CME Group. I'm Chris Vecchio. He's Ilya Spivak. Ilya, it is a very light, low volume day today still. Markets are edging lower over the course of the session, but my goodness, not even 700,000 contracts traded here. We have 90 minutes left to go in this trading day. Where are the people?
A good question, because we don't really have a lot of conviction here, and that's been a story that's been going on for a while. I mean, just look at the volume on ES last week. It was the worst for the year. the lowest for the year since December. There's no conviction in this market. And of course, the drift last week was sideways, and that's not for lack of news. I mean, you can go out there and say, oh, this is summer doldrums. Yeah, okay, sure. I'm sympathetic to that maybe, except it's not like we don't have a shortage of news flow, and it's not like the markets don't care when there's news flow. Volumes were already picking up much more strongly from a summer low last year, the year before that, the year before that. And so you look at this and you say, right, there's a lack of conviction here. This isn't just seasonal.
Our friend Brett Kachuba over at Spot Gamma pointed out today, and we can just go to SPX here just for the sake of this, but when he made this comment this morning, okay, when he was talking about the 0 DTEs, this was put out at 8:25 Eastern time, but the 77.90 0 DTE straddle at the time was $22.07 or 29 basis points. The average daily move in the SPX over time is 68 basis points. The last time that you had a move that was priced in this low was Christmas Eve at the start of today's trading day. So, Ilya, this market's been dead. The fact that we're down by 0.4% means that we've moved beyond the expected. I was talking with Mike about this on the morning show today, because one of the tried and true things, TP does it, Liz does it. I've been trying to do it on occasion. Mike does it, Jermal does it. It's when the day opens right before the market opens. If you have some stability in the pre-market, you look to sell an iron condor. And if the market doesn't move at all in that first like half an hour or hour, you feel pretty good about it the rest of the day, because that's where a good chunk of the trading volume's in. Today, I couldn't justify it because we were looking at the strikes. Ilya, it was like a 20-point move priced in around 8:30 Eastern. By the time we actually got on there, we had some technical difficulties this morning, as people know. 9:15 Eastern was closer when we got on, or 9 o'clock, I should say. But even so, it was dripping into the teens. And so now we've had a 30-point move. So if you did the short iron condor, you got blown out today, unfortunately. It's one of those, like, when vol is this low, how do you justify selling vol? And I can't. And we've showed the studies before. When the VIX is this low, when you dip below 15, and it's at 15.16 now, but when you dip below 15, you're taking more risk by being short the straddle than you are by simply being long stocks. So today's a day where it's like, okay, I'm glad I wasn't picking up pennies in front of that steamroller. But that's kind of where we are right now in the cycle. Vol is really low again.
That's right. And to my mind, this is not the kind of vol where you go, oh, well, the market is not worried about anything. Because if that were true, then this kind of slide in vol would give you a parallel rally, and it's not. And it just reminds you. I mean, we did nothing in the stock market last week. We went up some, we went down some. Where did we land? Basically a goose egg. Just look at the weekly chart. What has actually occurred? Nothing. And so when you look at all of this, you go, okay, does the low vol mean that the market is happy? No. It means the market is scared, perhaps, or at the very least, unwilling to commit directionally.
Ilya, this month so far, the S&P 500, it opened up at 75.50. It's currently in at 77.78, 77.74, we'll call it. So that's what, a healthy 225-point rise. Here's the context. Since August 4th, we have made a net advance of 10 points. August 4th, we closed at 77.65. So you say this market's not going anywhere. Market really hasn't gone anywhere. It's had these little bumps to the upside, moves to the downside. This is why, depending upon your time frame, this matters so much. If you've been trading 1 or 2 or 3 DTE things, the market's moving around a whole bunch. If you're trading something longer term, this thing hasn't wiggled, jiggled, or done much of anything. But I guess what I'm watching for here today is, in this soft tape, is there any semblance of technical structure breaking down? Because not for nothing, since we had the Leopold Aschenbrenner situational awareness washout around the Fed meeting here, we have yet to put in a close.
That's how you pronounce his last name.
Aschenbrenner? I think so. I could be mispronouncing it. Leopold? Which one was confusing you?
Leopold's what I've been saying, because I'm not even going to attempt it.
July 30th, we put a close above our 1 week moving average. It's that white line here in the chart, Ilya. We have yet to put in a close below there. So maybe this would be the first crack in the armor. That's at 77.80 right now, 77.80.92. So maybe you call it 77.81. That's only 7-8 points from here. That seems like a lifetime away given how slow this market's moving. But if we close below there, okay, something to watch. We're going into Vixpiration. The NASDAQ here, I have a line in the sand about basically like 30,050. If you get below there, if you get below the 1 week today, that's that 29,995. It seems like maybe a little bit of a false breakout in recent sessions. The Russell, I don't know. We've had a nice run in so many things that with Vixpiration OPEX coming up on Friday, Vixpiration was a OPEX Friday, FOMC minutes on Wednesday, consumer earnings over the course of this week, NVIDIA next Wednesday, FOMC Jackson Hole next Friday. Long deltas that are close to, if you're short premium and you're at 50% of your profit or you're pretty close to it, today might be a day where worth lightening the load a little bit. And I know that's what I've been doing and pushing out some duration right now because I don't want anything with a ton of gamma risk.
Yeah, I'm kind of happy, perversely, that whatever I had on kind of got blown out. Thankfully, I still made money, but obviously not as much as I did before I went on vacation the week before last when stocks were on their back foot near the lows. Then, of course, to start August, they decided to surge just over a day or two and then just flatlined. So I'm kind of happy I decided to take my ball and go home, take whatever premium collected there was on those short call verticals I had going into August that were working so well. Obviously, they didn't work nearly as well as they looked before I went on vacation, but they nevertheless worked. And there were some pennies to pick up in front of the steamroller. So I picked them up and ran away from exposure to wait and see what happens. I'm kind of happy I did that because I don't really want to be fighting this market here. All kinds of crazy melt-up situations can happen when volumes are this thin for no good reason. And so I don't really want to fight this thing. I want confirmation that it's rolled over. I've taken my ball here into other assets where I think you get better opportunities and there is an actual reaction function to all of what we see as far as economic news flow, and that's the dollar and it's the precious metals.
So, Ilya, I just mentioned the phrase gamma risk here, and I just want to put some examples on the screen of like how and where this happens, right? Your gamma risk is the risk that the options delta is going to change rapidly as the underlying price moves here. And so here's a 0 DTE 7800 call for today in the S&P 500 futures U6. There was a point this morning, Ilya, when it was trading near $20. Near $20, 8 a.m. Eastern time, $18 was the price of this option. It's now trading for 10 cents. Okay, that's gamma risk because the delta here moves. If you are long the call, you are dealing, you are long gamma. And so you're dealing with the risk that, yes, if this thing moves rapidly against you, and not even rapidly, it's down 30 points today. Time decay is going to go very much out of your favor. Here's the other side of this, though. If I'm short gamma, Ilya, and all of a sudden the market starts to take a turn the other way, you face what could be called a gamma trap. So let's say, like if this was with me with Meta would be a good example of a position that I'm in right now, where I'm trying to fight back. Today is not a great open, not helping out. I have something 4 days to expiration here. It's still underwater considerably. I'm going to have to take this off so I don't get assigned to anything here and just take this off at max risk. But if this thing was sitting, maybe this isn't a great example. I need to find a position that's, what would be a good example of this? Procter & Gamble would be a good example of this right now for what I'm trading. Okay. Procter & Gamble, this is a position here where I am short a 145 put right now. Okay. Let's look at the price of this option here. The price of this option has jumped meaningfully today because we're only so many days out because it's close to at the money. And all of a sudden, instead of being below water, it goes from being worth $1.28 at the low, where now it's worth $1.28 $2.46, right? So because I'm short the put here and this thing is moving down, there is a rapid change in the price swing. If we were operating at the 70, I'm going to go out to ESH7 here. We're going to go out to the December 31st expiry. I'm going to look at that. We'll look at the 8,000 call. Has the 8,000 call changed that much in value over the course of the day? No, it hasn't.
No.
Why? Because there's still so much time on the board. So this is the point I'm getting at here, right? You can see how the 8,000 calls have been pretty stable here in recent sessions, even though the price is down meaningfully. Has this dropped $20 or from $18 to 10 cents like the ESU6 7,800 call has today? No, that's your gamma risk. So I point all that out where if we're looking at a market that's feeling a little bit of sogginess, volatility is really low, you're short premium right now, and you don't have much time left on the board for your positions, you're dealing with a ton of gamma risk. It can cut both ways. I know it's working for me in Caterpillar today, where this thing is up $30, 3.5%, and I'm still sitting in a short 900, 890 call spread right now. And as you can imagine, that short, the long call here has exploded in value over the course of the session. So it went from being a very big loser, it's now working out better. That's exactly what I need to happen here, Ilya, right? So gamma risk can cut both ways, depending if you're long calls, short calls, long puts, short puts. But I know that's come up recently. Why do you keep saying gamma risk here? Gamma is how quickly the delta moves based on the underlying price movement. And so when you have a lot of gamma risk, it means a small price movement can change the value of the option very rapidly here.
Yeah, I mean, you have to be looking at this kind of a setup here. Markets going nowhere, vol on the floor, and going, this does not look like the market is thinking happy thoughts. It looks like the market is coiling up for a breakout. And that's exactly the kind of thing you're talking about when you say gamma risk. If the market suddenly decides that it has a narrative, then the underlying delta's sensitivity is going to change dramatically because the market will have made up its mind and will have said, oh, well, now we care. Here's the catalyst. Now we need to start shifting around assets based on what the underlying is doing because we actually believe that what it's doing is a thing, that it's a trend, right? So think about this thematically. Why would you suddenly have this gamma risk? Because in the derivative space, the collective thinking will have been, oh, well, the underlying just did something that's a trend move that's going to stick. Oh, okay, reprice the entire structure. Follow the underlying. What is it doing? And then, of course, you have greater sensitivity to delta because all these bag holders suddenly decide, oh, well, the actual underlying theme has changed. We need to go do that now and reflect that.
Well, one of the things that's changing today is the market seems to be a little bit more sensitive and keen on paying attention to what's happening in treasury yields. Noteworthy that today our Russell 2000 is among the weaker of the major indexes. The NASDAQ is down in negative territory now, but thanks to the performance of some of these semi-names, Micron, SanDisk, they've been able to bounce back. SanDisk was trading down at 998.19 on July 19th, Ilya. It's up 79, almost 80% now since July 29th, which is pretty remarkable. Oh yeah, that's when all the leverage was cleared out of the system. No one believed me when I was saying this was a big deal back then. I'm like, oh, it's just like when Bitcoin bottomed. And like, okay, here we are. So pick a name, STX. The only thing that I did differently here today, Ilya, oh, that makes me so happy. When it's a strong tape and a sector is just on fire, SMH is saving me here. We're about to get back to where I got long at 615. Saved. Or assigned, I should say. not got long, got assigned. Among the semis,
be clear.
Qualcomm is that was not I guess it was done with my permission, but really it was not done. I did not want that to happen. So
it was Qualcomm not chosen.
Here, right. Qualcomm here, semiconductor, that's down 2%. All right. It fit my criteria this morning in my sell the rip technical scan, Ilya. It was above its 1 month moving average, but it's still below its 50-day. And so maybe this is a bounce back and a trend to the downside here. And that's top left to bottom right. And so what I did was I put on a double bear. Because this thing may still run, right? The semis can run here. They're clearly running. Maybe Qualcomm gets a sympathy.
I mean, it could.
But what I did was I put on a super bear trade here, or a double bear. I'm short the 185, 190 call spread. I'm long the 140, 135 put spread, right? This is not a pretty chart. If you told me like, hey, Chris, look at this chart of a semiconductor. How do you think the sector is doing today? I'd say, oh, it must be a bad day for semis. Qualcomm does not have the same business model as some of these other names out there. I'm not going to go into it. If you're interested in that kind of analysis, go read Tae Kim, TAE space KIM. He's been talking about how Qualcomm's a dog. I never placed a trade on his ideas, right? You and I talked about this actually a few months ago. Like, hey, there's a prominent semiconductor analyst who's saying that Qualcomm is the one to fade. I didn't do that, right? And so I've had these ideas in the back of my mind, and now it's kind of like over the past week or two. Interesting. You're seeing that divergence play out in real time. Maybe today we can take advantage of it. So that's how I'm taking advantage of this in some form or fashion. I'm not throwing in the towel. Western Digital I rolled out today as part of this move here. I was in at 4 DTE at the 500, 510 short put spread. Again, talk about your gamma. The options here have changed dramatically in pricing over the course of recent days. It's been quite the wild ride, to say the least. Okay, I just want to pull this up here. At one point this morning, they were trading for $6. Now they're trading for 10. That's all in the span of one session. So rolling out, getting rid of gamma risk. We're going into expiration. We're going into OPEX. So how does that pertain with the actual futures trades that we're doing here? I am sitting in at 25 days to expiration, a short put spread in the Russell, Ilya. Rationale, 50-day moving average was pulled back into, and then we bounced from it. And then we carved out a new relative local high. And when we made a new attempt into the all-time highs, we pulled back. And where did that pullback do? Never got below 3K. So when we were there at 3K, it says, okay, what's below the held? So, okay, we're holding for now. What does the short put spread look like with a short strike below the 1 month moving average? 29.75 fit the bill. That was put on, and I believe we were talking about this morning, but it was put on for something in the neighborhood of $6.80 a credit. It being a short put spread, 50% profit target at least. That means we're looking for deterioration down to $3.40 of decay. It's only at $4.50. So I'm going to give this another day or two. But once we get to 50% profit, I don't want to be short vol going into next week. I really, not in the indexes. Don't feel great about that. Not at these levels.
Yeah. I mean, I think you look at this and you go, okay, looking at Russell, what are we afraid of here? I mean, technically, ticker agnostic, it looks good, but we're afraid of rates. And we're afraid of rates because this is where cyclical sensitivity isn't diluted by, oh my God, mega cap tech names are going to rain more magic money on us. None of that in the Russell. And if you really are looking at Fed policy odds changing in response to this soggy economic data, I mean, just take a look at the Atlanta Fed GDP Now model. It's still very heady, but we're only just starting to get a handle on the third quarter. The number doesn't matter. It's the direction that matters. And when you look at the way that the model has evolved, it's lost 2% from its forecast for third quarter GDP in a short 2 weeks, 1.5. It went from 6-ish to now 4-ish in a blink of an eye, thanks to NFP, soft inflation numbers, weak retail sales numbers, abysmal, frankly, consumer confidence numbers. So you look at this and you go, right, the economy seems to be losing steam under the surface of all of this data. And policy expectations have noticed we don't have a full rate hike discounted through the end of next year.
Yeah, did you, by the way, I included this in the morning note today. Reuters put out a story this morning. They polled 104 economists, some of our best and brightest, Ilya. 94 of them say that the Fed is not going to hike rates in September.
Yeah. Well,
That's
and Fed funds futures agree. I mean, you don't really have to listen to economists.
You should not listen to economists.
Yeah, I mean, market participants are getting there.
What the Fed should do,
sometimes
and what the Fed will
even
do,
a
are different things.
Well, yeah, right. But I mean, even a broken clock is right twice a day. And so you look at this and you go, okay, look, what's the thing that we're going to hear in the FOMC minutes this week? Is it urgency to hike? Probably not.
No.
Okay, so what are we going to hear in the data? We have S&P Global numbers coming up at the end of the week to give us another cyclical indication. Well, since the past week and a half, the data has been very disappointing, and the markets have seen that and they've reacted. It's not like they're ignoring it. It'd be one thing if the markets were saying, whatever, we don't care, keep it going. Well, then you believe the price action. But here, very clearly, the markets have said, reduce rate hike chances. Something is wrong with the economy. So the response is there. The reaction function's there. If the FOMC is not chomping at the bit to get something done on a hike imminently, doesn't sound like they are, and I think the minutes should probably show it. And if the S&P Global numbers are going to be soggy, how much joy do you expect to get out of the Russell? If we're going to a place where these kind of small cap names face a cyclical risk, that's going to look soggy. And that's going to be that breakout, let's say, is going to start to look like not so much a thing to follow, but a thing to fade.
Well,
when I fade it here, let's get a breakdown first.
We're going to learn to see how much the consumers are hurting this week. I really, after the retail sales report on Friday, I really feel strongly that the earnings this week actually carry more weight than maybe others are giving them credit for, which
I agree with you.
Perhaps a little arrogant to suggest that I think I know more than other people, but the market clearly made that vote in that direction already. I mean, I said this already. It was our trade idea of the day.
As a matter of fact,
when you look at the retail sales, the volatility in the retailers that had their earnings reports due out this week, it all went up. The market said, hold on a second.
Mm-hmm.
July was bad. We're getting 2Q numbers. Let's think about that guidance a little bit more from these retailers, from Ross Stores, from TJ Maxx, from Lowe's, Home Depot, a few of them out there. Home Depot, by the way, I mentioned this in the Trade of the Day video.
Mm-hmm.
If you're trading it this week, Tom Decker, the CEO, is away for medical reasons. So there could be an announcement related to him that could impact how the stock reports around earnings. Lowe's carries no such risk. And when you look at the chain right now, if you're playing a similar idea like the short iron condor, I'm still trying to get filled 202.5, 205, 225, 227.5 here. It says 97 cents credit. I haven't been able to get filled on that. Could I get down to 92? Would someone fill me for 5 cents cheaper? There we go. I've been poking around between 87 cents and 97 cents all day, like literally for the past few hours. So at least I'm in there now. But let me just take the other side of that off, because I don't need to be doubling up here. Yeah, see? Mid was 75 cents when I try to get that filled. Okay, well, at least we got in. That's the point. Okay, but so these earnings clearly matter a little bit more. The Russell here, the small cap, the rates stuff, that all seems like it's going to be very much in focus. So ZB is a place where we've been playing ping pong against that yellow line, the 1 month moving average, just rolling down put spreads. Ilya, it's been working like a treat. As a trend trader who's identified a clear trend, I milk this until the chain of trades breaks. So right now it's the 108, 107, sitting at 11 days to expiration. If we get a dip into the 107s, this thing is working out neatly. I'll take some profit. We're getting a little bit removed from the 1 month here, Ilya, though, and we haven't gotten too far away from it, right? It's been about a 2-point spread, so to speak, from like the maximal high to low when we consider where we are. Right now, that 1 month is 109.20, so we get into the mid 107s, another point. I'm going to take this off. I don't need to see 107 hit, but and then wait for a bounce back and then look to do it again. So you and I have a little bit of different views on bonds. Gold, I know we're in full agreement with here, though. I sold the put spread on Friday, Ilya. It was
Yes.
a pullback into the 1 week, which has been the trend since the start of the month. Close above the 1 week every single session. We had the pullback from that 4,500 area. Maybe we're getting ready to break out now, but this is the decision time, the downtrend from the all-time high, the swing high that we had when the war started, to now. Not that diagonals matter. You don't like them. Peter Brandt doesn't like them, so I'm not going to pretend I know more than both of you, but I do like them still. And if we break through there, plus the initial post-January collapse swing low down at 45.54, we've got a stew going here.
I mean, I started buying gold back. Let's see. I started to put this on August 5th and just buying outright 10Z futures. And I've been, I got out of all of it back in July and I'm adding here. So at this point, I'm building a position. I added more today. I started buying at about 4,300. I bought some more. I haven't bought more silver yet, but I have sold more US dollars. So I sold more dollars against the Aussie today, sold more against the euro. I think this Fed readjustment thought process is a thing. I'm going to stick with it.
Oh yeah, as I consider finally dipping the toes in and buying that 5,000 call spread around the 5,000 level, what I am thinking about here is what's the opposite right now? If I was going to sell the call spread up here, would I accept $4.20 for a $25 wide strike, less than a fifth of the strikes? Absolutely not. Which makes me think that buying the call spread is actually still pretty cheap. And it's sitting on the outside of the expected move. I know that's not the tasty way, but that's what paid the bills last year. So doesn't hurt to get back on the old bicycle, my friend. We're going to be done here right now, though. Curious what Tim Knight has to say. He's coming up next. The Slope of Hope himself after the break. You're watching Tasty Live.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
Hello everybody, Tim Knight, and it is time to go back to the world of charts. We do this every day. And for once, for what feels like the first time in about a year, we've got a red day on our hands. Not much of a red day, but red nonetheless. I guess the 60-day negotiating period for the Iran war is over. There you go. I don't know if that has anything to do with it. Crude oil is up somewhat, so maybe. And as we've talked about, we are entering not the season of the witch, but the season of volatility. VIX was barely in the teens on Friday, and it's starting to show some signs of life. Let's double it, at least. That'd be cool. Maybe triple it. That'd be really fun. This has been such a boring market. Oh, my Lord. Past couple of weeks, put my feet to sleep. So maybe things will change. But today's a little step in the right direction. Let's look at the charts together on this slightly red day. We begin with the basics. Our old friend, the spider. Lifetime intraday high on Thursday. Little bitty red bar on Friday. Little bit of a bigger red bar today. Whatever. I mean, unless you get back into that green rectangle, it's all just wiggle jiggle. Nothing really. I mean, don't get me wrong. I'm glad it's not green every day anymore. But we had this like burst higher, and since then, not a whole lot going on, and no surprise either, because why would it? You know, geopolitics seems to be like an oil painting now. It's just kind of frozen. There's no earnings data of note until next Wednesday. So 9 days from today, NVIDIA will come out. That should shake things up. And economic news, done. Done until the jobs report, way into next month. So yeah, things are pretty, the tumbleweeds are bouncing across your screen right now. The diamonds are down again, and I say again because they have been a real underperformer. This was the lifetime high here, and slumpity dumpity dumpity dump dumpity dump, down it goes, just kind of bleeding out day after day. I guess we've got a bit of a prospect for support at this gap, maybe, but it is kind of like January 2000. The Dow 30 just stopped going up, whereas tech just kept whistling past the graveyard. So very bifurcated market right now. The small caps, IWM, have been pretty strong of late. They have given up some of their gains from Friday. We're still above this breakout level, and it wouldn't take much to get a failed bullish breakout there, but it hasn't happened yet. So we're still just daintily poised above that breakout zone. Overseas, generally speaking, EEM up quite strongly. EEM is up over 1%. We've been inside this ascending channel for a very long time, about, what would it be now, about 16 months, 16 months or so. Little tease right there, but that didn't really mean much of anything. In fact, I'll just leave that be, just as I'm leaving this be. There's no reason necessarily because you got one day outlier to like drag the whole trend line up to a completely different angle. These are a little bit of an overshoot, a little bit of an undershoot here. The broad trend is enveloped by those lines. Country by country, it's kind of a mixed bag, although clearly the entire tariff wars and bullying and ugly words and such, the countries of the world are just kind of shrugging their shoulders, or at least their equity markets are. Canada, lifetime high today on an intraday basis. Right now it's basically unchanged. Japan, lifetime high on Thursday, just like us, and just kind of hanging out near those lifetime highs. And South Korea, tremendous rise here of late. I've gotten really disenchanted with the whole semiconductor space. If you saw my video this weekend, every single one was just sort of ruined. The one that seemed plausible still as a trade was WDC. By today, I mean, today's open kind of wrecked that too. The gap was more than filled. I actually did short that today, small position, but they're not as clean as they used to be, nor is EWI. The EWI, the past 4 days have all been well above the base of that pattern. Although weirdly, I'm not showing it here, but weirdly, KORU, which is the leveraged, triple leveraged, I think, instrument for South Korea, is actually still a really good looking pattern. So if you're feeling really zesty and ready for risk, you might short that because that's still nicely configured. But the plain old 1X here is just like yuck, just not worth it. But I'm not in any of these. What I am in is China, which is up today, but that is so okay. I'm actually trying to buy more puts on that. These are March 2027 puts. The index itself looks like this. Here's the Hang Seng index going back for many decades. And the germane part for us is this broken trend line, as well as the price gap right here, which we're beneath. So we're rallying right now. It's up about 1 1/3%. We have not violated that price gap. And of course, what I'd really like to see tomorrow is a drop on this. But this is a kind of a longer term trade. There's 7 months or so left in these suckers. And so this is the actual instrument, FXI, which is up more modestly. The index itself is up 0.43%, maybe anticipating tomorrow's prospective weakness. But yeah, $37 strike on an irresponsibly large number of March puts. But as I said, complacency reigns. Here we have the VIX just grinding down to the lows for the year. This crazy looking chart goes back for decades itself. You can see periods of tremendous complacency and also occasional, all too occasional, bursts of fill in the blank for your adjective, or your noun, excitement, terror, what have you. The tippity top here was understandably back in 2008, the financial crisis, where you just got just about to 90 on this. And so we've had almost 90. We've also had single digits. Those were the days, right? Missed those days. So we're way down here now. And from time to time, although they're not 90, but these days 30 is like, oh my God, bailout time from the government. They do appear with some regularity. It's not, you can't put it on your calendar, but you definitely look at it. It's like, well, it's about time. It's been a while. The last real burst we had was naturally back right when the war started, early in March, and it's died down for reasons I can't fathom to 14. But something tells me between now and the end of the year, we'll be up in the 20s, maybe 30s again. Isn't it sad that the 20s is like an ambitious, crazy goal? It's like, don't lock me up. Don't call the authorities. VIX in the 20s, whereas it used to be just like the norm. But that's the world we live in. I don't trade the VIX itself. And of course, there are instruments out there to do so, but they tend to erode really badly. Here's the UVIX, for example. It's, spot the trend. It's basically just grinding away constantly. And the funny thing about these is that because of the reverse splits, if you look in the past, it's like, $250,000 back in the day. And now it's like, whatever it is. So, do not recommend that even if you do think volatility is going to spike. But as I say, the cleanness, the clarity, the purity of the semiconductor trade has gotten pretty badly damaged. SMH as such still has a shot. And of course, it's kind of at the mercy of next Wednesday. Here's the diamond, and break, retrace, break, push higher. And we're kind of just hanging out. And there's no exceptionally clean level here to point to. I'll just plop it right there. That's sort of kind of in the middle of that diamond. It's okay as a rough marker. But there's, from a charting perspective, we're certainly not doing lower highs. This is well higher than we were here. And if you look at individual stuff, you can see plenty of just spoiled patterns, like SanDisk, for example. It used to be just pretty as a picture, and now it's just a dog's breakfast. So, kind of cool. I actually have very little, maybe even no semiconductor positions at this point, except for the WDC little bitty short, just because. But yeah, not an SMH or Micron, AMD, on and on and on. But more broadly with the cubes, this is still below its descending trend line, and I'm short this tight stop. I basically updated the stop to just above today's high. If we do violate that, kind of the last bastion of hope for the bears would be this trend line here. But it would really help if we didn't even make it to there, that it was so weak that it didn't even touch that trend line. So past 3 days, that's been pretty much as high as we get. And then, the lag 7, as they call them, is expressing itself, because here we have FNGD, I call it fingered, which is up 2 1/3% today. As you can see, for the past 6-7 days, it's been just kind of banging around at the bottom, but that's pretty impressive for a leveraged bearish instrument, the fact that it can find any kind of stability down there. But it is having to pop today because some of the big boys are quite weak. So, for example, as Mike Butler mentioned this morning, Microsoft down quite a lot. And we can zoom in here. I talked about this short last week because we had just gone blowing higher here and had the shooting star, and we've been slipping, today being the biggest drop in a little while. And then good old Meta, which you may remember, I covered my own short here and went zipping higher, and I pointed out this gap as a stop loss for any new shorts. It didn't even get there. The peak was last week, and there's a good amount of sunshine between the price gap and even as high as it went. So that's how weak it is. It couldn't even muster a gap close. And so I dare say that before this year's out, we will be well below any of those levels, new lows for the year. But it's fallen a good chunk already. One item which has been surprisingly robust has been Elon Musk's SpaceX, which I applaud. It's the one of the few assets whose ascent I applaud, that and precious metals in general. But we're still range bound. As I mentioned, the range by my estimation is like basically, in simple terms, 100 to 150. More precisely, it's like 104 to 148. And on Wednesday and today, we've conked our head on that ceiling. It will take some reason for people to have to jump to the other side of that line and to change what is currently resistance into support. I don't know precisely why that we're having such a good day with SpaceX. It doesn't particularly matter, but one possibility would be, I suppose, the Anthropic IPO in October, which will be here before we know it. And word on the street is that the Anthropic IPO will be even bigger than the SpaceX IPO was. And the SpaceX IPO was bigger than anything historical by a long shot. And so Anthropic's all about AI. SpaceX is largely about AI. Rockets notwithstanding. And so maybe that's added some excitement there. And I would add some weight to that theory by way of these funds, because I've talked about these in the past. These are funds that allow people to get into pre-IPO companies. I guess, the idea is like on the cheap, even though it's not really true. And those just got slaughtered until about a week or two ago. And they have been kind of dusting themselves off and pushing higher. So here we have 21 Capital with the Roman numeral XXI as the ticker symbol. So it's up about 5% today, well off its lows. And then similarly, Fundrise, which went to lifetime lows on Friday, but has shaken off that and is the highest it's been in the past couple of weeks. So the green bar here merely represents what the open was on its IPO day. And we got a little below that on Friday, but we're above it now. And, I don't think it's some grand new era for this. It's probably going to exhaust itself well before it undoes all this damage. But I do think it's indicative of the fact that a little more optimism is flowing into the market, that maybe IPOs aren't completely dead. Because beforehand, the concerns were Gee, the SpaceX one is kind of a dud. It's doing quite poorly. It had fallen, well more than 50%. And there was a lot of chatter about, hey, Anthropic and OpenAI ain't making any money, and they have all these expenses, and all the executives are leaving, and what's going on. So a lot of that fear has seemed to have disappeared. And so Anthropic IPO will be really important to the market's psyche, risk-on psyche, and also beyond important for the prospect of an OpenAI IPO next year. Because if the Anthropic IPO is kind of a dud and doesn't really recover itself, that's going to put a total chill on OpenAI's, and vice versa. If it goes well, that'll really set the stage for a good OpenAI IPO. Over in metals land, gold futures are up about $33 right now. Here's GLD. It is up, obviously. I would say that this price gap is the one to watch. We got close to closing it on Wednesday, but we tumbled a bit, and we're trying it again. I'll just, at the risk of being too repetitive, I'll just say that I do think this is going to sink. Although long term, I think precious metals of all kinds are going to tremendously outperform equities. But for those looking to go long gold, and I'm among them, I'd prefer to get in at a better price. If we could get this down to something like this area here, I'll just sloppily draw kind of what I perceive as the most recent basing pattern. If we could get down to the top of that green rectangle, that would be a very appealing price level, I think. So I'm not doing anything with it right now, but I'm not shorting it either. The only thing that is in the neighborhood of this that I've done a position on is I shorted earlier today XME, the miner, the metals and mining ETF, which isn't just precious metals, it's a mix. Here's the pure precious metals, I think just gold miners, GDX, very heavily traded, but here too, it's got a price gap. We got close to sealing it on Wednesday. We did not do so. We're having another try at it today. I would not be surprised at all to see gold, silver, GDX, XME all fall very soon, maybe even tomorrow. If I was feeling really saucy, which after the 2 weeks I am not, I would be buying DUST, DUST, which is the leveraged bearish fund against the miners, kind of the negative 2x to GDX here. And pretty heavily traded, but yeah, I'm not doing that. I made mention that oil is showing strength, and indeed we can see that here with USO up over 2.5%. So we have a situation in which bonds are falling, interest rates are rising, oil costs are rising, and for some reason people think that's a great stage for equities. Don't know how that's possible, but that's all bad for the economy. And you've probably heard that we've either just crossed or are moments away from crossing the $40 trillion debt level in the US. Interest payments about $1.25 trillion per year and rapidly climbing. And a target of, I think, a $50 trillion debt level by 2029. So yeah, I'm old enough to remember. I remember as a young person hearing that we had crossed the $1 trillion mark, and that made a lot of news because that is just an unfathomably large number. Kind of like people were talking about Elon being the first trillionaire this year. It's just a really big number, and when it's never been done before, people talk about it. But at this point, we're going to be measuring things in fractions of a quadrillion, which I guess is the next order of magnitude higher. Anyway, got us away from oil there, but yeah, USO is up. And then XLE, and I've been bullish on this, as you know, from last week after we crossed this level. XLE, my goodness, look at this. 1, 2, 3, 4, 5, 6 beautiful green bars in a row and getting close to lifetime highs, which is kind of remarkable. I mean, let's think about that for a moment. Look how close we are. And consider that when we were here, oil was vastly more expensive than it is right now. So I think the subtext there is you're going to see those price levels again. Yeah, because that was back on it was the end of March before, peace broke out. So yeah, XLE, that's doing quite well. What else is going on there? Well, of course, I've got a bunch of shorts going on. I've got 25 different positions right now. Some of my accounts are with a broker, not Tasty, which was down today, so that was kind of infuriating. So yay, Tasty uptime. That was annoying. But in any case, not a lot of trading activity for me today at all. Some of the shorts I wanted to share. We've got Abbott Labs, ABT, which I think I mentioned on Friday is a new position. And in some cases, I've really tightened up the stops on these. And all I do here on the show is I just mouse over that dash red line, which indicates my own stop loss, and it'll highlight what the actual price level is. Salesforce, I've tightened up this stop quite a lot. These guys are down not quite 2.5%. Okay, here's Carvana back. And I've talked about Carvana a lot. This is the entire price history. And you can see here this beautiful top here, which preceded this just, existential wipeout. It seemed like it was headed for bankruptcy here, but it certainly was not. It blasted higher. Now we've got this higher, bigger, cleaner top in the form of this diamond. And we had this annoying blast higher, but we seem to have peaked on Friday on that. And we're falling today over 5%. And so I've tightened up at the stop on this one too. So there's the line. I've tightened that up to say 75 on that short position. So that's Carvana. Intuit, INTU. I made mention of this because if memory serves, on Friday, that's when I had that experience with some SaaS company went roaring higher. I got stopped out of that, but I started sniffing around for other SaaS outfits that seemed to be intriguing on the short side. And this is one of them, Intuit, INTU. And this one here again, I've tightened up the stop because from a charting perspective, the stop kind of should be right there. That's where the price gap really is. But here again, considering the lovely experience we've had the past couple of weeks, I'm getting quite conservative with the stop loss levels. And so I just kind of bring those trend lines down and risk down, although that doesn't always serve me, I will tell you. Because like I bought January Microsoft puts like a week ago, and I dumped them, and I noticed they're up like 25% today, even though they're way out in January because Microsoft's tumbling. So sometimes getting risk averse can be very profit averse too, because it'll just deny you those gains, and if you just held on. So we've all been there, right? Another one I mentioned Friday and also this morning was a Blue Owl, and symbol OWL, and these guys are down over 4%. The whole hyperscaling realm has been a mixed bag of success because, as I pointed out earlier, the biggest portion of that, semiconductors, have been crazy strong. Like Micron, like Applied Materials, like AMD, and the memory SNDK, WDC, things of that nature. But this one, which is in more of the finance realm, looked really appealing because that pink pattern you see on the right side, boy, is that big. And we had gone zooming up to it, and we seemed to have peaked on that on Thursday intraday, undid most of Thursday's gain on Friday. I shorted this early on Friday, and then we're augmenting that drop today. And so obviously what I'd love to see is an acceleration of that cut down. And one last individual short is a UNH, United Health Group, and they're down about 2%. Since I'm in self-flagellation mode, I'll also mention I had puts on this too, which are doing great, but I don't have them anymore. I just changed that to a simple short position, and it's doing fine. But yeah, the sheer size of profit is much bigger with those January puts, and this is a pretty steady performer too. I mean, look at this. It's just even just short term, looking at the past month or so, pretty steady. It is almost immaterial what the market is doing. I don't know if it's just the fact that a health insurance company is so unsexy compared to AMD or something, that people are just rotating out of dull stuff into fun, exciting stuff, or if there's something else going on. But regardless, from a chart perspective, the reason I did it was because of this lifetime trend line was broken with quite a lot of fireworks, and we had this explosive move higher, got close enough to the trend line to make it interesting, and then we seem to have pooped out. So we've got this cute little reversal. And as I say, you could put a ruler on the screen and cover up all those bars because it's so steady lower. Changing gears for a little bit. One item that's been going well today, which I appreciate, has been bonds. I'm showing this Forex pair because it's quite germane to this. The U.S. is, as a show of friendship, they say, deployed $10 billion to try to shore up the yen. And as is evidenced here, it worked for a couple of days. We'll see if it works longer term. But the goal being to please, Japan, don't sell our bonds. We really don't want even higher interest rates than they already are. Well, it ain't working. So my bond short's doing fine. Nothing too dramatic here, but definitely heading the right way. This lifetime chart, you can see we're breaking down nicely beneath that big pink reversal pattern. I could easily see us cutting below these lows here, but I've got this by two methods. I am long TBT in one account and short TLT in another account. TBT being the negative 2x ETF against bonds. So TLT failing nicely under all this trading activity. It's looking at the macro here is really quite a dull chart, but the direction's right. And we're plunging in areas here with precious little support. So we've got a nice tumble going on there, and obviously TBT is up about 1.6% because it's negative 2x. So liking what I see there. Let's wrap up. Final moments of the show here. Here's the ES. We are down around about 30 points right now. And we've essentially just, we're back to where the open was on Thursday. Big deal. Nothing really going on. To get any sort of bearish hope, we must break this level, and we really must break this level. This was a very powerful move right here, and it's going to take those two snaps to get people jumpy again. And as far as the NQ goes, this was not helpful. This cross right here is why semiconductors have gotten so rapidly less appealing. And we're up here now. So this is a much, much, much sloppier chart than it was, say, carving out the past 7 or 8 trading days back in the day right here. So much murkier than before. But if you look hard enough, there's still opportunities. Okay, well, that's it from me. I'll see you tomorrow. Take care. Bye-bye.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
We built Tasty Trade's web platform for today's traders. Drill into data, find opportunity, and track the action with hundreds of indicators. Fund your account and start trading right in the app. Join the club. Tasty Trade.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
We're back. You're watching Tasty Live. This is Last Call. I'm your host, Chris Vecchio. Today we have a special guest, Adam Sarhan. But before we get there, let's take a quick jaunt around these markets. S&P still trading lower, not that much though. 77.69 and 3/4. We haven't really moved much at all, I should say, here over the course of the day. Since I was last on, it's about 5 points to the downside overall. A session perhaps being spooked by yields. Bonds here are what's dragging down this market, at least for my virtue or venture point. I see here we're at 108 and 10 ticks right now in ZB. That's posting a new low for 2026. Oil's back up over 2% on the day here today as well. We're watching some headlines out of the Middle East. Trump threatening to bomb Iran and Oman, getting both sides of the strait these days. We'll see where this all pans out. We've talked about this in the past on the show. When Trump's rhetoric escalates, it's usually a precursor to a de-escalation. So maybe this is ultimately an oil move we should be fading here. But when we look around the board, the top tickers here are all of those semiconductor names. Micron, SanDisk. SanDisk is up 80% nearly from its low at the end of July. All right, that's why we're bringing on Adam Sarhan here today. He's the founder and CEO of 50 Park Investments. He's the host of a great podcast, the Smart Money Circle show, which I got to listen to an episode earlier today getting ready for this. I'd encourage you go listen to that as well. He also wrote the book Psychological Analysis, which if you're trading, you have to master yourself before you actually master these markets. So he's a perfect person to have on to help us guide this conversation through Last Call. Adam, thank you for joining us here on Tasty Live for Last Call.
Chris, thank you for the invitation. It's a pleasure to be here.
So the indexes are a little bit boring right now. I want to leave them alone for a second. 0.5%, not nothing, but not that exciting. SanDisk, Micron, Western Digital, Coherent, Marvell, these stocks are ripping again today. The semiconductor space is on fire. I know that you have spent your career identifying markets that are not like chasing to the upside, trying to find things that are cheap before they become, well, the next Micron or Marvell. I'm curious, when we see this kind of price action here, this roller coaster in some of these big names, does that tell you that this move is done, or is there still opportunity that maybe folks are misunderstanding still?
Oh, I think there's definitely opportunity, providing you don't chase. And chasing is really one of those FOMO. It's one of those emotional magnets that draw people into the market, and it causes a lot of errors and unforced errors because it's natural, it's human nature. You want to be involved, you feel like you missed it, and then what happens is after a big move up, people end up buying, and then you get that pullback of the correction, and then what happens? They stop out, they lose, and then it goes up without them to add insult to injury. And these are the classic things that happen over and over and over again. And it's what I built my career on, and I look for. It's take the name out of it and just look under the surface a little bit deeper here. At the end of the day, it's human nature. You walk into a crowded theater, yell fire. What happens, Chris? People run. It doesn't matter your language, your education, your socioeconomic level. There's certain things, patterns that humans do over and over again. So yeah, having a move like this in the strongest area for the year, not just for the last few days, but year to date, semiconductors are the strongest area in the market. And they had a big pullback in July. That guy Leopold got wiped out because he was over leveraged. I can go on a whole tangent there about defense first and the importance of respecting risk. But you had a pullback, and then that correction, a lot of these names corrected sharply, 30, 40, 50%. That's what happens with these big growth stocks, and that's my lane, leading stocks, growth stocks. And now they're coming right back up the right side after that shakeout and that squeeze. Think of it like a lemon. You squeezed out the weaker hands, and now the stronger hands prevail.
So let's be ticker agnostic here. If your philosophy is price first, what's the price telling you, given how quickly these things have moved in not just this year, but recent days? SanDisk is up 35% over the past 5 sessions.
These moves are extremely strong, and usually when you get these type of moves, it's a confluence of 3 factors. It could be short covering, because a lot of people were short going into July and early August. Now that they're starting to rally, it's like, wait a minute, maybe the end of the world is not happening in these names. So there's 3 forces. The first, a lot of those shorts have to cover. So how do you cover a short position? You have to buy. So that's one force of buying. Second is you have momentum traders step in, because you get back above certain moving averages. You get above, I see the downward trend line you drew there, which I like a lot. You get above these technical levels, and momentum traders are rewarded because stock goes up, price goes up, more people buy, and so on and so forth. And then the third confluence of factor or force of nature that comes in, if you will, are the value investors. You see a stock that was trading at, let's say, I don't know, $1, and then 3 weeks later, 6 weeks later, it's down 50%. Clearly, from a valuation standpoint, it's no longer overvalued. It's now undervalued compared to where it was just 3 weeks ago or 4 weeks ago. And then as the price goes up, they're rewarded. More value investors jump in, more momentum buying, and then guess what happens? More shorts have to cover, and then you repeat that whole cycle over and over again. That's why in corrections, bear markets, whatever word you want to use, you see some of the strongest and biggest moves to the upside because of those 3 factors.
I'm curious here. Today, I was looking at this tape, and with all the semis being up, one of the trades that I put on here, and we have a little follow page on our platform, was what we call a super bear in Qualcomm, right? SanDisk is up, Micron's up, Marvell's up. How come Qualcomm is struggling? And now it's down about 1% more from when I put this on. At 60 days to expiration, long a 135, 140 put spread, short a 185, 190 call spread here. I was looking at that because I have a lot of long semi stuff, long AI infrastructure stuff in my book personally right now. So figuring out ways to balance out my beta weighted deltas didn't seem like an irresponsible thing to do. But how do you distinguish an opportunity within a group? Like, do you look for the laggards or the leaders on those days when the market's up or down? To me, Qualcomm stood out like the ugly duckling today, and I wanted to take a shot at the one that was lagging behind.
So there's a great concept called relative strength, where you look at a stock relative to other stocks in the group and relative to the S&P 500. That's a big concept. We developed a platform called Market Terminal, which is like a Wall Street terminal for retail investors, because the big institutions use terminals to win. So I said, okay, great. Why not the rest of us? And that's on Market Terminal. We have a term. We have our own proprietary ratings. One of them is called current strength. So the problem with relative strength, Chris, is that it's relative to other stocks. You could see a very high relative strength, but the stock's down 50, 60%, like what happened to a lot of these AI stocks and semiconductor stocks over the last few weeks. So the current strength is a little bit different. It's more adaptable to the stock's own performance, in addition to the relative strength. So you get pretty much everything in the relative strength, plus you get a more adaptive or more sensitive rating based on where the stock is relative to its all-time highs or its recent highs. So to answer your question, with Qualcomm, whenever I have a stock that's outperforming on the upside or underperforming like Qualcomm on the downside, normally I would put it on my radar. I wouldn't pull the trigger, ready for this, until the market confirms my thesis. And that's one of the big things that I do. It's part of my investment system. It's called AMPD, AMPD, and every letter stands for something. But one of those is being aligned with the market. So a lot of this is like the scientific method, right? So what do they do in science? They teach us in school and kids, right? So you have a hypothesis. And then what do scientists do? They test the hypothesis, and they either works or it doesn't work. Good news, it's binary. And if it works, what do? You now go further. You can have a theory and all that kind of fun stuff. It can become a law and whatever, right? Okay, great. If it doesn't work, you just trash it. So with trading, a lot of the trades don't work. We get that if you're an active trader. As long as you keep your risk small, you're okay. But, and here's the but, I like to wait for the market to confirm my hypothesis. That's how I know that my trade has a higher likelihood. It doesn't have to happen, but it's a higher likelihood that that's going to work. So in that case, I really like what you're doing here, the way that you look at the market and say, hey, this, I always like to say the market's speaking and then ask, are you listening? This is how the market speaks. It's nonverbal communication, but it's communication nonetheless. So yes, I would wait for that, but I would wait for the signal where Qualcomm would actually break above those highs and or break out of recent highs, not all-time highs, but just that little shelf that you had shown earlier the last few days. And then the second it breaks above it, that tells me that, yeah, the market does agree, or that yellow line, whatever. Yeah, I can't see.
Yeah, one month average here. Yeah.
Yeah, there you go. Once it gets above the highs of the last 10 days or so, or a week and a half, whatever it is, several bars, and above that moving average, now all of a sudden I know that something has changed. The market's voting. And now all of a sudden my hypothesis, it's either going to be right and they'll continue to rally, or I'm wrong. It break out and the breakout fails. But at least there's a catalyst. Think of signal versus noise. You know, Elon Musk and Steve Jobs, they have that concept of a signal matters. It moves the needle. Noise, most things in life don't matter. So the signal would be, okay, the market's now confirming that this is a breakout to new highs. So either, you can buy near the breakout or buy above it, average up, or whatever you want to do into it.
Right.
But that's how I play the game, because otherwise it could base for the next, what if it goes sideways for 6 months and these other stocks are going up without it? And or what if this thing goes straight down?
Hey, fine by me. As long as Qualcomm doesn't go up, I'll be good here, right? And the market goes down, I'm fine with that. But yeah, you mentioned signal versus noise. Yeah, we do a little show here on our YouTube page called Signal versus Noise. I'd encourage folks to go check out today's episode. It's on a lot of VIX call buying here that's sitting out in September 16th. I don't know if you caught this today, Adam. This was a lot of volume in this one particular strike sitting out at 29 days to expiration. Someone was dumping, I see, 178,000 contracts traded here today in the 24 strike at 29 DTE. That's more volume than the rest of the strikes at 29 DTE combined. So certainly, interesting catalyst, interesting time of the year. We're getting through, perhaps FOMC, we're thinking about midterms coming up, but I don't know. We'll keep that in the back pocket. Okay, so before we hop off the memory stocks here, I want to give something for the audience. Micron, SanDisk, Marvel, Western Digital, Coherent. Which of these looks the cleanest to you in terms of your approach? And then more importantly, how do you know to say the run is over, I'm out? Because I think some folks did that a few months ago and they're feeling a little bit of regret right now. And as you mentioned, chasing is just the worst place to be in as a trader.
Yeah, for sure. So it all depends on your time frame. Number one is when you get in and or when you get out. Number one. Number two is I like to look for, again, catalysts. I like to say the market speaking. So recent highs. Did the stock break out above a breakout point or pivot point or whatever word you want to use? And if the answer is yes, how far extended are you above that breakout point? And the breakout point would just literally be resistance. If you're familiar with the concept of support and resistance would be the top of that trading range. So if you have a situation that it's clear resistance and you've broken out above it and you're 2, 3, 4, 5% near that breakout point, sure, you're in buyable range. But anything above that, it's just gone. Like this guy here, he's just way gone. I wouldn't buy him in good conscience because where's my exit? So let me leave you with this, Chris, and your audience as well. And I share this in my book too, Psychological Analysis. By the way, the book was #1 on Amazon every day for 3 months. Why? It teaches people how to make rational, not emotional decisions with their money. All right. So in it, part of it is having structure. So before I buy any stock or option or futures, I ask myself 3 questions. Number 1, where am I going to enter? Number 2, where am I going to exit? And number 3, how much do I risk of my account if I'm wrong? So once I can identify the risk before the entry, before the exit, now all of a sudden the emotional, oh, I like this stock, what if, the chasing, all of that right out the window. So if I don't have a clean entry, by definition, I don't have a clean exit, which means I don't have a clear point of risk. If you buy SanDisk right now, where do you exit if you're wrong? Today alone, how much is this thing up? Where's your percent change?
8.6% right now.
Yeah, so just today alone, you're up 8, almost 9%. Where are you going to exit? If it goes down 4%, if it goes down 5%, if it goes down 10%, it just gives back today's gain alone. So that's how I play the game, where it's like, all right. And by the way, if I did miss it, and I'm going to miss most of these, and so are most traders, guess what? That's okay. It's just like if you miss a bus and in a busy city, another bus is coming. An elevator. If you're in a building and there's an elevator, you miss the elevator, that's okay. Another elevator will come. Just like with leading stocks. There's nobody I know that catches every single leading stock at every single time and enters perfect. Take all that mental noise, the mental algorithm out of your mind. Just quiet your mind and say, it's okay. I don't have to catch all the stocks I'll get to the pretty girls in a second, but it's not possible, and that's okay. It's like the high school proverbial boy who goes into a high school dance. He wants to kiss all the pretty girls. It ain't gonna happen. That's okay. You need one, you're very happy. Same thing with stocks. If you catch a few good trends a year and you keep your risk small, you do very, very well. So that's how I look at stocks. I used to beat myself up when I missed these, and now I just realized it's another one of those, like Ray Dalio talks about. It's inevitable. It's going to happen to all of us. So that mental component, which is a big piece of what I do, is so paramount, because instead of fighting with myself and beating myself up, it's a negative ROI, which I did for years. Now it's like, all right, just take that breath and relax and realize there's always another elevator. There's always another opportunity. There's always another trade. And that's the beauty of what we do.
Yeah, we like to say it around here too. The market is always open tomorrow. Don't force the trades. Let the market come to you and move on. So let's talk about the calendar here moving forward. We only have you for a few more minutes. It's obviously much more interesting. This week, yeah, there's some earnings, the consumer stuff, which I actually think is important, but FOMC minutes, Vixpiration, monthly OPEX. Then we have NVIDIA earnings on August 26th. We're going to get the FOMC Jackson Hole next week, the 27th to the 29th. If you're managing a momentum portfolio, so to speak, right? I'm looking at my book right now and everything is tech related, AI related, and you have these risks in front of you with a VIX that's flirting below 15. How do you manage this portfolio of stocks?
So there's a great adage in Wall Street. It says never short a dull market. And if you pull up the Qs or pull up the S&P or the SPY or whatever, any of the major indices, you can notice, look at the, you have volume on this?
Yeah, I mean, 23 million traded in the triple Qs today, nothing.
It's so quiet. And that's the beauty of this. It's so quiet over the last few, not just, hours, days, the last few weeks. So what happened? At the last Fed meeting, which we get the minutes today, but this week, but the Fed meeting on the 29th of July, you had that big sell-off, that Leopold Low, that hedge fund manager who blew up because he was over-leveraged. And then what happened? You had a huge rally afterwards, huge, and a very short amount of time. Then you're basically sitting tight for the last, 7, 8, 9, 10, 15 days or so as volume dries up. So for me, this is the market's way of just pausing to consolidate a big move. And it's building a really tight shell for sideways consolidation on a daily chart. And the next move wins is one of my rules. If you break out and you have a nice rally up here, you can easily have a nice rally to new highs. And we're even with all this craziness and the SMH, the semiconductor index, fell hard. Even with that, the NASDAQ 100, which is heavy tech, was only down about 8-9% from an all-time high. At the time, the S&P was like 2 or 3% below an all-time high. So for me, we're in a bull market. Surprises in bull markets happen to the upside, not the downside. Until we see any heavy selling show up, the bulls are in control.
Listen, if we keep grinding higher, I'm not going to be an unhappy camper. I went out in April and purchased some end of year 8,000 calls in the S, which are getting ever so closer to moving in the money with each passing tick. So if we want to keep grinding to the upside, hey, listen, the kids are going to be happy for Christmas. I'm curious. You mentioned Leopold here. Last question. Yep. I feel like this is, and I gave the guy credit when I saw this on Twitter. I think his handle's like Deathmaker01. It was a tweet I happened to see randomly, but he pointed out very astutely that every story of financial success in the market, you read Market Wizards, for example, Jack Schwager's books.
Yep.
Every trading style is different. Time frame, analysis style, how they get in, how they get out, how they operate in a group or by themselves. But when you read the stories of everyone who failed, they're also all the same. But the lesson is one thing in particular. It's always leverage, right? What did the Leopold story tell you? And why was the market able to rally once his name was taken out of the equation?
It's a classic market tale, and it goes back as old as time. Forget Beauty and the Beast and, Belle, the tale as old as time. This is really the tale as old as time. To me, it's risk. It's not even leverage. To me, it's not respecting risk. One of my rules in the book, it's defense first. It's always respect risk. I've gone back, Chris, and I've studied every major bull and bear market in history, every major economic boom and bust. And if you go back, you saw the tulip bubble back in Holland, you had the bust afterwards, and every subsequent boom and bust afterwards, and the Market Wizards books, I've read all of them, which are fantastic, by the way. It's risk. The ones that fail because they don't respect risk. In 2008, the entire investment banking model collapsed, and I was there. I traded through it. There were 5 biggest investment banks: were Goldman Sachs, Morgan Stanley, Lehman Brothers, Bear Stearns, and Merrill Lynch. Merrill Lynch gone, Bear Stearns gone, Lehman failed, and it left you with Goldman and Morgan, and those two had to change from investment banks to commercial banks. Almost overnight, you had the entire investment banking model destroyed. Now, the folks running those firms are very intelligent people. But what did they all do in common? They did not respect risk. Leopold, to his, whether infinite genius or infinite other side of that coin, what did he fail to do? He did not respect risk. So when you have, just understand math, when you buy something, let's say at 100 and it goes down 50%, you're now at 50. In order to get back to 100, it has to go up 100%. How often does that happen? Usually, rarely, almost never, right? So, and the math, by the way, just gets worse and worse and worse. If you go down 80%, it has to be like 700% to get back to even some crazy number like that. It's not exactly 700 something, but it's not linear. It's not down 10%, has to go up 10% to get back to even. It's not like that. It's just numbers. So a SanDisk that goes down 50%, if you're 4x leveraged, you're wiped out. If it goes down 25% and you're 4x leverage, you're wiped out. And these growth stocks that he was heavily invested in, they do go down. We just saw it in July. They go down double digits, 20, 30, 40, 50% at times. And if you're over leveraged, you get wiped out. And that's what happened to him. So Citadel came in, perhaps the smartest folks on the street right now, or one of the smartest folks on the street, and said, okay, we'll basically save you, bail you out, but 40, 50 cents on the dollar. Well, what is Citadel? They have two sides. They have a market making side and a hedge fund side. Well, all right, we bought them. Now that this guy's wiped out, again, the weak hands get crushed in those corrections or bear markets. They were bear markets in some of those stocks. What happened? We can just buy. And everyone that shorted, we spoke about those three forces when you have the short covering rally, all those shorts had the cover. And that's exactly what's happening now.
It's been a pleasure speaking with you. He's been Adam Sarhan. He is the CEO and founder of 50 Park Investments. He wrote the book, Psychological Analysis. We're just talking through it. It's on the shelf there. He also has this podcast, Smart Money Circle Show, which I'd encourage you to go to listen, but not during the trading day. You're watching Tasty Live during the trading day. Adam, we will hopefully see you another time.
First, it's a pleasure. Thank you.
Folks, we have about 7 minutes to go here in our trading session right now. Great guest here on Last Call. Again, last week, we're doing these guest interviews to finish out the 30 minutes of the trading day. Next week, we'll be having Gus back on, I believe, with me in the afternoon slot. So stay tuned for that. But here we are with a market that is sitting just pinned near where we were when we started Last Call, 77.70. It's one of the reasons why we're doing these guest interviews during the summer months, folks, because this is a market that's not moving around a lot. Now, we are testing the lows of the day. The Nasdaq's off by 0.14%. Russell, Dow Jones off by around 0.5% each, but it's been very quiet on that front for most of the afternoon session here. What's in the driver's seat? Because quite frankly, it's not equities. Equities, 819,000 contracts traded here in ES. That's not anything at all. That's actually one of the quieter days that we've seen, including from last week, which was a pretty quiet week. It's oil, though. A market with low volume and, quite frankly, low participation becomes a little bit more sensitive when some of the levers in the market begin to spin and get pulled wildly. And oil here is now nearly 3% on the session. This morning, going into the afternoon, noon Eastern, oil's trading in at what, 81.90? So it's added about $2 here over the past 3.5, 4 hours or so. I'm not trading oil in a meaningful way. I'm not sure about anyone else here. I've been kind of sticking on the sidelines, but for a longer dated short put position that's sitting out 69.71, I cleared a lot of that risk out. We were sitting in the middle of the range. I didn't like any of the pricing here. This particular short call spread, short put spread, I should say, in oil went back on several months ago in the CLV6 contract, and there's still 90 odd days to go. But we talk about what, 90? Oh, where are you on this board here? We're going to have to scroll through. This is definitely an earlier trade. I believe that was in the neighborhood of here. That seems about right. Yeah. Yeah. So we're only at 58 cents right now. This is only about like 28%, I think, 29% of the way through decay. And that's the unfortunate nature of when you sit this long term. For it to actually work, it's got to sit for a while to work. If we get a little bit higher, though, I am going to take it off because I don't want to be in oil towards the top of the range, particularly with Trump's rhetoric these days, which is a question we've received a lot about today. I've seen it in the chat a few times. Is Trump going to bomb another country in the Middle East? He's talking about bombing Iran, Oman now, too. Look, Trump has had some rather aggressive commentary here over the course of the war, no doubt about it. He made his civilization is going to end commentary at the end of March, right before he called everything off. and started moving towards a ceasefire. And of course, the markets then rallied there afterwards. We heard a few weeks ago when he was talking about having a special surprise and a blow off the top of Pickaxe Mountain, right? And then all of a sudden we start talking again with Iran. So these escalating to de-escalate types of verbal jousting, that has been the playbook he's used here for the past few weeks. So we're getting a little bit of a way up in oil, just like we did back then. And we'll see what comes around the corner. But in terms of the volatility component of all this, 25 IVR right now in oil vol is not high compared to where we have been throughout this cycle. 50s, 60s when you're going out throughout the V expiry, that doesn't seem like a lot right now. So I'm mindful of selling vol. I don't want to go in and sell a call spread just yet. And quite frankly, selling a put spread doesn't seem that great either. So oil here is doing its own business, but that's good news for what we have been having fun operating in, which would be bonds. Past few weeks with TP, rolling down short exposure in the bond market in some form or fashion, at the money, slightly out of the money, put spreads here. The most recent one was after CPI the other day, because CPI came in at the screws, right on the nose. And one of our working theories around here, which now we have evidence, more evidence in practice, is as a mirror image to the September 2024 Fed rate cut of 50 basis points when they gave us 50 instead of 25, marginally more easing. If we get any data that suggests the Fed does not need a hike right now when the market does actually want it to hike, then you're going to get more inflation. And what happened in 2024? Long into the yield curve blew out. And so after we got an inflation report that was on the nose the other day, I went in with 108, 107, long put spread here. Folks, it's still working. It's 11 days to expiration. It's a little bit of a reach. I'm comfortable holding it right now. I am very cognizant of the fact, though, that if oil goes down, takes the elevator down tomorrow or the next day, this thing is going to go. And because of the way it's trade structure, there's a good deal of gamma risk here. So this could go from being a profitable trade to unprofitable. I want to see a tick in the 107s. That's what I'm holding out for. And then I'm going to get rid of it and wait for a rebound and wash, rinse, repeat to see if we can latch back onto the trend. Beyond that, though, I did see that there were some, big movements in semiconductors today. Semis, to me, I had to avoid. If you were listening to that segment with Adam Sarhan from 50 Park Investments, I mentioned the fact that I put on a super bear or double bear trade, which when semis are up 6, 7, 8% and Qualcomm was down 1, it made no sense to me that we would want to look to have a sympathy trade higher. This thing has been a dog. And if it's going to fail and the market, if semis are going to fall, why wouldn't this be the first one to fall here? So today it bounces back above its 1 month. It finds itself above its 1 month, but below its 50. A nice little sell the rip criteria met. Indeed, put on the super bear. So how will this work out? It's 60 days to expiration. This is not looking for an immediate pullback here. I point that out because semis are really strong in this tape. The idea here is that maybe we can grind sideways to lower. And if there is a correction in the market, Qualcomm's the first one to go down. And I can ring this bell and take this off pretty quickly and use it to help insulate losses elsewhere. But we have about 30 seconds left on this trading day right now. Outside of that, we're going to want to pay attention to the Home Depot earnings tomorrow morning, which if you were with us on the trade of the day, I am working that short iron condor here, 322.5, 325, 352.5, 55, in part because, well, the market pricing is pretty decent right now. And $1.07, well, we could flip that, but $1.07 on your credit for $2.50 wide strike. A little idiosyncratic risk. The CEO has been taking a health leave, but we can use that tomorrow morning to inform us on Lowe's, which this is the Consumers Week. Home Depot, Lowe's, TJX, Ross stores, they're all coming. They're all going to be out tomorrow morning through Thursday afternoon. Our S&P 500, 77.66 here, 67 on the close. It's a loss of about 0.5%. The Nasdaq down 0.2. The Dow, the Russell off by about 0.5% and 0.3% respectively. Okay, that was the closing bell, which means it's time for us to close this out. But, there's more conversation to be had ahead. You know him, you love him. It's Jermal Chandler, and you also love him. It's Karsan. They're up here for TastyCrumbs. That's next on the network. They're going to debate the real issues. And is Vixpiration the end of the bull run? Find out next.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools, and place trades in a single click. all on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move. Investopedia says we're the best for options trading. Stockbrokers.com says we're #1, and Broker Chooser raves about us too. So what else can we say other than boom? Trade like a trader. Tasty Trade.
Am I okay with this mic? Should I move it? I shouldn't touch it probably, huh?
We're in an environment where things are so quiet you can hear a pin drop. It's the doldrums of summer, but there could be some things coming along the way. Welcome to Tasty Crumbs. I'm Jermal Chandler. He's Jim Karsan. Mr. Karsan, how you doing?
Doing well. Good to be here. Happy Monday.
Yeah, man. Happy Monday. I was looking this morning, and honestly, I would say the expected move probably exceeded what I thought was going to happen, to be totally honest. We had 36 points today. I didn't even see what the move was ahead of time, but I do know that we came in. We talked about the weekend effect last week, and we definitely saw that play out a little bit today. We saw VIX as low as 14, 18. Is that what the low print I saw on Friday?
Yep.
Remember
the weekend effect makes that look lower on Fridays.
For sure.
You come in on a Monday and you see it pop. That's gonna be a recurrent thing here because we're on Mondays, but
which is nice.
It's gonna look like the VIX is always up when I come on, which that's kind of in line with
I don't know if we really want to call it up today. You know
that's
what
right.
I mean?
It's not really up. That's the thing. So
But as we're already on this convo, we got a couple of charts here. Let's go into them. Just illustrating how low things absolutely are in the VIX environment. And so, just looking at VVIX and VIX, I actually like to do this chart a lot of times as a ratio, and I think about it in terms of that. It's essentially around 6 right now. Fair value for that over the last 10 years is about 5.8. So we're just right on that measure. But this is not the ratio. This is them themselves, right? And we do know the long-term average is about 19 or so. Some people say 20 for VIX. I would say long-term average, at least for VVIX, can be somewhere around 100. We're well below those, right? Illustrating just how low things are. And if we go to the next slide, we see this actually, just looking at the volatility risk premium, which I know you're very well aware of, but that difference between VIX and 30-day historical vol, is extremely low. Just looking back to March, where everything was a little bit fearful, we saw way higher. And at this level, we talk, Jim, we talk here to Tasty people a lot about selling volatility. I'm the first one to say this is not the environment I want to sell vol in. I don't want to have any strangles. Sure, you could be short, downside if you want, with that idea of eventually taking on a stock position, but it's not high volatility. It's not high premium. It doesn't matter if it's an individual name. It doesn't matter if it's index. It's low vol right now. And so these are the hard trading environments.
yeah. And what I'll highlight is a lot of the time, this is counterintuitive, but when implied vol or the VIX is low, that actual spread of realized to implied actually tends to be a little higher, because vol is usually low historically for a reason, or like the pinning effects drive less realized vol. And we're actually seeing low premium and low vol right as you're coming out of the summer. And we'll get to a little bit more of other signs. It's not just that it's low, so you should buy it. It's not just because we're coming out of the summer, so you should buy it. It's because it's low with a lot of signs under the hood that it's too cheap as we come out of the summer. And as you pointed, even that risk premium is quite low.
But the interesting thing, though, is and you're right, vol is low. We've illustrated that, and vol is low in indexes. But the interesting thing is that there is still high implied premium in some individual names. I know you're not an individual name guy, but how do you not get trapped in that if you're trying to reach for alpha, trying to reach for something to trade right now, and you see an individual name, let's just highlight like an individual LRCX or some type of, most of them are tech names, right, that are might be high implied vol. How do you not reach for that and sell that right now saying, I got to trade something?
Well, so first of all, dispersion, we'll get to that here in a little bit here, has been at record levels. We talked about in May how this summer was going to have the highest dispersion ever. Sure enough, it did. We actually talked about that. The momentum names and the names that you're talking about largely would explode in vol while the index would stay muted for all the reasons we've kind of gone into here, which is if the index is pinned, you tend to get stuff moving away from each other. So that happened, which then understandably expanded the vol there on the realized, on the implied vol for those names. What you're seeing lately is that starting to come down. So implied correlation, or the implied vol between the two, is starting to narrow, right? Which is what tends to also happen, and we'll get to this in a chart here in a little bit, also tends to drive reflexively then a more of a VIX increase and a delta one kind of correlated move. So I would say, look, if you're gonna sell vol somewhere to buy it somewhere, I agree that it should be in those names, right? Where the vol is higher, but you should net be longer vol where it's cheap and in other places. One of the better trades, and if you're gonna play for kind of downside broadly, is to actually sell the call skew to buy the put skew in those names you're talking about. So you don't have to play the vol per se, like in these Momo names. Because there's been such a call squeeze and that call vol has squeezed up so much over time. Again, there were slightly better entry points a few weeks ago, but it's still a great time to be selling that call vol in those names to buy the put vol. If you can do zero premium callers with kind of some of these names slowing down here as we're coming out of the summer, that's really interesting, if you ask me.
Not a bad idea. That's a good idea. That's a good idea. You're coming around to the retail people. You're starting to give them a little bit what they want, man. Not yet. Don't get too happy with them yet.
Sometimes we do a little more than crumbs. Sometimes you get the whole pastry.
Okay, I hear you. But you have, I know you have at least a couple of things here that outlines how you're feeling, is what you think is about to come at some point in time in the future. Is there any, you've laid out the scenario in which you feel like what might happen. Is there anything that makes you think that thesis might change? Because look, we've seen things change in this economy. We've seen the wool pulled over our eyes right in front of us, and it didn't even matter. We've seen these inflation reports that potentially show there's not inflation, but yet we know it still exists in the system. We know that retailers aren't spending that much, what we saw from retail sales the other day. So, I mean, does that give you cause to think this is still going to happen, or, you know what, maybe not?
To be clear, there's three different parts in prediction. We've talked about this before, kind of a three-legged stool. There's the flows, right, which is very kind of short-term, what's happening in the next week, month, quarter that really affects those things, like day-to-day. There is the macro, right, which is what everybody loves to talk about. It is as causal, usually after the move already happened, but it is very important on a more kind of quarterly, annual, multi-annual basis, right? And then there's the administration, and reflexively, what is the Fed? What is the Treasury? What are they doing, right, in order to kind of counteract things, to get the market moving or whatnot? These are the three things we're going to talk about again and again and again. The flows, which there's just a chart up there that I want to kind of get to, has been incredibly, from the vol perspective, incredibly compressed. So things have been very supportive and constructive throughout the summer, as they tend to be if you go into the summer in a healthy way, particularly lately as the vols have increased. And as we talked about, when that happens, you tend to see correlation breakdown. And what you see here for the last 3 years from the flows perspective is whenever those vols get really, really, really compressed, that's kind of that VIX chart at the bottom, you start to see these kind of lower levels along the way, correlation starts to break down. And after correlation really, really, that's the bottom part there, has really broken down like we've seen it now. And this is a 20-day or 1 month moving average, 20-day correlation breakdown and the underlying constituents of the S&P, right? Mm-hmm. When that really happens, once you've gotten to the end of this, that generally means when it does happen, that vol at the index level has been unnaturally kind of compressing what is otherwise what I would call idiosyncratic vol or kind of real vol, like things that are really moving the market. And when things are going on under the hood, you're getting big correlation breakdowns and the index is pinned. Eventually, as that vol, for whatever reason, sometimes it's seasonality, it's the volume coming back at the end of summer like we talked about, which is why we've kind of pointed to that as a risk. As that starts to happen, that correlation breakdown, which you see has been a fairly reliable, not right away, always. Sometimes it's a couple weeks. Sometimes it's, even as long as a month. But before too long, that drives the opposite, which is a vol expansion and more of a correlation one move, which then brings back that correlation. That's what this chart's telling you. And some people will be like, data set of 4. Come on. Like, that's not. And again, some people will be like, this last 3 years, show us something longer. The truth is these effects are getting bigger and bigger as vol flows get bigger and bigger. We've been talking about these for at least 6 years, right? Mm-hmm. But they are bigger than ever, and they are becoming more determinative than ever, okay? And so my point to you is this chart gives you a little bit of a keyhole into how that works. And where do you see us right now, right where that red circle is? So right as we're coming out this summer, right as there's a setup of that index vol compression likely expanding, as we've talked about for the reasons we've talked about, that correlation breakdown has been really low. And so that's a really nice setup for a Delta 1 move and likely a move lower with VIX going higher.
Yeah, but Jim, the thing I'm going to ask you though is and this is the thing that people ask me all the time. I mean, how do you know that what's going to happen here? So when we look, let's zoom in on the chart.
First of all, nobody ever said I know. This is about probabilities.
Maybe you don't know, but my point is
signs and clues that are underneath the surface, right?
Looking at these days, right? Looking at April 2024, I'm pretty sure that's Liberation Day, right? I think. I can't even, you know what? Yes. These things are starting to run together. It's
yes.
Get a little hard to remember. Pretty sure July was also tariff related, July of 2024. October was sort of this breakdown with oil, with gold and silver and some of those, and that's led to this environment where volatility picked up big. Earlier this year was obviously what we just went through in April, and then obviously we're getting here now. I mean, it's almost
narrative follows price. Narrative follows price. I'll give you an example. If the market hadn't declined on Liberation Day, would we still be talking about it? No. The reason people think that Liberation Day is so important, the reason we talk about it, because the market went down. Whenever something big happens, by the way, we have a huge kind of mess of Strait of Hormuz. Is anybody even talking about the macro? If now the market had a big crash, now we'd be talking about the Strait of Hormuz and how it was a problem.
Mm-hmm. Wait, what are you trying to say? You're trying to say that these things are only talked about after the fact?
Correct. We talk about them beforehand, and then it doesn't lead to anything. It doesn't.
Yeah, but everybody was talking about Liberation Day.
By the market responded to something.
Everybody was talking about Liberation Day before it happened. I honestly didn't think it was going to be as big of a deal as it is, and clearly I think the rest of the market didn't. Is my point, And so it's easy to say right now, vol is low. We're due for a big bounce back coming soon, but what's the catalyst?
I'm not the catalyst. My point to you is often the catalysts are already present. Here's another great example. We've talked about this. We were sitting on shows. I was talking to my clients actively in late December, early January about COVID. COVID was already a thing.
Right.
All right. Did the stressful event happen in December, January, or did it wait 2.5 months later? About 2 months later. It happened 2 months later. The Strait of Hormuz is nobody's worried about it as a crisis really yet, or they were for a second and I've forgotten about it. But when the event happens, we'll say, that was X or Y. My point is, underneath the hood, macro moves very slowly. It has structural effects that degrade and present themselves, as you see in the chart, underneath the hood. But the flows eventually unlock. And when the flows unlock or expand, like the vol expands, the flows become less supportive, risk that is underneath the hood is allowed to present itself, right? We have all kinds of examples of this throughout history. I could go on and on and on about this. I'm not saying the macro doesn't matter, but if you want to know when the timing is right and whatnot, you need a macro setup. You need to understand the bigger structural risks and why things are potentially dangerous. But then you have to sometimes wait quarters, maybe even a year before the actual net effect plays out. And in the meantime, you have to understand the flows, the administration, and how the responses to things are playing out in between. But to answer your question, what is it? Everybody wants to point to the macro effect, or this earnings drove X, or this CPI number drove Y. The reality is the majority of the actual short term, meaning weekly, monthly, quarterly timing of how things play out is a function of supply and demand. It's a function of the flows and how those are hitting the market, how they're affecting outcomes. And why right now is it a potential problem? What that chart up there is telling you is the stresses are already present under the hood. They're already building under the hood. The vol, the flows are not allowing it to happen. So my question is, your question really should be, well, if that's the case, Jim, how do we know we're not in, July, where it took a month and a half for the stress to happen?
That's the real question.
And
because actually, I don't think they already exist. Like, I think something that is currently the case right now, I think that to imply that, like, first of all, I think COVID versus, some of these other things are completely different. There's generational stuff, and then there's stuff that's happening currently, right? Like, it's different. I don't think that the thing that always takes us down is something that always existed. It usually ends up presenting itself in a different way, or it ends up manifesting itself bigger and bigger, right? Like, we don't necessarily, like, I agree. It can be a catalyst, but to me, anything that comes out right now that really scares people is going to create a situation where VIX is going to jump to 18 or 20. I mean, look how low we are. Like, we're extremely low.
I agree with you right now, but I would say if that was a month ago, it would not be the case. My point to you is fragility and the creation of an opportunity for markets to respond to things is a function of the flows and the setup, right?
Okay, yeah. I think we both agree on that.
And by the way, I'm not saying a macro event. This is not saying that, macro never matters in the short term. Nuclear bomb is about the surprise. It's about the speed and how surprising it is for markets for how much it can affect things. So, like, a nuclear bomb goes off in New York City tomorrow, nobody's expecting it. Yes, you're going to have a massive risk on.
Well, it sounds like you're conflicted about what macro is.
No, I'm not conflicted at all.
Because you said obviously, COVID was a macro thing to some degree, right? I mean, it affected the macro economy.
Yes, but it did not surprise the market. People were actually hedged and prepared for it. That is why it took longer. That's why it was difficult for it to play out reflexively. If people are hedged for an event, I have a saying, knowledge is vol dampening. If people know something is happening, they prepare for it. It is very hard for markets to react to that. You have to wash out the supply and demand that exists out there. So a great example, again, is COVID. People were prepared for it. So you need to kind of squeeze the people who are trying to short it and buy vol before you could roll it over. There are plenty of examples like this oil recently with Strait of Hormuz. Nobody would have expected that to happen. Well, because everybody thought it was obvious oil was going higher. And that became a reflexive trade that now is taking a while to play out, right? Knowledge is vol dampening. The more people are prepared for things, the less likely they are to happen on a supply and demand basis. Doesn't mean they're eventually not going to happen unless reflexively the policy or the reality of the situation changes. But the reality is usually things that are stressful that people are prepared for largely take a while to play out. They eventually do matter. Market is a weighing machine in the long term. It is a voting machine in the short term, right? What does that mean? That's Benjamin Graham's quote. That means in the short term, it's just about buyers and sellers. The price is determined by buyers and sellers. And that price is just a matter of voting buy, sell versus the weighing machine. Eventually, the realities of the situation come out and play a role and to get things to where they should be. But the path there could be dramatically different. You could go 2 years, right? I've seen this before, where the outcome is clear that we will be down 40%. But you can go 2 years and the path might be a year and a half, 40% rally followed by a 90% decline, a la the tech bubble, right? Yeah. Or the great financial crisis. I've lived through both of those. Both of those markets, we knew about those things way beforehand. We literally talked about them at length for a year and a half before each. Everybody was early. That's why it took so long to happen. That's why we got blow off tops and fall compression that seemed irrational. Doesn't mean they didn't happen. We knew about them beforehand, right? If anything, it made them take longer and become a bigger bubble. Same is true here. So the flows are critical. You have to understand the flows. The macro matters, but it matters over a much longer time frame, and the path there can be very, very choppy and very different depending on how much it surprises the market and what positioning looks like.
So you mentioned the flows. We're arguably at a point where the flows could be changing soon here. Tomorrow's Tuesday. We know that's followed by Wednesday, which is going to be VIX expiration, as we fondly like to refer to it for those of us who trade. And of course, later in this week, we got an August expiration. We talked a little bit about that last week, but again, I mean, this is a setup, kind of what you're hinting to here. There's possible chance for flows to change.
Yep. And it's not just the flows. I'll jump in here. It is also the fact that, well, this is flows related too, but it is macro and flows meeting, is we have a midterm election coming up in early November. And oddly, very few people are talking about it. And if you actually go look at the event vol, like the one-day event vol priced in for that, in my opinion, it's incredibly low.
Well, and not to cut you off, but even bigger than that, not only people aren't talking about it, we don't see it in VIX futures, right? I mean, we usually see something like that in VIX futures. Why? I'm
It's
a little
very
surprised
small
by that, aren't you?
relative to the event risk. I think that's very true. I think the market is starting to wake up to that slowly. You're starting to see a move there. But I've highlighted on here, this is not only a reason to buy post-election vol, because you're going to get that event vol appreciation, but broadly, vol is too low in general. And the increase in that vol is likely to decrease what I call the vol supply, the amount of implied vol that dealers have. Right now, dealers are still quite long of implied vol because it is low, and it is because volumes are low and they haven't been taken out of it fully. They are quite long of vol. And what will likely happen is as we move out of the summer and into September, which is already a vol increasing time, there's already the signs from a flow basis seasonally that that's going to start happening through the correlation, everything else we're seeing. But on top of that, that midterm vol being low is going to, if people start to buy that now, it starts to increase, you're likely to see stress. This is what this chart kind of speaks to. This chart shows the last elections going all the way back to 2002, so about 20 years here of elections, and what the outcomes have been starting as of like a day or two ago, right?
Mm-hmm.
And yes, some perform reasonably well, right? But if you were to take this and say, hey, this is the next, especially until about 20 days left, about a month left until early October, would you think that's a good risk reward base if this is your data set? And I generally say no, not at all. There's meaningful risk there. There's two outcomes out of the six, right? Where you'd see 20.
Yeah, I was going to say, which ones you highlighting here? 2018?
What's that?
Which ones you highlighting here? You say you see two. Which ones you talking
Well, I'm talking about the poor outcomes there, which are 2022 and what is that? The orange 2002, right? Yeah. But if you look at even like 2014, 2018, those aren't particularly good outcomes, especially here for the next 40 trading days, which is about 2 months, right? You have about 4 of them there that are quite weak here for the next 2 months, and as we go to 3 months, right, it still doesn't look all that great. So my point to you is, good time for caution. Why this isn't just looking at a data set and saying, hey, I mean, the reason this is happening is a lot of the things I talked about. When you start moving towards the election, coming out of the summer, what you see is not only that normal seasonality, but an even greater level of pressure from implied vol and stress because vol is likely to go higher, just as a function of the midterms coming into picture and people not wanting to be short the vol, if anything, being longer vol for the risks around that time. Importantly, I would say also, more recently, the elections have been more dangerous from a vol perspective, right? Because we're in a more populist period. There's a lot more at stake. And so not only is there embedded macro risk at its base, at its core, but these elections embody that risk and kind of magnify it. So between the coming out of the summer, low vol, signs of correlation breakdown, which tend to precede these issues, coming out into a midterm that's underpriced in terms of implied volatility, that historically tends to drive your probabilities of a vol increase are meaningful. That's the point I'm trying to make. This is not determinative. It is, and it doesn't even mean, by the way, we could see vol go higher without a meaningful decline. But again, I'll highlight the one last fact that you don't see on this. These are all presidential elections. But if you go to the last 3 midterms, right? The last 3 midterms, which is 2022, 2018, and 14, right? All 3 of the last midterms have had a 10% decline or bigger that started either at August or Sep expiration, within a day of expiration or a day of expiration, okay? 3, all of them 10% or more declines, all of them starting within a day of expiration or expiration. That's kind of a weird coincidence. I know, again, small data
Well, hold on.
set.
Yeah, well, that's a good call out, by the way. There has been, but there's also been a little bit of changes in those times, right? Like, I'm the worst at politics, but remind me, 2014 to 2014 was.
Keep wanting to go back to macro. I'm talking about flows.
No. But just the change. The reason why there were those downtrends, my point I'm trying to get at, is because there were changes. There were changes.
Reasons because of supply and demand.
Yeah, but there were changes between 2014 to the next president, right? From 2014, that midterm to the next president, and then 2018
these
from
are all
the next
midterms,
president.
to be clear, and they're all pre-midterms. The move we're talking about is without knowing any change in fact of what may or may not be happening at the midterm, right? I'm talking about August or September.
I'm just trying to find a pattern in what you're saying. I actually agree with you on this.
Okay, go ahead.
But my point is that I think, didn't the presidents change from those midterms to the actual general election in all 3 of those, right? Went from Trump to Biden and Biden to Trump.
Yeah, midterms almost always.
This one is about to change. This one may or may not change. We'll see, I guess, right?
Yeah.
So that's an interesting dynamic is what I'm trying to say.
I hear you. Midterms are more important and have a tendency, I agree with you, to hurt the incumbent president. For there to be a move. Everybody comes in with this. I said this when Trump came in. Everybody was like, "Woo! Things are going to change. The world's going to be way better." Everybody was exuberant. I was like, "Okay, wait a year or 2. Easy. Every time this is what happens. People get excited, and then it's just more of the same, if not worse." And so this is no different. Midterms tend to go against the incumbent. So yes, there is a point to that. That's fair. But I think the bigger point of like, why now? Why not? If that's the case, you could argue, well, that should have started earlier in the year, or right? Why at this point? Why August expiration? Why SEP OPEX? Why does it so consistently have a 10% decline within a day of these events? And my point to you is, it is because of the flows. It is because these risks exist that I agree with, that you're highlighting. It is a loss of control by the administration, which tends to create more risk. But the unleashing of the decline, the risk that presents itself in these specific windows as a function of the flows, right? And I will highlight in the 2014 and 2018 declines happened in September at expiration. But the 2022 decline happened at August expiration. So, okay, it's only one data point, but it does seem to be moving sooner. And then a reason I'll say it seems like it's moving sooner, 2024, which is not a midterm, it's a presidential election, but same dynamics of elections happened in early August, right? So people are aware of this. They are starting to front run these realities, right? And as they do, it tends to bring any decline or stress forward. So could it happen? Wait till September again? Yes. Could it not happen at all? Yes. But I would say that, with the VIX expansion likely here, I would be looking very closely here at August OPEX. And right where we are now is a very, very important transition period.
If we don't get like 5% declines in the next 3 months, people are going to completely roast you.
Okay.
But if we do, I'm going to help you take the victory lap. How about that?
I want to be clear. The easy trade is going long, right? Coming on here and being rah, Tom Lee, whoever, always bullish. That's the easy trade.
It is the
It's easy to be always, be right, 80% of the time, particularly when you're buying the dip. You kind of go mildly bullish. I'm mildly bullish.
I think it's a good time to get long.
And you get decline, you're like, I'm much more bullish. And everybody's like, this guy's a genius. No, that hard part is actually calling the shorts. And when you do get those right, and by the way, I don't expect to get them all right? Sure. I expect to get about 60% of them wrong, and that's amazing, right? If I'm getting or 40 to 60%, like anywhere in the middle is amazing. And We have a much better track record than that, I would say. Go look at the media. Go decide for yourself.
Yeah.
Make your own trades, make your own bets. But this is the hard part of the trade.
I love it, Jim, with the humble brag. I think we've established some pretty good things here today. We established vol's pretty low, but there's chances of it moving. We both feel like it's a little weird that the midterm elections is being a little underpriced now, but we have highlighted the idea of selling upside to potentially buy downside heading into this is probably a pretty decent.
In the momentum names, I want to be clear.
Yeah, in the momentum names, right? In the momentum names where that skew is a little bit more to the upside. So those are potential trades here. So,
and the reason I wanted to say that, by the way, is because index skew is quite high. So yeah, if you sell the call, buy the put in the indexes, I'm not saying that won't potentially work on a big decline, but the price are getting significantly worse. So given this correlation break, right, the call squeeze relative to put in that part of the market, especially if we're going to see more of a delta one move, doing that kind of reverse call or a risk reversal the other way in those names is particularly appealing.
Jim dropping crumbs. I'm dropping crumbs along with him, folks. This has been another Tasty Crumbs. Jim Karsan. I'm Jermal Chandler. Join us every Monday at 3 p.m. Central Time. We'll be here bringing the heat. Thanks for watching.
You bring it,
They're gonna bring it down. I gotta feel good. You wanna see my moves? Let's party all night. We gonna build it up and then we tear it down. They gonna know our name all over this town. We gonna stir it up and do things our way. So if you wanna move, get out of our way. I'm feeling fly tonight, like a rocket ship. I wanna drive fast in this red hot whip. We gonna stand our ground and show off all our moves. Get out the glitter ball and play some dope blues. I wanna play the game, I wanna roll the dice. I got an easy hand that's gonna make the night. You wanna dance off? Let's get our shoes on. I'm done with all your fussing, this body totally bussin'. Summer
I'm still coming down from the weekend. Saturday night like we should. I know I should work a bit harder, but baby, your love is too good. You knew what you did when you planned it, you scammed it, making right off like a bandit. I know that you worked a bit harder, 'cause baby, your love is too good. Touch me, hold me, love me, know me. I like how you do it, you're helping me through it. Baby, your love is too good. You knew what you did when you planned it, you scammed it, making right off like a bandit. I know what I know, it's time that I go, 'cause baby, your love is too good. Baby, your love is too good. Touch me, hold me, love me, know me. I like how you do it, you're helping me through it. Baby, your love is too good. Touch me, hold me, love me, know me. I like how you do it, you're helping